Right, good morning, ladies and gentlemen, and welcome to day one of the BCI Global Investment Conference, broadcasting live from the beautiful Lord Charles Hotel in a very stormy Somerset West. So to our online audience, you are missing a fabulous storm. And to our live audience here, thank you all for coming through. We were a bit worried this morning, so I see some of you came with your canoes and your rescue jackets swimming to the venue. But thank you all for being here this morning. It's really great to see so many of you here. To our online audience, a big warm welcome as well. Thank you so much for joining us online, and we'll keep you updated with proceedings as we progress. This will sadly be the last BCI Global Investment Conference, but definitely not the last global conference. All right, so we're not going to use the acronym BCI going forward. So in future, we're going to have or use the Fundrock acronym, and it will become the Fundrock Global Investment Conference. So the journey is definitely not ending. It's just picking up momentum and becoming a lot more powerful. We prepared a short clip for you all to take you through this journey from humble beginnings almost 14 years ago and to where we are now. And we'll play it for you just now. Thank you.
Founded in 2014, Boutique Collective Investments has always had a clear vision: to put managers first, scale with our partners, deliver consistency, and build trust. Growing from 2 billion Rand to over 600 billion Rand in assets under management. Today, we administer more than 600 funds and stand as South Africa's largest manco, expanding beyond traditional unit trusts into hedge funds and broader investment solutions. Now we take the next step forward. Boutique Collective Investments becomes Fundrock Collective Investments. The same team, the same focus, the same partnership approach, but now with even greater scale to support you. Continuity you trust. Scale that delivers.
Right, thank you for that. And I think the key message of that video is exactly that. You know, we remain humble. We're grateful for the clients we deal with and some of the top investment minds, not only in SA, but globally as well. And we strive to maintain that excellence of client service. Fundrock, or BCI, is the largest manco in SA. And Fundrock is the largest white labeling manco globally. So you're part of truly a very powerful international manco going forward. The fund name change in unit trust funds will take effect in the next few months, but we'll keep you posted on exactly that when that will happen. Right, to the agenda, the BCI team again made for a wonderful lineup of some of the top asset managers in SA and some of the global managers that also flew in for this conference. Thank you so much for joining us here. And they will be joined by some of the top DFM or asset consultants in the country to moderate some of these panels. I want to thank to all the presenters, the asset managers, as well as the moderators here this morning. Thank you for your time you took in preparing for these sessions. We know a lot of work goes into that as well. To our live audience, this is a dual medium event, so we are streaming live. But if you have any questions, you're more than welcome. We've got a roaming mic, or you can mail those questions to marketing@bcis.co.za, but you're more than happy to engage. For all the sessions we've allowed for an extra 10 or 15 minutes at the end for the moderators to answer those very tough questions that they've worked on in the last week. I can't say the last month because markets are so fluid. They're changing daily. I think some of those questions were maybe even formulated this morning. And to our presenters, thank you so much for keeping the content that you bring to these sessions very current and very much up to date so that we can get the most current information in dealing with those tough investment conundrums. To our online audience, you know how it works by now. If you have any questions, and please, we encourage you to participate even if you're not here. You can use the Q&A bubble to post questions. It will come through on an iPad here with the moderator, and we'll cover those as best we can. The question we always get, will you get the presentations? Yes, you will get the presentations, and this whole session are being recorded if you want to view it afterwards as well. So from Robert Walton, the BCI and Fundrock team, Tanya, Olga, thank you so much for being here, and thank you for your continued support throughout this journey. We remain very grateful. At last year's conference, one of the fund managers made the comment, if you look at returns over the past 12 months, the risk was being out of risk assets. So that despite a massive volatile March, and I think there was some panicking going on, I think there's a lot of questions on, when will the straits open and how long is this going to persist and what the knock-on effect is on a lot of assets. And we're going to try to deal with a lot of those issues today. But if you look at the past 12 months ending April 2026, investors again were rewarded with fantastic returns from anything from income funds to multi-asset funds, equity and global equity funds. But you have to ask the question from a risk asset perspective, and if you look at where markets are trading at the moment, isn't markets getting detached from reality as to what's happening with the oil crisis or energy crisis, and again, possible disruptions to supply chain globally, and what will that knock-on effect be? Words like inflation or sticky inflation and potential rate hikes are again being uttered by some of the central banks, some of the stuff that we've been hearing for the past 3 years. And again, is it different this time, or is it just more of the same? With that, it's my absolute pleasure to welcome our first panel for the morning. Here to moderate the session is Nadine Fundrock from Advantage. Nadine, thank you very much for coming through. You can come to the front along. She will be joined by Hino Vermaak from Granite Asset Management, Nick de Vos from Centaur Asset Management, and Simon Raubenheimer from Contrarian Asset Management. Ladies and gentlemen, thank you so much for joining us here this morning. Great to have you here. Thank you very much.
Nog eens wakker, kom maar, ik zeg maar eens. Mich berührt. Und jetzt? Morning, everybody. It's a pleasure to welcome you all to the conference and to the first session of what promises to be an engaging and also insightful 2 days. I must say, given the weather, I'm very impressed with the number of people that's attending this morning. My name is Nadine, as Eugene mentioned, from Advantage. Previously, you would have known it was Analytics Consulting. The reason for the rebrand was that we sold one of the companies in the broader group. If there's any questions around the rebranding, our service offering, the people involved, I'll be here for the whole day if you do want to come and chat to me. So we're operating in an environment with increased uncertainty, shifting rate expectations, and inflation dynamics that changes on a daily basis. Portfolio managers are navigating this landscape where traditional correlations are breaking down and as valuations across asset classes are more contested. In this context, asset allocation decisions, risk management, and portfolio construction are very different or might be different. And as the margin for error has narrowed and the dispersion has widened, it's nice to have 3 well-known portfolio managers with us on the stage today. They've all been managing a multi-asset portfolio for a very long time, and we're looking forward to your insights. So it's my pleasure to welcome and introduce to you Hino Vermaak, an investment analyst and portfolio manager at Granite Asset Management, Simon Raubenheimer, Director at Contrarian Investment Management, and Nick de Vos, Director and Portfolio Manager at Centaur Asset Management. As Eugene also mentioned, I want to encourage you to make the most of this session. If you've got any questions, post it online, or we've got a roaming mic, and pose your questions to the fund managers. With that, over to you.
Okay. Thank you very much, Nadine. Thank you very much, everyone here. It is, as Nadine said, quite surprising that there are so many people sitting in this room. We appreciate your focus and your attention today. And I also want to say thank you to BCI, or Fundrock, for inviting us to this event. It's a pleasure, and it's a particular pleasure to talk first and not last, like often happens. Today, I want to leave you with only one thought. And I'm going to spend the rest of my allowed minutes to discuss that thought with you. The thought is that the world is uncertain. The world has always been uncertain, and the world will continue to be uncertain. What matters is not waiting for that uncertainty to leave or for certainty to reappear. It's not going to happen. What matters is what you are going to do with that uncertainty. Our multi-asset funds launched in February of 2020. And since then, I've constructed this slide to show you just 7 events of extreme uncertainty that we've experienced since then. Within weeks of launching our funds, we learned about COVID-19 and the world went into lockdown. The markets crashed. On a global basis, across asset classes, everything was down. As we recovered out of that in 2020, Russia invaded Ukraine and putting the world on the brink of war. In 2024, we had elections in South Africa, a very uncertain outcome and uncertainty as to whether we'll have a coalition government, a government of national unity, or just complete chaos on the streets. For us and our funds with exposure to the semiconductor market in 2025, DeepSeek was released and questioned a lot of our investment themes. In 2025, President Trump had what he called Liberation Day and imposed tariffs on a global basis. That led to another bout of uncertainty. And as we stand here, we are in the midst of a conflict in Iran. Some days the straits are open and some days it's not. Some days we have peace, and other days there's love taps happening left, right, and center across the strait. But what I'm trying to show here is that in each one of these events, we were confronted with the question as to whether this time is different, whether we need to change the way that we do what we do, whether the previous rules and the previous expectations are changing or not. And I want to discuss with you how we go about that. Now, it's important to say that, again, the world is not more uncertain now than it was in 2020. It was always uncertain and it always will be. The sooner we can all accept the fact that uncertainty is the truth and the constant, the sooner we can go back to doing the work that we really need to do. It does not help for us to just sit around and wait for an answer to come from somewhere. We need to construct a process that allows us to handle this uncertainty that we see on a regular basis. But it's human to worry. What we have here is a picture of a person, a skier on the slopes. Pristine conditions. He's got all his equipment, skis, poles, gloves, helmet, goggles, everything that you need. However, he is there in his shorts and a t-shirt. That is your client. He's done all the right things. He's invested his money. He's swapped instant gratification for the belief of something better somewhere down the line. Now, when uncertainty then triggers or occurs in the markets and the markets are down, he starts to worry, and it is like being out on the slopes in a t-shirt and the shorts. And I have to be honest with you, we feel the same. We feel that same emotional reaction to when markets are down. It's no fun seeing the positions that you believe in being whacked in the market and the funds go down. We are investors in our own funds. We feel it. It is not a theoretical exercise for us. But we think that we get paid to manage that worry on your behalf. A portion of the fees that we charge for our fund management goes into managing that worry so that you don't have to. The rest goes into managing or picking investment decisions that will last for the long term. So we think that if you have entrusted us with the money and you are lying awake at night worrying about what's happening there, then it is like that skier on the slope that paid the all expenses, all-in price for the ski holiday but forgot to put on the thermals. Now, we can't force you to put on the thermals, but what we can do is to remind you that they are available and that you have got a pristine slope in front of you to ski down. Now, the question then becomes, how do we manage that uncertainty? And for us, managing uncertainty boils down to the way that we are structured. In essence, what we try to do is to be as rational as possible in times where we are not unemotional. And we've put a team together around one table to approach this question. We have around the same investment committee, teams of equity, fixed income, property, cash. We look at valuations. We've got input from macro views. We look at risk. But all of us together discuss this and we disagree. For us, disagreement is not a problem. For us, disagreement is the process to get to the answer. And what we try to answer is that question in the middle. What has actually happened? Has anything changed in the investment case that we are talking about? These external influences, all this uncertainty that we look at, we try to answer whether something has actually changed, and if then, we act. We look for the opportunities, because if one person is worried in the one corner, another person is scanning the market for the opportunities, and we can discuss that. So we think structuring yourself to be rational is a very important part of managing this uncertainty. And what I have here is the long-term returns of the two multi-asset funds. These funds were born before those 7 events that I discussed on the initial slide. And I'm not showing this in any way to boast. For us, the number makes the argument that the process works despite all the uncertainty that we've had through this period. We'd like to focus on the longest term returns here, since inception, where our balanced fund has exceeded its benchmark of inflation plus 5, and similarly, the flexible fund exceeded its benchmark of inflation plus 6. This is what we do. This is what we want to do. We want to take the uncertainty, process that, look for the opportunities, and then buy when the opportunities arise. Looking at this slide, I want to take you through some tangible examples of what we've done over the last couple of months. Our process is exactly this. We can think of it like a forest where we have trees that we are growing. Our portfolio is a forest of trees. And every now and again, we get the opportunity to harvest some of those trees. That is when the investment case has played out, and positions that we've bought in previous despair increased in value to a point where it no longer makes sense for us to maintain shareholding. And there, one example is our exposure to semi-cap industries. Semi-cap is the semiconductor capital equipment industry. And in the doldrums of 2022, we were able to buy a lot of these. Recently, the excitement that exists around AI has created opportunities for us to exit some of these positions and deploy it into other areas. Similarly, PGMs, European property, and the long bonds reached levels where it no longer made sense to have large allocations to these in our portfolio, and we've harvested some of those. Additionally, we felled one tree. Mr. Price unfortunately got infected with the European M&A borer beetle, and we had a sick tree in our forest that we had to remove. We take asset allocation decisions, capital allocation decisions very seriously, and we struggle to understand the reasoning behind Mr. Price's venture into Europe. With those proceeds and those holes that opened up in the forest, we were able to plant a number of new trees. We've increased our exposure to inflation linkers and UK property. We added to positions like Microsoft, Tencent. These are the flip side of the AI coin. And where there's a lot of excitement around the chip names, there's a lot of questions around some of the software companies and those spending the money and building out the data centers. Additionally, we added names like Advitech, Pepkor, and 3i to our portfolio. And lastly, there are some positions that we watered. TSMC is one example. If we go back to Liberation Day on the 2nd of April last year, we all sat watching the screen looking at President Trump putting up a cardboard poster with names and numbers, arbitrary numbers, we thought. But it led to a lot of uncertainty and a lot of hand-wringing and wondering what's happening in the world. We went back to our table, we thought about it, and we realized that the fact that President Trump puts up a poster does not change the investment thesis of a company like TSMC, and we were able to water that one. So going back to the question, what do you do with uncertainty? That is the question that you'll get from your investors and your clients. You'll get it today, next week, next month, 2027, or whenever the next bout of uncertainty hits the market. And we would suggest that the answer to that is not to sit and wait for certainty to come back, but to actually act and be rational in the way that you go about it. Thank you very much. I look forward to the discussion.
Okay. Good morning, everyone. Thanks to all of you for coming through this morning. Today, my presentation is going to be why I think the investment management industry needs danger pay, driving all the way here on the N2. No kidding. Thanks to BCI for setting this up. Thanks to Nadine for the introduction. I'm going to be talking about a theme today that everyone in the room has been experiencing to some extent over the past decade. The rest of the world, specifically Europe, has also started experiencing this over the past few years, and this is what informs the title. Hulle weet nie wat ons weet nie. So I'm going to be talking about the energy theme, and really the energy situation has a trilemma. So you've got cost, carbon, and reliability. So cost, the debate we've all been used to locally is IPPs, renewable energy, and the significant cost, particularly many years ago that they took to come to ground, versus carbon or coal-powered power stations, and how that cost has kind of merged over time. Renewables now are arguably a lot cheaper than coal. Then carbon. So if you're like the guy here on the roof, you've installed solar panels at home, whether you've intended to do so or not, you've solved your own carbon situation at home. And then, most importantly is reliability. And this is really the key about it. So, the wind blows when the wind blows. The sun shines not today, but at night it doesn't shine. And that makes renewables unreliable. And Europe has been figuring this out over the past few years. 2025, you had grid failures. Portugal, Spain, too much renewables on the grid, not enough base load, and essentially grid instability. So if I pose this question to you all, what if the sun doesn't shine? You should all be thinking or know what the answer to that is while you install batteries. So if you look at this chart, the blue bar, all the way on the left, 2015, 60% of all new power being installed on the global grid came from renewables. 2020, 80%, and more recently, 90% of all new capacity coming onto grids is from renewable power. The issue, like I've mentioned, is that renewable power is intermittent. Think of looking at your, if you've got the app and your inverter at home and the sun charging up your batteries. Usually about halfway through the day, batteries are fully charged up, and then you lose that power, or essentially that the rest of the batteries get wasted. If you're like me with the City of Cape Town that hasn't installed your new meter for the past year, you are unable to sell that back to the grid, and that's an issue. So the solution to all of this is battery energy storage systems. So that's battery packs and systems that manage when and how that power is distributed back into the grid. And the good news in all of this is that batteries are finally affordable and they're a lot more reliable. And I'll show you now what's been happening with the affordability of batteries. So here's quite an interesting story that's applicable to today, and it forms part of this theme. So all the way on the left-hand side, 1973, that's a Dodge Charger. It's an American muscle car. And at that time, you had an OPEC oil embargo. It was around the Yom Kippur War, and gas prices in the US essentially quadrupled. The US wasn't energy independent like they are today. People stood lines at the gas stations. There were fuel shortages. Fast forward a few years later, 1979, you had a further energy crisis, the Iran Revolution, and these two situations combined with a few other things essentially destroyed the US muscle car as we know it today. But back then you also had a little company in Japan. They started producing vehicles a lot lower on fuel usage. That company was called Toyota, and they quickly gained a third of the US market share by exporting their cars to the US. Fast forward more to recent times, so 2022, we had the Russian invasion of Ukraine. Europe, gas prices, energy prices went through the roof, and the Europeans pushed harder than what they had done in the past towards renewables. It was, part of their policy in reducing carbon, but it was also about sovereignty. And that's all I've got the image there, the further rise of the EV. You've got a Tesla vehicle there. And then in 2026, we've had the Strait of Hormuz and the Iran energy crisis currently unfolding. What we've seen so far is in March, EV sales in Europe are 50%. April data is also pointing to EV sales up 50%. There have been some subsidies, but I wouldn't be surprised if we see more subsidies globally coming out for EV vehicles. The technology here is changing very quickly. I'll give you now an example in a further slide of how this has changed. So this now goes through to one of the positions that we have in our funds. It's a pick and a shovel play. The company is called Contemporary Amperex Technology. Now, big disclaimer slides here when everyone does a stock pitch. Remember, this is within the portfolio. I'm not saying go out and go and buy a big slug of this in your personal capacity. See this in a portfolio context. What this chart's showing is the battery capacity of CATL. So that's CATL is the short name for this. 2015, 2.5 gigawatt hours production capacity. Fast forward to today, 750 gigawatt hours of production capacity. So a significant increase. To put that into context, this is one company that can produce enough batteries per annum to power Cape Town for 23 days. Now, more interesting, if you look at the color change in the bar over time, so the gray, that's EVs, and that's been growing for some time. And that really talks about the 1970s story that I've just explained to you. And then the gold side is the energy storage system, or ESS. And part of why that's also really taking off at the moment is the whole AI theme. You've got the hyperscalers spending $700 billion this year. A lot of that's going into AI infrastructure or data centers, so very intensive energy users, and that's adding to the supply constraints. So it's both a supply and a demand story. So CATL is the largest battery producer in the world. They're based in China. They've got around about 50% global market share. They are way ahead of nearest competitors. BYD's in second place there. CATL is also by far the most profitable of all these businesses. And we think CATL continues to get stronger. So essentially, they've got the lowest unit cost of all the producers. That leads to further contract wins. The further contract wins, you reinvest back into business. That adds to further expansion. And the bigger you get, the more scale and the more efficient you become. So Jevons paradox helps to illustrate the story a bit better as well. So if you look on that chart on the left, you've got the gold line, $310 per kilowatt hour is what it used to cost to produce a battery. Today, that number is closer to $120, so a significant decrease. But for further context, battery prices are down 75% since 2016, and they continue to decline. And what this is illustrating to you, by 2035, battery prices are expected to halve again. So cost deflation continues to reinforce demand for batteries. The gray area that you have there is our kind of expectation of what battery demand will do. We think battery demand will 4x from now up until 2030, and this is really Jevons paradox. So it came from the 19th century when you had steam engines, which became a lot more efficient. He was an economist, and people thought that with steam engines becoming more efficient, coal usage would actually drop. He made the argument that it would increase, and that's exactly what happened. Things became more efficient, and usage skyrocketed. So, the question here is not about growth or the direction of the growth. The question here is the pace of that growth. So, we've bought cattle. We think the business can maintain the current rating and grow at 20% for a number of years going forward. Just asset allocation changes that we've made since the start of the year. This is just to illustrate, I think, what we've done since the war's broken out. So this is December up until March. We've made a few more changes post this. But the main point I want to illustrate is that we've been at the onset, we raised some cash, and then into strength, we've been raising further cash. Our starting point was overweight equity content, our benchmarks, and we've clawed that back to be basically in line with the equity content of our benchmarks. We think it's prudent to have dry powder. So this slide here illustrates to you, this is now the flexible fund. So you've got the strategic asset allocation. That's the flexible funds benchmark. So if you ever want to get an idea of our views on various asset classes, fixed income within the flexible fund is 20%. We are at 20% at the moment, so not taking any material views there. A big portion is the cash that we've raised. We've sent some currency overseas as well, so it looks a bit different to what it does here now. And then on the equity side, 80% is the benchmark, our strategic asset allocation. We're there at the moment as well. We've clawed back or brought back SA Inc. Equity exposure. We think that the SA Inc. story is stalled for the next 6-12 months. And then we've actually been, as I said, taking rands offshore and selectively buying offshore names, cattle being one of them. So our view, just general market outlook. So a lot of uncertainty. Henno spoke a bit about it. Equity markets are at all-time highs. We think there is some risk. Elevated energy prices and how long that lasts is very important, and that will determine inflation going forward and what central banks' policy responses are to that. SA Inc. rally, we think, is on pause until we see another rate cutting cycle. Our strategy, so, is not to focus on the macro. It's very difficult monitoring what's going on on a daily basis. Things are continuously changing. We focus on stock picks, maintaining valuation disciplines, sticking to principles, and then we've prudently clawed back equity content so that we've got dry powder if opportunities present themselves. And then here's just a very long-term track record of the flexible fund. So 26-year track record of the fund, various market cycles. And that's my story. Thank you. Yep.
Thanks, Nick, and thank you very much to BCI for the opportunity to present to all our clients. It's always great being back in South Africa. I feel right at home with this weather, so yeah. So I've only got 12 minutes. I'm going to run through this pretty quickly. So most of you would know us for our global funds. You'll see there on the left the Section 65 approved offshore, so the Global Equity Fund, the Global Balanced Fund. We also have rand-based feeder funds, BCI rand-based feeder funds that feed into these global funds. And then more recently, we launched domestic funds, 3 domestic funds in South Africa, one an equity fund, one a balanced fund, which is, of course, the subject of today. And then we also have the South Africa-focused equity fund, which only invests into South African equities. This is the performance of the fund. It's a pretty new fund, so we only launched it at the end of September 2024. Since inception, it's up around 19.7% versus the benchmark of 15.1%, but it's a very short time period. Our goal here is to build long-term wealth for our clients, so it's still very, very early days. This is one of the reasons why we launched the fund. The blue line there shows the valuation on a forward multiple, just using Bloomberg consensus numbers on the FTSE JSE All Share Index. The red line shows the forward multiple on the MSCI World Index. This was done a couple of weeks ago, around mid-April, and you can see at the time the World Index was trading on around 17.5, 18 times forward earnings. This is earnings, not cash flows. The price to cash flow multiple, of course, with all this capex being spent, is significantly higher, whereas the JSE is trading at around 10 times earnings. So a massive discount to the rest of the world, which is one of the reasons why we decided to launch a domestic fund in South Africa, just because we saw the opportunities in South Africa were abundant. And as we know, low starting valuations imply higher future returns. Your returns are very much impacted by the price you pay for your investment. So this just shows over a long period of time the forward multiple on the market versus the subsequent returns that you would have received over the next 4 years. And you can see the lower your forward multiple on the x-axis there, the higher your future 4-year returns. Now, this graph, of course, comes with all the disclaimers. There's autocorrelation. Some of those time periods overlap, but it shows the broad principle that your returns are largely determined by the price you pay at inception. So despite the fact that, yes, South Africa has its warts, there are, of course, issues. Valuations are very, very low, both in absolute terms and also, versus its own history, but also versus other markets elsewhere in the world. And the same actually is true for fixed income. So this shows the real yields on 10-year bonds. So these are nominal yields adjusted for inflation. So the nominal yield less the inflation, prevailing inflation rates in all these countries. The blue bars are developed countries. The red bars are emerging markets, and in green there is South Africa. And you can see that South African yields, aside from Brazil, it's really one of the highest yielding markets in the world. This is just looking at the 10-year bond. So again, valuations in local currencies are very, very low. So this is how we've positioned the fund. At the moment, 64% of the fund is invested in South Africa. 36% of the fund is invested offshore. You can see that the bulk of the 36 that's offshore is invested in net equities. The bit that's invested in South Africa is sort of a combination of shares, so 34% in shares, 21% in fixed income. And if we want to add sort of a little bit more color to how we've invested the foreign portion, you can see in gray. Of the 28%, 19% is invested in North America, 7.5% in Europe, 1.2% in Asia ex-Japan. You can see we have some commodities. That's largely gold, not a big portion. That's 2.3% of the fund. And then you can also see sort of from a fixed income perspective, globally, mostly sitting, well, both cash and fixed income sitting in North America. So that's how the fund is currently positioned. I'm maybe going to spend one slide on how we see foreign markets, given that 36% of the fund is invested offshore. We started doing a lot of work on AI probably about 3.5, 4 years ago, and we came to the realization that this was a truly transformative technology that would change, basically profoundly change how knowledge work would be performed, and not just knowledge work. Knowledge work is probably the lowest hanging fruit, but eventually all work. And it would have absolutely profound implications on broader society, on the division of labor between capital and labor, and that we wanted to position the fund back in 2023 already to benefit from this, from this absolutely transformative sort of technology. So our first goal is to pick companies that we think are long-term winners in a world of AI disruption. And I've shown you some examples there. They're not just American companies. There's some Chinese companies in there too. So we've got companies like Baidu and Alibaba in China. Of course, we don't run an AI fund. We run a diversified fund. So the second thing we tried to find was to find companies that are of a high quality and that are less likely to be disrupted by artificial intelligence. Since we've launched Contrarian back in 2009, a lot of these companies that you'd see in the middle block there were very expensive. So those were traditionally called like quality compounders or whatever. And for many years, they traded at very, very high multiples. Those, in many cases, have come right down. So you can find companies that produce very strong sort of consumer staple brands that are incredibly defensive and actually have brands that have been around for decades in many cases on very low double-digit or even single-digit multiples in some cases. So we are seeing and are very excited about the opportunities in companies that may not be the fastest growing companies in the world, but they're companies that will produce a stable stream of cash flows going forward, even in a world where a lot of companies, and in fact, entire industries will be disrupted by artificial intelligence. And then the third block is one that we don't often speak about, but is one that we're doing a lot of work on, and those are companies that may be disrupted by AI. And I guess the challenge there is to avoid the sort of value traps. A lot of these companies have fallen. You've seen software names that have fallen by 50, 60, 70% in some cases, and look very cheap on the face of it, and even have fantastic histories. But they're companies that, in many cases, we think may only be around for a few more years before they get completely taken out by artificial intelligence. So those are the companies that we are trying to avoid in our fund. So when you look at our top 10, hopefully you'll find shares that are in the first two buckets, and none of the shares are in the third bucket. I will mention that one has to be incredibly nimble and adaptive, and you can't sort of stay wedded to preconceived ideas or notions. You have to be able to move very quickly because things change. Things change very, very fast, and it is a challenge to stay on top of things. So our biggest share, if you look through both our domestic and foreign holdings in our BCI balanced fund, is actually British American Tobacco, which we own both in our South African portfolios and also in our foreign portfolios, followed by EchoStar, Tesla, and a little bit lower down, Sun International there in South Africa. So I'll talk a little bit about British American Tobacco and Sun International and just give you our thoughts around that. So I guess the obvious question is why BAT and why now? And the reason in a nutshell is that for the first time in many, many years, BAT may again becoming a growth business. So this graph here looks at world nicotine industry revenue, 2022, 2025, and then this is using BAT's forecast to 2030. The interesting thing is, so the gray line there is combustibles, so those are the traditional cigarettes. Actually, revenue hasn't fallen. It's actually gone up a little bit since 2022, despite people smoking less on a per capita basis, lower consumption, but you have population growth and you have very strong price increases in real terms, which compensates you for the volume loss. So the traditional or legacy business is actually not falling, but you've got these new next generation products that are actually starting to add quite significantly to growth. And we expect that to continue. You can see heated products, vapor, and nicotine pouches, which have really taken off in many countries around the world. This shows you the most developed market in the world, which is America, the most developed tobacco market in the world. And you can see 2023, 2024, 2025, people are consuming, and sorry, this is looking at volumes, not revenue. People certainly are consuming fewer cigarettes. You can see cigarette volumes in gray there have declined somewhat over the past 3 years, but that has been much more than offset by growing smokeless tobacco volumes, in particular, these nicotine pouches that we show an example there on the right. And you can see in America now, 2025, actually 2/3 of the market now is next generation tobacco. And we think the rest of the world will follow suit. These are very profitable products for the incumbents, and we think a company like BAT is very well positioned to benefit from that, given this chart is straight from a BAT presentation, given how strong their products are in this next generation area of tobacco. And finally, Sun International, pretty similar story to BAT. You've also got the legacy casino business, which we show you there in red. And this looks at the total South African gaming market by market segment. So traditional casinos in red, online betting, gaming in blue, and then there are a few other things in gray and green. And you can really see there 2021, the sort of 2020-21, the big knock that the physical casinos took, of course, through COVID, where it was difficult to sort of with lockdowns and things to leave your house. That's recovered, but all the growth, and this unfortunately only goes to 2023, all the growth is in the online market. And the total industry as a whole has grown by around 9% per annum. Since 2023, and I'll focus on the blue block, since 2023, and this is a slide straight from Sun International, you can see how that online market has continued to grow. Now, this is what Sun International management expect. So the blue block, currently 51.5 billion in gross gaming revenue, that should grow to around about 100 billion by 2030. Sun International were late to the party and launched their own online sort of casino and have grown from an insignificant market share to now a 4.5% market share, and they're expecting that to grow to 8%. We think the company is well positioned to benefit from a growing sort of online gaming sector in South Africa. And we think the fact that they have both physical and online casinos, those are highly complementary businesses in terms of customer data, loyalty, MVG, offers that you can make to your clients. So we think they're very well positioned to continue to gain market share in the online sector. And actually, if you took what management have said, every time the company reported, every 6 months, they've actually underpromised and over-delivered. So their forecasts have historically been too conservative. And there's a good chance that sort of continues. So I don't think these numbers are aggressive at all. If I use management's forecast for their numbers in their online gaming division, and I plug that into the current Sun International, sort of our current Sun International's earnings, this looks at earnings segmented by SunBet, which is Sun International's online casino business, and the rest of the businesses. So they're land-based casinos, which include Grand West, include Sun City, include Sibaya in Natal, etc. You can see if I just keep all their businesses, including their finance income, finance costs, everything, if I keep all of that flat, I don't grow it at all over the next 5 years. And I'm assuming what they said, what their forecasts for the online division, I'm assuming that does come to fruition. You'll see that their total business will earn close to 10 Rand a share by 2030. 6 Rand a share, just their online business, and 4 Rand a share for their domestic land-based businesses. The current share price is 45 Rand, so it's on a 4.5 times multiple 5 years out. And actually, you're probably getting their online casinos completely for free if you think their land-based casinos should be trading on a multiple of around 11 times. So we think this is a fantastic opportunity with massive optionality that you're currently not paying for at all in the share price. And it's one of many examples of South African businesses that we think are trading at very, very low multiples and actually are still growing. Despite all the bad news, despite all the issues in South Africa, we are still incredibly excited by many of these opportunities that we are finding in the domestic market. So that's it from me. Thank you.
Simon. If I look at your top 10, you're truly contrarian with Tesla and Sun International. And there's not many investment managers for those top 10.
No.
Yeah. I've got a question from the online forum. How do you feel about the gaming tax that's being discussed? I suppose that's for you.
That's probably for me. Look, I think it's something that we'll have to watch. It certainly will impact the companies. I mean, there are a few things that will impact this business. The gaming tax is one. There's a tobacco bill that will ban sort of all smoking indoors, which will also affect the company. So absolutely, those are challenges. But we think Sun International is very well positioned to deal with all of that, given that it's a regulated business. It's not sort of an unregulated online casino. We see lots of those in South Africa. We think those will be, we hope, the first to go. It's a significant contributor to the fiscus of many of the provinces that it operates in. And we think if it's properly regulated, it's actually great for the incumbent businesses and probably actually strengthens their competitive position vis-a-vis all the other players in the sector. They've had to deal with this for many decades.
Okay. Another question before we go to the floor for questions. Both Granite and Centro have balanced and flexible mandates. How different are the mandates really managed? And what benefit is there in having two mandates that are multi-asset? You go first and then we'll go to Nick.
Yeah, for us, it's true. They look quite similar. The difference between the two is that the balanced fund is a Reg 28 fund. Our flexible fund is not limited to Regulation 28. For us, it's simple. If you are saving for retirement, the balanced fund has got our best ideas. And if you allow us a bit more flexibility and in discretionary money, we would suggest the flexible fund is an option. They are deliberately run together. They are the same team behind it, and obviously the same ideas that go into the portfolios.
Exactly the same answers as Heno just gave. Rule of thumb, the balanced fund typically runs 80% of the equity content that the flexible fund would run. So it's more conservative, Reg 28. And then given the size of the balanced fund relative to the flexible fund, sometimes the balanced fund might buy a smaller or mid-cap stock that the flexible fund might just not have the ability to buy.
From an asset class point of view, is there any other asset classes that you'll put into the balanced fund that's not in the flexible fund, or is it exactly the same?
Exactly the same.
Exactly the same. Okay.
Yep.
Before I go to my questions, any questions from the floor? Okay. I've got a question to all three panelists, and that's to do with benchmarks. So from our point of view and anybody in the audience, it is a very important tool to measure performance. So, Heno, your fund is a CPI benchmark where the two of you have got a strategic asset allocation. So I want to start with you. What do you think is the relevant metric for us to measure yourself on, and how do you assess whether you've added value from a stock selection and an asset allocation point of view?
Yeah, it's a complex question. Maybe I can approach it from a slightly different angle, saying that what we try to do is to take the capital that's entrusted to us and to give more back when it's required somewhere down the line. And if you think of your pension savings, I don't think I'm that bothered what the different asset classes did. What I'm concerned about is whether I've got enough money to retire with. And generally that's linked to inflation. So what we try to do is to increase the buying power of the portfolio over time. We will be measured in many different ways. Different allocators have got different preferences to that. And fortunately, everyone's got a spreadsheet to do that with if they wanted to. But what we try to do ultimately in the long run is to increase the buying power on a per unit basis. We are bottom up, so it's difficult to really attribute stock selection versus equity or asset selection. We look on a global basis. We are limited by a 45% offshore allocation, but we've got a South African CPI mandate. So we are cognizant of foreign currency risk that we try to hedge, but for the rest, best instruments on a global basis can be considered for both the funds.
Simon, Nick, you want to add something to that?
Yeah, sure. I mean, so for us, the question in a sort of a balanced fund on benchmark, because you can pick sort of one of two benchmarks. You can either pick a peer benchmark, which a lot of balanced funds have. So they look at the average peer group. We decided not to do that. We decided to go with a sort of a composite benchmark that you can actually invest in, because it's difficult to invest in the entire peer group. And we think that's what clients pay us for. We think clients pay us to outperform the passive indices that they could potentially access at a very low cost, right? So why pay us a fee if we're underperforming a passive benchmark that you can get for much cheaper? So our value is really in how much we can add over and above a passive benchmark, which is why we've picked the 60-40. So, I mean, I think it's also sort of recognition that I'm not competing with these two guys here. The battle is passive versus active. Active is getting an increasingly share of the flows, and our job is to demonstrate that we can outperform passive indices, and so
Yeah, that's very true. So Nick, maybe on your side, do you think, because I mean the asset allocation, the stock selection requires different skill sets to
Yeah.
add value over time. Which one has added the most in terms of your balance fund?
So definitely the stock selection. So let me explain. I mean, it's similar to what Simon said now. But we find, having that strategic asset allocation or that benchmark just makes it easier. It's a hell of a difficult, if not like impossible, to go and make an asset allocation call, whether you equities, bonds, local, offshore, to go and make that call on an annual basis. It's hell of a difficult. So having that strategic allocation is almost like a guiding light. It's one less thing to worry a lot about. We still think about it, but we don't spend a hell of a lot of time on it once we've set up what that benchmark or strategic asset allocation is. And then it boils down to stock picking. So it's finding businesses that can compound or go up multiple times over years. That's really where the alpha comes from.
Okay, maybe just from the audience point of view, from our side, we measure all managers relevant to a CPI target and a passive SA option, just to see through cycles. Because I mean, Henny, you're smiling, but at certain periods for a long time, you're going to underperform an inflation target. So you need to have something that's a little bit more tangible. Simon, I've got a question for you online. They have a lot of resources. You've got a lot of resources in your top 10. Any views on global demand for resources?
Yeah, I mean, a lot of these resources, they are cyclical businesses, but, many of us at Contrarian have worked in the South African market and are actually very familiar with the resources cycle. They're shares that are almost second nature to us. We know them very well, and throughout the history of Contrarian, we've owned resources companies in and out, and we've got several resources shares. One example is Tech Resources, which is one of our top contributors of all time since we've launched the fund. So I think the resources sector has been good for us. We think in this growing world of AI, I'm exaggerating it, but once robots build robots, what's the ultimate constraint? It will be resources. We're seeing current, you could look at the capex being spent by the hyperscalers, and we think that'll only continue. So we think increasing automation, increasing sort of robotics. You've got a massive global shift happening in the car pool from internal combustion vehicles and into electric vehicles, and all these transitions, the energy transition will, at the end of the day, and this is one problem that AI can't solve, is where do you find the resources to build all this stuff? So we think that is the ultimate constraint. You can solve for energy probably, but things like, copper, things like, iron ore or steel, those things, silicon, so all those things are, we think ultimately, that's where one of the constraints will be. So that's an area, and you're buying these companies at reasonably low multiples, certainly relative to the rest of the other high-flying stocks in the world. So it's an area that we quite like.
So structural tailwind for resources.
They're real assets.
Yeah. Talk about real assets. I remember the discussions back in 2022 when offshore was increased to 45%. As we saw managers, a lot of them said, now we've got the opportunity to expand our exposure to alternative assets because the universe or the allocation is bigger and the universe is so much bigger offshore. Since then, we haven't seen active allocations to alternative assets, let's call it that. It's a broad definition, but commodities, private markets, infrastructure. Why haven't we seen, maybe Nick, let's start with you, a pickup in allocating to alternative assets in funds?
It's probably because it's, outside circles of competence. To go and allocate money to, private equity or something that we're not familiar with or, that isn't our bread and butter, we won't go and do that. So we kind of stick to what we know. I don't know what the other guys, think of it, but I think there's enough opportunity set within the number of businesses that are overseas that you don't have to go and look for another way to do it.
Simon, your perspective from global managers. Is global managers accessing alternative assets?
I mean, so my personal view, private equity is in a massive bubble. I think those chickens are going to come home to roost at some point. So that's an asset class that I would not touch with a barge pole. And then sort of a lot of the other kind of infrastructure assets give you bond-like returns. They're not particularly attractive. I mean, we can pick from thousands of shares. So, why venture into all these things that,
Sure.
we're finding a lot of opportunities in just plain vanilla, ordinary listed companies.
And it's more complex and-
mainstream. Why complicate things? Exactly.
Okay. We're running out of time, so I'm going to have one more question for you, Heno. What is your portfolio not positioned for? So what's the downside risk? If what happens, then your fund will not do well.
Well, I mean, it's difficult to make a prediction like that. In the short run, literally anything can happen. So I can imagine a million scenarios where there will be a drawdown in the fund. But I think in the long run, the way we approach the companies that we include in the portfolios and the instruments we include in the portfolio are the type of companies that will ride it out, ride the difficulty out, and we think will emerge stronger. There's literally a million ways in which the fund can be down in the short term.
No, I understand that, but it's more, you're not positioned for a risk-off scenario that we're going to, in this protect.
We don't have exposure to gold. That would be one example. I would question whether gold is risk on or risk off these days. I'm uncertain about that.
Yeah. Thank you. That's all. We can have another hour-long discussion, but we've run out of time. So thank you for that. And over to you, Eugene.
Thanks, Nadine.
Thank you.
Thank you.
Thank you, Heno, Nadine, Simon, Nick. Thank you very much for setting a scene for this conference. And I think the point that Heno made as well, what will you do with that uncertainty? Because there's always uncertainty, as we know. Right, our next panel that we've got is on fixed income. To moderate the session, we've got Rafik Taylor from Sanlam Multi-Managers International, or SMI, well known to all of us. Rafik, thank you very much for coming through. And then we've got Philip Bradford from Portfolio Metrics, JP du Plessis from Methodical, Nolan Wapenaar from Anchor Capital. You've all met these gents. Fixed income, lately, it's still exciting because, with yields that went up. But when I look at fixed income, I think about clients with too much money in the bank. And I'm not talking about working capital, but it's exactly that. Clients are scared and they're sitting with cash in bank. And if you look at what income funds are offering clients, I think we need to rethink targeting those clients or visiting those clients and say, you're missing optionality. But we've got a superb panel here this morning to look at exactly that, gentlemen. Thank you so much for being here.
Good morning, everyone. Ending 2025, I think we were all filled with lots of positivity, low inflation environment, and certainly sort of seeing interest rates being low on average. And I guess while we were closer to the bottom of this inflation cycle and seeing the lower end of interest rates, the market was certainly expecting further cuts in interest rates. And I think that really got rudely interrupted by the one and only Donald Trump. And I guess if you look at it now, from seeing a pretty sort of muted inflation environment, we've definitely seen a surge in commodities and certainly oil. And that's obviously going to impact us in terms of pricing in the future, in the short term. And so I think where we are at this moment in time, and hopefully our panel has some answers for us, is certainly one where we were definitely more upbeat about the prospects for returns, both on the equity side as well as the fixed income side. And now we're facing a world where that is likely to be stifled. And I guess what we will see is the prospects of, instead of seeing rate cuts, the prospects are that we're likely to see interest rates rising from here on out. So today, our panelists will tackle this theme in the context of SA income and whether the party is indeed over. As you know, my name is Rafik Taylor. I head up the Implemented Consulting Division of Sanlam Multi-Manager and Glacier Invest. Today, our panel is Philip Bradford, the CIO of PMX, or Portfolio Metrics. We've got Nolan Wapenaar, who's Head of Fixed Income at Anchor Capital, and JP du Plessis, who's a PM portfolio manager on the fixed income funds at Methodical Investment Management. They will present their thesis, and then we'll have a debate to round things up. So from my side, thank you very much, and over to you.
Very good there. Great. So, and thanks, Rafiq, and thanks for the intro. I gave the topic for my presentation earlier on in the year, and it was like, is it too late to buy SA fixed income? But actually, the world changed. And I've learned over time to get worried when markets are, and everyone's positive. You know, Rafiq said at the start of the year, the outlook for fixed income was good. I actually thought it was getting worse because everything was just getting more expensive. Interest rates were lower, and that's the toughest time. And the lessons we've learned, I think, as investment managers is never let a good crisis go to waste. We all know what's happened over the last couple of weeks, really. I mean, since February, March and now into April, we've obviously know what's been happening around the world, and it's caused a huge amount of panic. We know all of a sudden about a place called the Strait of Hormuz and what's happening and how that's causing challenges for oil all around the world. Meanwhile, this is what's happening in South Africa, by the way. I took this picture yesterday morning in Joburg. But it really summarizes for me what is actually happening. We're not so worried about South Africa. Things have got a bit worse for South Africa during the Iran crisis at the moment, but it's still, we're still going along okay. It's small fry compared to what's happening everywhere else. For those of you who know me, I like analogies, and I've always used, one of the analogies I've always liked is when you are building an investment portfolio, you've got to get to a destination. You're sailing across an ocean. You are going to come into storms. The most important thing is, is your vessel engineered to survive the storm? You can't steer away from the storm. You've actually got to sail into the storm, and that is actually where the opportunities come. And that's really what I want you to get out of the presentation today. So what have we learned from the past? This is the recent oil spike. But we've got lessons from this. We've been through a number of crises, even over the last 10 plus years that I've been managing this specific portfolio. We've been through a lot of crises, and 2022 was a great example. Remember what was happening at the start of 2022. No one thought interest rates were going to go up, and particularly the Fed. Remember, inflation was transitory. We were coming off the back of COVID. The Americans had lots of money; they hadn't been able to spend. And what happened was, the oil price started at $80 a barrel. It went all the way out to $135 a barrel. And then and bear in mind, the Ukraine crisis is not over. That's still going on, believe it or not, that war. And oil went back to $80 again. And this is the kind of thing that we need to understand, that these crises can't last forever. The question is, how long will they last? And the Iran crisis that we are dealing with right now isn't, for us, for me in particular as an investor, I'm not as much worried about inflation, I'm worried about growth, because the longer it stays higher, the more it can lead us to a global recession. So what happened a year ago? This is actually what I was showing to you at this conference a year ago. And I like to show these bull-bear scenarios. We build the portfolio saying, okay, what is our worst case scenario? What is a very bad scenario? And then if those are still okay, then we know we can move forward from there. And a year ago, we thought, geez, a really, really bad scenario would be about 6.5%. And wow, a great scenario would be something like 17%. Actually, what happened, if we apply our Back to the Future, we dealt with Trump's tariffs. We dealt with Venezuela, Greenland, and now the Iran oil crisis. And actually, despite those, the bull type scenarios actually played out. In fact, even slightly better. To the end of April, crazily enough, returns on our portfolio on the Dynamic Income Fund are up 19% to the end of April, which is so interesting to understand, because the trick as investors is to take advantage of those crises. We invested a lot during Liberation Day, during Trump's tariffs last year, and now during this Iran crisis, we've invested a lot of capital. Over 2 billion rands worth of capital have gone to take advantage of yields that have actually gone higher during this period. So we've been through Trump's and tariffs and crisis, etc. But if we look at our longer term track record as well, We've actually been through a lot more than that. We've been through Nenegate, state capture, the grid was about to shut down, et cetera, et cetera. All of those crises are things that as investors, and bear in mind we're dealing with fixed income here. These are lower risk investments. These are fixed cash flow investments. This isn't equity. So it's really about taking advantage of those sort of challenges. And then we've seen over time how this plays out. This is our longer-term track record across the couple of the funds we've run, and really over time you can see that actually, crazily enough, the portfolio has outperformed equities. It's outperformed the peers by sort of 75% over that time. But importantly, those little dips that you see from time to time, if you look back at some point here down into Nenegate, to COVID, to the Ukraine crisis, and then even the current crisis, isn't that important in the long run. But it doesn't feel like that when it happens. So what actually happens? When we have an event like we've had now, we tend to have a sell-off. This is just illustrative of what actually happened, but it's pretty much what's been playing out. And at that point of peak uncertainty, the temptation for us sitting on investment committees, for yourselves sitting in front of clients or running your own portfolios, the temptation is to say, hang on, there's a lot of uncertainty now. We need to take action. We need to do something. We need to probably sell. And that's typically when the recovery actually starts. And only after the recovery does clarity actually come. And here's an example. I'm showing an equity slide, guys. Can you believe it? This is global equities. They fell 8% after during the start of this recent crisis. They then recovered 10%, and we don't have clarity yet. So as an investor, we've got to be aware of that the path going forward is always going to be uncertain, and we need to take advantage of that. Here's our actual portfolio, and the All Bond Index in red, and our portfolio in blue, and there was a big drawdown. But after a strong run-up at the start of the year, there was a drawdown, and you can see it's largely kind of recovered already. We're still up about 2% year to date now. So when those opportunities happen, when the sell-off happens, we need to take advantage of that. And we've engineered the portfolio to take the knocks and still come through the other side for investors. And we've seen it over time that this is investing during crises. This is our portfolio in blue, the All Bond Index in red, and then the multi-asset income peers in gray. And during each one of these major crises, you can see that it's actually been fine if you invest in the middle of Nenegate, Trump 1.0, COVID, Ukraine, et cetera, et cetera. And this is where we were 12 years ago at Liberation Day. And it was actually, if you'd run away during Liberation Day, remember we were going to have tariffs, the world was going to collapse, we're going to have inflation, and actually it would have been a disaster if you'd actually reduced your risk at that stage. And we've seen it over time. This is my slide. I get threatened a lot by Tanya and team if I have too many slides. So what I've done is I've squeezed 45 slides into one slide here. I call this my robot slide. What you've got on the left is, and it's ranked from most important to least important, are factors that are affecting SA bonds. Global interest rates, SA interest rates, US dollar exchange rate, oil price, etc. Importantly, though, what is on the current status are the things on the left, and the direction are the things on the right. And direction can be more important. When things were looking super positive, and this was in February, it was green at the start of it was mostly green to the top and to the right at the start of the year. And this is actually what it kind of looks like now. Importantly, you'll see just from the change of colors, you'll see a lot more red and orange. And importantly, on the right-hand side, the direction of change is actually where we've seen the biggest change over time, over here. So things have gone from, some things from very good to bad or uncertain, and that as an investor is when you get the most worried. When things go from red to green, that's actually when you tend to make more money. But the good news is that yields have got a bit cheaper for us. I'm going to flick over these very quickly, but the bottom line is, and Rafiq will touch on it in the questions later, our terms of trade in South Africa is exports over imports. What's happened was last year, it actually had nothing to do with bond inflows and positivity on South Africa, really. The bottom line is gold and platinum are high. Thermal coal was relatively low, but getting a little bit better, and the oil price was relatively low. What's happened now is those are still quite high. Gold, platinum, thermal coal's helping us. Oil prices spiked up, but our terms of trade are still pretty positive. So that explains pretty much all the movements on the rand. This slide here is showing you that if our terms of trade get worse, in other words, if gold and platinum drop and the oil price continues up, the rand's going to weaken. It's pretty simple like that. And those are the things that we're watching pretty closely. These are oil scenarios, and I'll move through them pretty quickly just in the interest of time. But really, regardless of the outcome that happens here, if the oil price stays too high for too long, it's still likely to see some sort of a reversion back to the mean over time. Oil probably won't be getting back to 60, but it should be going back down to 80 odd into the future. The question is, how long will that continue? How will that impact inflation? What you'll see is inflation goes up, but if oil prices are the same next year as they are now, that's a zero inflation over that period. So inflation eventually starts coming off the cliff, and we might see some rate hikes. If the US is forced to raise interest rates, we are probably going to have to as well. But actually, as a bond investor, I would welcome that, because as a bond, we want the Reserve Bank to stamp their authority on that 3% inflation target, and they probably will do that. And I would actually expect bonds to rally if we have a small rate hike, similar with the rand as well. So what actually happened a couple of months ago was this. The markets were factoring in you can look at the yellow and the green lines. Those are the 3 and the 7-year rates. They were factoring in rate cuts below the black line. All of a sudden, they were factoring in 3, 4, 5 rate hikes. And that's, for us as investors, is a great scenario, because we didn't think that rates hikes are going to come through that much. If you look here, these are just one of the economists' sort of forecasts, but it's pretty much consensus now that we might see a rate hike, or it will stay flat where it is. But the market is still pricing in five rate hikes at one point. So as an investor, we said, thank you very much. We're going to lock in rates at higher levels because we don't think rates are going to get anywhere near there. And then even if rates do go there, you're still fine as an investor. So our current yield at the moment is back to around just under 10%, which is the kind of yield you would have had to go and buy the All Bond Index around Liberation Day. So back to the bull-bear scenarios. Yield of around 9.9 at the moment. That's the gross yield of the portfolio. If things go absolutely pear-shaped from here, oil price goes over 200, you're probably doing around 6% over 12 months. If things go well, you're probably around the mid-teens sort of area. Importantly for us as an investor, though, the one risk that people don't talk about enough is reinvestment risk. And if interest rates do go up by 200 basis points, and we have a 200 basis point sell-off in yields on bonds, we are then able to reinvest all the interest payments we get, all the coupons that come out, we reinvest at higher levels. So for us as fixed income investors, the outlook actually improves when you have a crisis like this, simply because we can reinvest our coupons at higher interest levels, and investors are actually better off in that scenario. So I'll leave it there, but over a 3-year period, we're hoping to bore you to death somewhere between 9 to 10%, regardless of whether it's a very good or a very bad scenario.
Okay, thank you. Sorry, I wasn't sure if I was being introduced again, but my name, for those of you who haven't met me, is Nolan Wapner. I'm head of fixed income at Anchor Capital. And firstly, let me say thank you very much to Tanya and team for inviting me. I was saying earlier, it's actually been a decade since I've spoken at this particular conference, so really appreciate getting asked back 10 years later. And then, just a health warning, as Philip alluded to, and actually there's a remarkable amount in common with Philip, I've noticed, just listening to what he said. A lot of what he said, we're actually going to echo, give a similar sort of view. And unbelievably, actually, Anchor's also bought just over 2 billion of bonds into our portfolios through the crisis. And the perspective we've got is that, calm seas don't make a good captain. And it means you've got to go through, a bit of a tumultuous period over time to learn experience, to get a sense of how to manage portfolios. And this isn't our first crisis. This isn't even our third or fourth crisis. So from that perspective, we've got a very good handle on how to react, how to manage a portfolio. But the challenge was that Tanya and team asked us to submit slides 2 weeks before today. So it made for a very interesting thing, because a lot can happen in 2 weeks. In fact, Donald Trump can release 431 Truth Social posts, which keeps you on edge. The other point I'd make is that Moody's can come out with a sort of rating and a review of South Africa. And it's almost as if they read a lot of what we're going to say and have kind of said the same thing. So from that perspective, the message I'm going to give you today is that South Africa was on a good track. The trend was positive. We've had this external shock, but looking through that, the shock will come, it will wear off for one of a variety of reasons. You're going to get into a position where the longer term trends in South Africa continue to be positive. So remain invested, stay invested for the long term trend, accept that there is going to be a bit of volatility, and that is going to throw up an opportunity for you. So that's essentially the message I'm giving. And starting with Anchor's Rand graph, which I think is familiar to a lot of people these days, you've got the jagged line, and I'm tight on time, so I'm going to fly through my slides here, but we've got the jagged line which shows you the behavior of the Rand dollar over time. And the point that Phil made, the point that I'm making, is the Rand today is at 1640. A week before February the 27th, so February the 20th effectively, the Rand dollar was at 16. Today it's at 1640. That's a 2.5% move. You've got one of what the Independent Energy Agency is calling the greatest shock to oil production, to energy the globe's seen. And the Rand's moved by 2.5%. Very, very small move. And that's all got to do with the terms of trade, and I'll show you that in a second. But it's also got to do with the fact that South Africa was actually in a pretty good space when this took place. And that speaks to how we're going to weather the storm, and why, as you look through it, this becomes more and more of a buying opportunity. So speaking about the terms of trade, and as Phil mentioned, gold was up 45% over a year. Gold price right now is about 4,700, give or take. Platinum price up over 100% over the last 12 months. Platinum price today, 2,100. Those actually become very important numbers, because absolutely, think of South Africa Inc. as a country. What do? We export gold and platinum, we import oil. For a long period, the oil price stayed down. We're making super profits on exports. And if you go and look at the national reserves, the amount of dollars that our government has on deposit around the world, it was at record high levels. Gold, they keep gold and dollars. From that perspective, that says to you that our nation was accumulating wealth. It was actually doing everything you'd want to see. And even if we look at it post the oil shock, the actual amount of dollars that we've spent is negligible. So from that perspective, it's saying to me, we had this situation where we were making super profits. It's now kind of balanced out, but that still puts us in a reasonably good position. And that's one of the key reasons that South Africa still looks attractive to us. So we've spoken about terms of trade. Phil had that slide up as well. But let's talk about what else that means to our government, what else that means to our nation. And the point I want to make here is I've taken a slide, and this was actually a cut and paste, effectively, from National Treasury's budget in February. We then gave it to marketing, who took the national budget and reworked it all to be Anchor's colors. But that's what happened there. And the point I'd make is, in that green box, what you've got is National Treasury's assumptions as to what the dollar or what gold price is going to do and what platinum is going to do. Gold, they've got it 4,500. I've just said it's 4,700. Actually, we're running ahead of Treasury expectations right now. That 3 Rand petrol subsidy, where's it coming from? It's coming from those super profits. What about platinum? Well, Treasury was expecting 2.2. They're actually getting 2.1 at the moment. Again, that's not too meaningful a difference. The other point I'd make is things were actually a lot higher before February the 27th, before the Iran war started. So from that perspective, our average profit the Treasury is going to be looking to tax is probably a lot higher than today's spot prices. And even if today's spot prices persist, fiscally, our tax collection should continue to be quite strong. So from that perspective, we actually think that South Africa remains in a good position, notwithstanding this external shock. And what we've got here is a chart showing you the government's balance. So I look at the top line, and everyone's an equity person. So it's kind of the government's EBITDA, if you want. It's basically earnings before interest expense. And that's the primary fiscal balance. So that you take tax revenue minus what the government spends on salaries, wages, and roads, and everything else it spends, and that gives you that brown line. What you can see is that brown line was below zero, so the government was running a primary deficit for decades, in fact. And then since the end of COVID, since 22, we've actually seen for the first time the government move back into a primary surplus. Now that's kind of important because it means that the government is starting to pay back its debts, paying off its debt. And we're actually seeing debt levels come down. I remember for the last decade, every time there was a budget speech, they'd project debt levels come down in 2 years' time, and 2 years never arrived. Next year, it would be 2 years' time still. For the first time, we're actually getting to a point where you're getting to that tipping point where debt levels, debt as a percentage of GDP should come down. And in fact, Moody's picked up on that as well. And, you know, it's starting to sound like people are believing us for the first time. So from that perspective, we think we tick the fiscal box as well. Monetary policy, interest rate hikes. Are we getting an interest rate hike? Yes, I think we are. So what we have got here is effectively the real repo rate. So essentially, we've got the Reserve Bank's interest rate minus inflation. And the point is, if you look at the real rate, and I can only point to this side, unfortunately, it barely comes out, you can see the real rate's a lot higher than it's been for a long time. And Anchor at the beginning of this year was absolutely drumming the table, saying we need to cut interest rates, we need another 2 or 3 interest rate cuts. What about growth? In retrospect, thank goodness we didn't. We've gone into this crisis with a massive cushion. And that's that our real rates are the highest they've been in the last decade and a half. That's given us flexibility. So we're talking about inflation going up. We're talking about inflation, you know, our economist, depending on what day of the week I speak to her, is modeling inflation will be somewhere between 4 and 5%. And it comes down to what assumptions she wants to put into the model, or maybe, you know, how grumpy she is or whatever. But the point is, inflation is going to push above 4%. The Reserve Bank is going to be concerned about that. Realistically, I think they are going to have no choice but to hike. But the point is, if we look at the policy hikes, let's stick with this graph, what you had after 2002 was a massive chasing of inflation. Massive hiking cycle that had to take place because this transitory inflation never actually transited. It just kind of parked there and stayed. And that forced the Reserve Bank into a massive hiking cycle. This time around, we're actually entering a situation where you're actually kind of already towards the top end of a hiking cycle. Yes, we probably will need a bit more, but it's not going to be as drastic. And that means that, you know, when the market starts pricing in 4 or 5 interest rate hikes, guys, it's a buying opportunity. And we fully think that this presents a very attractive investment going forwards. So, holy moly, sorry, Tohonga. Finally, we need to talk economic growth. And admittedly, the oil price shock is going to dampen growth. A lot of people are going to find this sort of sucks money out of their wallets. If you've got to fill up your car because you have to get to work, it means you can't go and spend money at the casinos we were seeing earlier or at PEP or something like that. Our models at this stage are not saying the shock is enough that it's going to be catastrophic, but yes, it's going to be a bit of a handbrake on growth for a while. But the point I want to make is that our growth leading indicators continue to point upwards. So what we've got is the blue line here, which is the leading indicator from the SA Reserve Bank. And they basically sort of have an econometric model where they might pull together all the major sort of data points in the country. They kind of figure out what that means for likely direction of growth. And that continues to trend upwards. And it trends upwards for a variety of reasons. Interest rates had been coming down, gold prices are higher, etc. But one of the very important reasons that it is trending upwards is that we are starting to see people investing in our economy again. They're investing in our country. And this will feed growth for a while yet. And we're talking about that blue line there, which is basically corporate loans, coupled with a gold line, which is capital formation. So in other words, it's investments into new assets that are going to produce new things. Those are pointing upwards. As those trend higher, we fully expect that South Africa's growth rates will go up. And again, you know, I've sat here for the last decade and seen the Minister of Finance go, nah, 2 years' time, growth's going to be at 2%, and we all laugh him off because we know it's rubbish. Actually, we're starting to see it in the numbers. Again, the fundamentals for bonds, the fundamentals for South Africa are quite strong. It's just that external shock that's come through. Now, the point I'd make for fixed income is that what we've got here is the foreign ownership of equities. And you can see foreigners have actually been piling into South African equities, chase the gold. However, when you look at bonds, there's still a massive, massive sort of opportunity for foreign investors. South African bonds have some of the highest real yields. One of my peers had that up on the charts earlier. The fundamentals continue to track in the right direction. Our office in London continues to talk to people who are interested in South African bonds. These are discussions that weren't happening. This pulls together to say that the buying opportunity is coming, and we want to get ahead of those people. Hence, we've bought 2 billion of bonds into this crisis. And with that, I see that my time has run out. So I'm going to hand over. Thank you very much. We'll take questions in a few minutes.
Good morning, everybody. Thank you again to BCI for the invite. Unfortunately, my presentation has no super yachts or big pleasure boats on it. So there's just a warning there. It may say something about the fees that we charge versus my peers here, but anyway. I was having a conversation with a friend of mine the other day who's an equity investor, and he said, I just don't understand what's going on in these markets. He was talking about the Mag 7 and valuations and kind of understand what's going on in equity markets. And I said, rather flippantly, I said, well, I'm lucky. I'm a fixed income manager. Valuations always matter. And I think that is partly true, or largely true. Normally at these things, I like to take a big step back and talk about kind of big trends and things that are happening, and not bore the audience to tears with charts on valuations. But unfortunately for you, given what's going on in the world, I think it's time for a few charts on valuations. A lot of my charts look a lot like Nolan, my colleagues' charts, but where they are the same, I'll skip over them a little bit. So the focus is just briefly on the macro backdrop. As Nolan said, we had to give these slides a few weeks ago, so somewhat trepidation sending it through, not knowing what would happen in the following 2 weeks. Fortunately, we're not too far off where we were 2 weeks ago. Then some views on what's happening in fixed income. As I said, we're focused on cash flows. Bonds need to be repaid. We're focused on kind of real stuff, not blue sky thinking like some of our equity colleagues, and then just where the portfolios are positioned. So yes, as I said earlier, we went into this crisis before the war with relatively high repo rates. The Reserve Bank is quite keen to embed that 3% inflation target. Those of you who had seen me present before, I did have some reservations about whether that 3% was achievable in the face of kind of external shocks, and that we are, as a small open economy, subject to external shocks, and we've kind of now in the process of experiencing that. But generally, I think people were thinking that we were heading towards lower interest rates, given that we had inflation down at 3% and repo rates substantially higher. But what we have seen is that situation change. We've seen this chart a few times. This is the oil price in rands, which is even more dramatic. And I'm sure anybody who's filled up their car knows that oil prices have gone up. And that's obviously inflationary. And it feeds through in many ways. It feeds through in first round, it feeds through in second round, inflationary effects. And we'll have to see how that pans out and how long oil stays at these levels. This chart just shows you, the red line is the 2-year inflation expectations. And you can see that we've been through periods where inflation expectations were substantially higher, but then we went through a long period of time where inflation was expected to be slowly reduced. And we got down almost to that 3%, that bottom blue line is the 3% target. We got close to that in terms of 2-year inflation expectations, but now we're starting to see that tick up. This chart's now, this red line's now above 4 as we've seen the shock of oil prices and some weakness in the rand. So what does that mean for rate expectations, as I said, we went into this crisis with the market broadly expecting interest rates to get cut and the repo rate to be reduced. Where we're sitting right now is that interest rate hikes are being priced into the market. Not really surprising given how inflation has turned round. Now, interestingly, some commentators refer to Iran as a petrol station with a country attached. I think in some ways South Africa is kind of a mine with a country attached. A lot of what we do and a lot of what drives our economy is driven by our commodity exports and our terms of trade, which has been talked about before. But you can see we went through periods when our terms of trade has improved, when we saw those commodity price increases, and everything seemed to be going right for SA. But equally, in the past, when we've seen the terms of trade go against us, everything seemed to be going wrong for SA. And the terms of trade does largely drive our economy. Our fiscal picture looks better, the rand looks better. All of those things improve when our terms of trade improve, and to a large degree, that's out of our control. We don't control oil prices. We don't really control the price of gold and platinum, etc. So what we do need to do as investors and fixed income investors in this market is just keep an eye on what's happening with those and what that likely means for the future of interest rates. This is just showing you the credit spreads for emerging markets in the blue and South Africa in the grey. What you've got there in the dotted line is the kind of long-term average of South African CDS prices, the 5-year CDS. So what you need to pay to insure against South Africa defaulting. And what you can see is that we've been trading quite a lot for quite a while below the long-term historical trend. And that was again driven by solid fiscal receipts, rand performing well, and general kind of risk on environments in global economies. What we've seen since the crisis is actually not, this is a monthly data, so what you don't see is the blip in March, month-end data, should I say. You don't see the blip in March, but broadly speaking, we're still tight of where we were, where we've been historically. So it's not like the market's pricing in huge risk around SA. We're actually trading closer to our long-term averages. Apologies, this is a busy slide, and I will explain it. Inflation-linked bonds still show value to my mind. I've spoken about them before. I didn't necessarily foresee inflation picking up, but if you looked at them relative to where nominal bonds were, it made sense. What was priced in terms of inflation was pretty low, and in break-evens of inflation are still below 4% for those short-end bonds. So I still think there's a lot of value in inflation-linked bonds in the front end, and I do own them across the funds. This no fixed income presentation is complete without a slide of the yield curve. This is the yield curve. The red line is where we were a couple of weeks ago. It's not too far away from where we are today. And the grey line is where we started the year. So you've seen some shift up in the yield curve, particularly in the sort of front and middle of the curve, which is really dominated by interest rate expectations. So interest rate increases has meant that there's been some weakness in the curve. The longer end of the curve, which is more around the fiscal picture, hasn't weakened as much. There's been some support there. I always think this is a good slide, and Nolan did have their PPP slide, but I think PPP purchasing power parity for the rand is a good slide to explain why valuations are important, but not, they're not a trading indication. So over the long term, the red line is the kind of long-term purchasing power parity, so the fair value of the rand versus the dollar. But you can see the blue line is where the rand's actually been. And you can see that given fixed income flows, equity flows in and out of South Africa, given the terms of trade balance, those the currency can move a long way from that kind of fair value at points in time. My fair value has the rand at about 16.30 at the moment, so we're really pretty much bang on where the long-term fair value is. The beautiful thing about being, other than having valuations as a fallback, about being a fixed income manager, and particularly in this space, is that you have a lot of different asset classes that you can allocate to. There are places to hide. There are places that always show some value, and there's a broad spectrum of different types of asset classes that you can allocate to across the multi-asset income space, which is where both of my funds sit. So I run two funds. One is the methodical BCI income fund. I like to call that my widows and orphans fund. It's a very low risk fund for people of a nervous disposition. And then I've got the dynamic income fund, which is more of an aggressive asset allocation fund within the fixed income space. Typically, you would normally see the income fund have a much more diversified portfolio because, again, risk diversity does reduce risk. And then in the dynamic fund, a bit more of a concentrated portfolio. So those are the two funds that I run in the space. If we think about benchmarks, the benchmark in the income fund is cash +1. I always think inflation +3 or 4. And then dynamic income is cash +2 with a higher inflation plus kind of 5, which if you think about it is pretty decent returns versus the kind of risk that you're taking in the space. That's my story. Thank you.
Thank you very much, gentlemen. I can attest that was definitely one of the more interesting slides, because at some point I thought I was actually in an equity presentation. But yeah, thank you very much. And then I think, JP, you spoiled it with the yield curve. So thanks for that. Yeah, I think before I go to my questions, I'd like to ask the audience if you perhaps have a question for our panelists. Here we go.
Good morning, Andrew Cordy. Everybody's talking about interest rate hike. Normally that is to do with demand, but obviously, or not obviously, the question is, what is the purpose? Because interest rate will go up because of inflation, and that is because of the oil price. But the general person in the has got nothing to do with that. And isn't the oil price in any case what happened with the petrol price, going to put a damper on spending? So what would be the purpose of raising the interest rate?
Maybe I can take that one. I actually forgot to mention in my slide, which is that the governor of the Reserve Bank is very much focused on that 3% target as his legacy, in my view. And maybe to hell with the economy, rather achieve that 3% target. I think look, it's always the conundrum, and we've seen this many times played out all over EM, where central banks put up interest rates to stave off a currency crisis or some kind of initial shock, and then end up throwing the economy into trouble. The problem there is that what they're trying to do is trying to eliminate second round effects and to try and stop that those kind of inflation, that inflation getting built into wage negotiations, etc. The problem with that is it's quite a blunt tool. It's a very small rudder on a big ship, and you could argue very much that 25 basis points or 50 basis points is really not going to, unless you're really shoving the economy into reverse, not going to necessarily impact the inflation number overall. So it is, I agree, it's a difficult one. don't know if anybody else.
Can I add something to that? Sorry, Tian, we'll be with you in this. Actually, I'm not even the moderator, but sorry.
Well done, Nolan.
But if you give me a second there, Tian. So I had a big problem with a 3% inflation target, which we published. And the issue with it is that electricity inflation, water inflation, government-administered price inflation runs hot. It runs at 7%. Yeah. So if we are going to average 3% and something is running hot, then something else has to run cold. What ran cold for us? It was energy prices. Base effects on oil prices coming down meant that transport inflation was close to zero, if not slightly negative. And that counterbalanced excessive government inflation. That counterbalance has disappeared. So what's the governor really going to do? He's going to punish our economy until something else runs too cold. And that's the problem, is 3% in my mind is too low because it's going to create this constant structural imbalance within our economy. And it's going to create this sort of tug of war within the central bank of we've got to force inflation down in certain areas way below where it should be, just so we can kind of tick the 3% box because the government is running 7% inflation at Eskom. That's what's going to happen. And it's not great. I'll be honest with you. I've been saying that for a while.
Philip, do you have anything?
Yeah, I think it would be good if we raise interest rates. And the reason why I say that is because the Reserve Bank's job is not to control inflation. People get caught. What is inflation? Inflation means your money next year will be worth less than it does this year. Their job is to retain the credibility of our currency, which is your money. So if your money loses credibility, you're going to have crazy inflation. So by them reiterating and saber rattling to the market that they will focus on that 3% target, the consequence of that is the rand will likely remain stable. The credibility of your money is there. Because I can tell you now, if we cut interest rates today by 2%, the rand would be at 25 or 30 in 2 seconds, and inflation would go through the roof on the back of that. And then you lose control over it. And then all the foreign investors say, cheers, we're out of here. So it is important, actually, I believe, for the Reserve Bank to indicate to the market that they are likely to commit to that target. And I actually think if they raise rates, as I said earlier, that we'll probably see a rally in the rand, or it'll remain stable, and or longer dated bonds. I would actually be, as a longer dated bond investor, if I've got a 20-year fixed rate in my portfolio, I actually see that as a positive as well. So I learned 25 plus years ago not to try and guess what the Reserve Bank should do, rather play at and invest according to what they're likely to do.
So one of the lead-up questions from online has been kind of in line with something that you said in your presentation, and kind of latches on to what you said, which is, why do you believe a rate hike would be supportive of bonds? Surely the rand would rally on the back of that, but bonds?
Yeah, so short-dated bonds, if you've locked in a rate at 6 or 7% and you think rates are going to go higher than that, that's not so good. But if I've bought a long-dated bond that's 10 or 20 years, and I think that the long-term trajectory, I'm going to have a short-term spike in inflation, but actually that's going to hurt growth, and then longer-term inflation is going to be lower, then you'll be positive there. So it depends which bonds and what you hold. So as an investor, we don't invest in the repo rate, really. We're looking at 3, 4, 5, 10, 20 years, or floating or fixed rate instruments.
Okay. Any other questions from the audience? Here we go.
All three panelists spoke about one key driver being the terms of trade. Okay. And we've had this conversation, I've had this conversation with every single one of you guys. The biggest challenge we sit with is, you've just mentioned your incentive is up the rates because it serves you as a bond investor. Our country is served by better terms of trade, and that's the driving force of our currency and our economy. Why don't you echo that message to the powers that be? Because we got to recognize that it's not policy, it's not what the government does. Those things don't impact the currency. It's the terms of trade. So whether the platinum price goes up, whether the oil price comes down, why don't we give that message to the people? Okay, we keep on telling them to do things that are not in their interest because it serves us. Is it not our responsibility as investors to show them the light? You guys are the clever people, and yet we're not showing them the light. So please, be the light, man.
Wow, that's a question.
I don't know if that's a comment.
All right, guys, who's got that one?
Nobody's putting up their hand here. Look, I mean, I think the market sends the message. You know, the market shows, you know, people. I'm again going off topic, but you know, people love talking about private equity, venture capital, all that kind of stuff. But you know, there's no pricing there, but like South African credit. But pricing ultimately tells you whether things are. The reason communism didn't work is because there wasn't free market pricing, and demand and supply didn't adjust to the pricing mechanism. And so, you know, the bond market prices that. And you know, if you know, if the Reserve Bank puts up interest rates and the economy falls off a cliff, longer term, the fiscal position won't be great either. So markets will dictate that, and I don't know that we will necessarily listen to us, no matter how smart we are.
Yeah, I'd add to that you know, the terms of trade, gold price, platinum price, coal price, iron ore, matter, but they only matter to the extent we can actually get the ore out of the ground, onto a ship, and across the ocean. Now, to the extent that there have been issues with, you know, rigid mining laws or labor laws making getting it out of the ground tough, railways making it very difficult to get it to the port, and dysfunctional ports making it difficult to get onto the ship and sell it. All of that actually has been a major, major issue that also needed to be taken care of and continues to need to be taken care of, because, you know, your terms of trade only matter once all of that's in place. And I think saying we need to continue to invest, and I think we've been arguing that for a while, that we need to continue to invest in upgrading those services, will put South Africa in a better place. And then, yes, absolutely, we're like a cork cast adrift, sort of bouncing up and down on the global commodity prices. We do. But investing in Transnet was absolutely impossible, other than just writing them a sort of blank check for a while. And that's being addressed. You know, for the first time ever, I think there are now private concessions on the Transnet rails. We've needed access to that as an economy, actually, rather than as an asset manager per se.
I mean, I appreciate the engagement here. I'm getting to my first question, and I've got 2 minutes left. So I'm going to shoot from the hip here, and I'm going to start with Philip, but I'm going to ask all of you to comment on this. I mean, talking about all the good news coming out of SA, you know, the last 2.5 years has been pretty positive. You know, whether it's terms of trade or current account surplus or getting onto and then off the grey list, and then also a more accommodative sort of monetary policy environment. Now that we're in the throes of, I guess, this global macro picture, you know, what can, I guess, we expect, including myself being an allocator of capital, from fixed income or bonds for at least the foreseeable future that we can see in front of us?
Yeah, so I mean, it's in the name itself, fixed income. So we talk about a lot of exciting things and macro and all of that. The bottom line is we lend money to companies or governments. We've got a fixed sort of cash flow. And the irony is this sell-off that has happened now has improved the outlook for fixed income. It's made it more murky for equities and the economy and everything, but we've now been able to lock in yields at much higher levels, and the higher future rate environment, higher than was expected, actually allows us to reinvest coupons and everything at higher levels. So that's how markets work for us, you know. And when the outlook is good is when you're actually likely to get hurt the most. So really the outlook for us has improved from a return perspective.
I got you. And maybe just like on top of that, I mean, obviously the volatility and the expected volatility in the future is obviously a lot higher, and you're trying to take advantage of that through, you know, buying longer dated instruments potentially. I guess the free call option on that is, if the volatility rescinds because we get a good outcome, then you benefit from that on the back of that as well.
And sort of got both. Actually, most of the buying that we did during this time now was in that sort of 3 to 10 year space. Actually, not the long dated, because that's where you saw it on JP slides. That was the big sort of spike, and that was the opportunity. So actually and you need to be able to change and adapt to that. You need to change as the market changes. And if anything, this has been It doesn't feel like it, but it was a bit of a gift that Trump has given us here. He's given investors an opportunity to get into yields at higher levels, much higher than they were 2 months ago.
Okay. JP?
Yeah, I mean, I think, again, going back to the kind of premise of my presentation is like focusing on valuations, looking at what's priced in, are we being compensated enough for the risks that we're taking? The great thing is that there tends to be bouts of volatility where, the periods like we went through in the last year where, the market can get slightly ahead of itself in terms of pricing in perfection. And then we have bouts of volatility like we've seen over the last few months where the market starts to question that pricing price to perfection. So those give opportunities, and as I also pointed in my slides, we have an array of different asset classes within the space, that fixed income asset classes in the space that we can take advantage of. So we've always got a place to take advantage of and a place to hide in the spectrum of assets that we have at our disposal.
Thanks. Nolan?
Thank you very much. Very briefly, I see time's up here, but as my colleagues have said, the market has given us opportunity. We've all, to varying degrees, locked in that opportunity. And as we sit here, portfolio yields are probably 10% on the Albee, give or take. And if you believe that we are going to get through this, we believe that the Iran war is going to, at some point, peter out and calm down, then suddenly you're talking about potential bond yields, potential bond returns, somewhere in the 11-12% per annum range for the next 3 years on average. That might be a little bit less this year and a little bit more for the next 2 years. But actually, that's a good outcome for investors. And I think we'd be pretty happy with that.
Perfect. Gentlemen, we have run out of time. I want to thank the audience for making my job a whole lot easier by not asking the questions on my cell phone. And so from my side, thank you for your insights. I think we all found it incredibly valuable, and thanks to BCI. Thank you very much.
Thank you, Rafik, Nolan, PJ, Phil. And to link up with that, I mean, all the sea captains does have a lot of experience. And Tian, thank you. That makes me think of that song, This Little Light of Mine. So we'll show them the light. Right, on stage already, Global Equity panel that's assembled here with our moderator, Tavonga Shavize from Apex Investment Consulting, their Chief Investment Officer. Then we've got on my first right, Tony Bell from ThinkCell, Neil Smith from All Weather Capital, and Adrian Clayton from North Star Asset Management. And like the guy said earlier on, the fixed income panel, they're not like the equity managers that think about blue skies all the time, but we'll get some answers straight away. Gentlemen, thank you so much for being here today. We really appreciate your time. Thank you.
Awesome, cool. Thank you so much, Eugene. I'm Tawonga Chiwije from Apex Investments Consulting, South Africa. So I think as I was preparing for this, panel, I went through Tony, hi Tony, presentation. And literally, I think, as many of you know, Tony being the second differential thinker, I pretty much just started blinking because I couldn't quite understand some of the slides. And then I quickly realized, like Adrian almost saying there's no time to blink. And I thought, okay, Flip, I must be like bipolar or something. And then I saw Neil talking about multipolarity, bipolarity, and all of that. So I think it's going to be quite an interesting, panel for all of us. I think from a global equity perspective, we've got a strategic, stance to sort of be investment style neutral through the cycle. So pretty much investment styles being growth, quality, momentum, value, and your small mid caps. But then, however, depending on the direction of the US dollar, we do take geographical bets, which is obviously your DM and EM, away from a MSCI ACWI neutral position of 85% DM and then 15% EM, where we split our emerging market component equally between emerging markets and Chinese equities. So I think many of you would know all the way to 2022, I think, or 2023, running a style neutral benchmark meant we kept on buying into the value underperformance cycle. And more recently, in the last maybe 12 to 15 months, we've been buying into the weakness of quality as value has come back on the on the forefront. So obviously, when you're buying into a style that's on the back foot, it does make one quite uncomfortable. but our strategic view on that is no investment style, does well through all the cycles. They're pretty much all cyclical. So I think it's going to be quite a nice panel with the quality-oriented managers, I think being Tony and Adrian, sort of speaking into that. And then on our geographical bet, we pretty much start to overweight emerging markets in a dollar weakening cycle, where we move from the 85-15 to a 70-30. And I think we'll get a sense of how to think about that dynamic strategic asset allocation when Neil comes onto stage. So without taking up too much time, Tony, over to you. Thank you.
Good morning, all. What I'd like to do today is really just give you a little bit of a framework about how we see this particular environment and really interlink into our stock selection choice the drivers that we see of the macro environment. To us, it's really not that confusing if you get the right yardsticks in place, but it's, as expected, a little bit of an unexpected journey that we've been with Trump. Let's just look at the fund very briefly. We've had the pleasure of managing this fund since inception. It's in the flexible space. It has an 80% MSCI, 20% benchmark. That's its performance relative to peers. Done a nice job. That's the consistency of performance, and really what we're trying to do, as many of the speakers have alluded today, is you don't really manage for the upside. You manage risk to the downside, and the upside sort of takes care of itself. So that's the scoreboard. Very happy. Let's move on. When I presented at the BCI conference last year, I showed this slide and the next one. And it really referenced the major shift that we've seen in the political environments. And I think the subtext of today's talk is really about this dynamic of change and how we factor in the bond markets, how they're reacting, the currency markets, how liquidity flows are changing, and really how the whole world has shifted since Trump's appointment early last year. I think what makes this slide so powerful is the positioning of where Trump is at, next to Erdogan, next to Putin. And what's really happened in this world in the last 18 months is we've moved from top left to bottom right. And with that, I think you've got to structurally change your mindset as to how everything works. When I spoke about Project 2025 last year, a couple of folk picked up their phones, took some photographs. Most folk hadn't heard of it, and now most folk have forgotten about it. And it's a central document, a central thesis in how this world around Trump evolves. Because Project 2025 isn't just about what Trump's next best idea is. If you look at Project 2025, it's a 960-page document. And it very, very carefully sets out in some detail what the world according to this new right agenda looks like. And it's very different from the past. And so one of the themes for today is really the shift from the left to the right and the framework that that encompasses. The other theme I want to bring through today didn't happen last week, 2 weeks, or 2 months ago. It actually happened quite a long time ago. And on various platforms that I've had the pleasure of speaking on, I've mentioned these 3 movies really being put together. 2000, 2001, 2006. How incredibly prophetic. The Matrix, AI. So the Matrix in our today world is big data. AI is self-explanatory. And what was Avatar about? Avatar was about mineral rights, the fight for mineral rights. And so when you put these 3 together, you've really got a curated insight into the world that we're in and the world we're moving towards. How does that play out in markets? I think one of the beauties of running a flexible fund is we have the ability to shift geographically as well as sectorally. And for us, the underlying theme that drives our equity selection is capital allocation and the way in which industries are adapting to this very big shift in the political environment and the innovation that comes with all of these changes that we speak about. So what we see on the right-hand schematic is we see an industry that really has shifted through different phases. At the moment, semiconductors are the in place to be, but you can see on the right-hand side of the chart that a lot of the companies that were once sort of leading their field have started to fade. And so even within industries itself, company survivability is no longer assured. I was looking at my master's thesis that I did a long time ago, a few weeks ago, and I studied the 40 companies on the JSE, their price formation process. This was a while back. 2 of those companies survive today. The average lifespan of a company on the S&P 500, only 15 years. So when you have a look at this dynamic of capital allocation, industry change, productivity change, technological change, it has quite a big impact not only on companies but also industries and how they can adapt. Healthcare being an example in the current environment. So the schematic on the left-hand side really shows the dynamic of change within industries. Those little blocks represent the highs. At this point in time, when a sector reaches a new high, you can see the importance of having the flexibility within the fund to move in and out of the different sectors. About a year ago, there was quite a big push for non-US investment, Europe. There was a push towards Japan. We've capitalized on that, but we've largely exited or downweighted regions where we think capital allocation and flows are very poor. The US, the little circle or eclipse at the top, is very suggestive that at the moment, the structural forces that are driving companies and industries favor the US in terms of a number of changes that have been introduced by Trump. Big, beautiful bill, accelerated write-off of capital, the technology, the brain power that's there, and Europe to some extent seems to be a little left behind. This rally, who knows how long it will last, but the forces behind it are very powerful. If you sit back for a moment and you just think about the level of earnings that are being generated across a wide spectrum of US companies, quite phenomenal. You know, we look at tech earnings and we say, oh, NVIDIA's earnings are up 60% for the quarter. That's against an inflationary backdrop of 4%. Quite phenomenal earnings drivers. So we see a very strong underpin to the growth stocks that we have in the portfolio, and that largely is driven by earnings. But there's a but. And what concerns us looking ahead are 2 things. What's happening and the information, the message being shared by the bond market and the currency markets. So long end of the yield curve, yes, I agree with Philip, it's very attractive, but we've got to remember that equities price off the long end of the yield curve. And to the extent that that yield curve is shifting up, we've got to be cognizant that the risk transmission mechanism for equities could come through bonds and could come through currencies. It also could come through liquidity. Trump's tariffs have changed the whole way in which the US deficit is funded and the way liquidity flows. So we've constructed an indicator where we look very carefully to make sure that we're not at one of the stress points within this cycle. So if we put it all together from a selection point of view, last slide, we find ourselves in a slightly unusual place in the management of global macro. In the past, we were driven by high-quality names that produced the growth. We find that those companies no longer offer the same sort of growth profile that they used to. So in the sort of dotted block, we've got positions like GEV, Taiwan Semi, Lam Research, Caterpillar, XPO Logistics, Micron. Very focused, active positions, but really the focus at the moment is to complement those active positions with a very, very strong focus on downside risk management because of the way in which the bond markets and the currency markets are telegraphing risk. Tavongo on that, thank you very much. 2 seconds to go.
Thank you. I think up next is Adrian Clayton. Sorry, my apologies. Up next, I've got Neil Smith coming up on I think multipolarity and diversification. Thank you.
Okay, good morning, everyone. I'm going to talk something a little bit different. I'm going to talk about multipolarity. We're currently living in one of the biggest regime shifts in a generation, and that is really the end of the unipolar era, 3 decades of US dominance and a shift to multipolarity. And I'm going to build an argument to show that portfolios haven't caught up to the reality on the ground. We've started the chart that I think most of you in the room will be familiar with. This is the MSCI Emerging Market Index relative to the S&P. And over 15 years from the end of 2010 to 2024, the Emerging Market Index underperformed the S&P by over 80%, which obviously that performance killed allocations in all portfolios globally. But however, since towards the end of 2024, emerging markets have started to outperform, and to date, to the end of last month, have outperformed the S&P by about 30%. Now, the question is whether this is a cyclical bounce or whether this is something structural. The conundrum is really that trust in America, and I'm going to show you this, trust in America is eroding quickly, yet global investors are very overweight the US. And this overweight position in terms of all US assets, whether it's fixed income, equity, or just the dollar itself, is reflective of a worldview. And it's not simply about company earnings or currencies. It's about a geopolitical premium that has been assigned to the US. That premium is currently being debated among governments, central banks, investors. Now, back in February, so before the Iran war kicked off, a lot of the US's closest allies were asked a very simple question. Do you feel more comfortable depending on China or on the US under Donald Trump? So Canada, the US's largest trading partner and direct neighbor, answered 57% in favor of China. Germany and France both answered 40% in favor of China, and the UK 42%. Now, for these are not adversaries, these are treaty NATO allies who have anchored their global prosperity and security to the US-led order over the last 80 years. For them to answer China, the very concept of the US being the global risk-free anchor for the global financial system, at least, is starting to be debated. So in March this year, after the Iran war started, the Europeans were asked, do they see the US as a threat or an ally? 12% answered they see them as an ally. 23% answered they see them as a partner. 24% as a threat, and then 36%, which is more than a third, actually as a threat. So the question is, what happens to US assets if this is one of the biggest allocators of capital? This shows the European ownership of US assets back to 2015. If you look at the black area, that is the European ownership of US equities. Back in 2015, Europeans owned roughly about $3 trillion of assets, of equities, and that's grown to 10 currently. The question is, if 60% of Europeans see the US as a threat or as an adversary, the assumption that capital is going to keep flowing to US assets at the same rate is a big assumption. This has been a tremendous support of US asset prices by compressing yields and elevating equity multiples. So the assumption, if you're betting that this is going to continue into the future, you need to be careful. This shows the extent of the concentration. Foreigners own around 230% of US GDP on a gross basis of US assets, or 90% on a net basis. This is the biggest crowded trade globally at the moment. All sovereign wealth funds, all large pension funds, and all institutional asset allocators have got this position in their portfolios. Now, crowded trades carry reversal risk, not because the underlying assets are bad, but if sentiment shifts and people sell, the exits narrow. Central banks have noticed. Central banks are traditionally the longest horizon conservative investors. Their purchasing of gold has spiked since 2022, and that is the year the US and their allies seized 300 billion of Russian foreign assets. And that single decision changed the rules. US assets held in Western custodians are no longer financial assets. They're bare political risks. So the question is whether this follows through to institutional investors. Ferguson's law, this is something fun, this is very interesting. The historian Neil Ferguson, he observed that when a superpower starts spending more on servicing its debt than defense, its days as a superpower numbered. Well, this isn't a political opinion, this is an observance of a historical fact on any empire in the modern era. As soon as this dynamic started to occur, their power started diminishing. So just contrast the US to emerging markets. I am an emerging market asset manager, equity manager, so this is of interest to me. Real GDP growth, US 1.8%, emerging markets 3.9%. Government budget balance deficit is minus 6.5% for the US, minus 5.8% for the emerging markets. Current account as a percentage of GDP, minus 3.6% for the US, 0.6% for EM, positive. So the US is really the debtor, EM is the creditor there. And the balance sheet, government debt to GDP, 126% for the US, 72% for EM. So in any metric you look at which determines sovereign risk, emerging markets are better positioned than the US. This is also interesting. The US, if you look on the left-hand side, accounts for 26% of global GDP, but 63% of global market cap. So if you take market cap divided by GDP, it's a 2.4 times multiple. Emerging markets, 32% of global GDP, 11% of market cap, 0.3 times multiple. That's an 8 times differential on the multiple. If you look on the right-hand side, you've got NVIDIA. NVIDIA, this by itself is 1.7 times more valuable than the entire market cap of the Taiwanese stock market. NVIDIA is 0.9 times the value of China and Taiwan combined. Apple, 1.4 times the size of China. Microsoft, 1.8 times the size of South Korea. Amazon, 1.8 times the size of India. I mean, are those bets you're comfortable to run indefinitely going forward? Those multiples are the premises that US dominance will continue forever. So also the assumption that US corporates, if they suffer no competition in industries that are going to define the economy for the next 10 years is also incorrect. If you look at China as an example, I mean, their open source AI models are competing directly with the West's closed source paid for use models. China has 65% of the global EV market. They're the largest manufacturer by far. They control 60% of rare earths. Rare earths, the global semiconductor, defense industries, battery storage can't function without that. And this is just China. This is just the one country within the index. There's also India, there's South Korea, there's Brazil, so many other opportunities. Unipolarity is, I think for all of us in this room, is something that we've all lived with. We started our careers in that and something that we're used to. History shows you here that unipolarity is an outlier. I mean, every time there's been a major power, that's always led to a broader distribution of power, more competition in a multipolar world. So this is really back to revision to mean. The last slide, it really is, we're not arguing for a zero US position. US has got tremendous companies, tremendous assets. We're just saying the position size is too large and that rebalancing to reflect the multipolarity is warranted, given that trust in the US is eroding quickly. As I showed you, partners are seeing the US now as a source of risk. You think of NATO, Greenland, Liberation Day, etc. And as I say, it's the largest crowded trade at the moment. Just needs, running that position going forward needs to be considered. Thank you.
Thank you so much, Neil. I think we'll finish off our discussions with Neil, with Adrian, sorry.
Good morning, everyone. In the heavy weather out there, I thought I'd start on an interesting note. And it actually deals with watching a plane land at Cape Town International on our way here. We'll start with a bit of aviation information for everyone. I don't know if you're aware, but the average pilot that enters cloud gets spatial disorientation in 15 seconds if they're not using their instruments. In fact, the ears generally take over because we all default to balance. We don't have a visual context in clouds. We don't have a horizon, so we default to our ears. And the ears are the liars of the aviator. They don't tell the truth. You think you're flying straight, but you're actually descending or you're turning. And the theory, aviation theory, actually is quite interesting. The literature says that the problem is you default to an illusion. And that illusion stems directly from your ears. It's your balance. Now, we have exactly the same thing in finance, believe it or not. It's called anchoring bias. And in the literature, finance literature says that anchoring bias is the assumption that price is always correct, and that's without performing any form of valuation work. So we all have that. We always think that price is right. It's a natural disposition for all of us. Now, I'll give you some examples of why that isn't the case. And you'll all be able to resonate with this immediately. In 2016, Steinhoff hit 96 Rand 85. In Sanlam in 2003 was 5 Rand 80 on a 20% yield. It's now $100. And in 2000 March, Cisco reached $80. It reached $25 in the same year and took 20 years to get back to $80. So clearly price isn't necessarily right. So price, we would say, is a little bit like the ears to the pilot. It's the liar for the finance industry. And valuation work and research are like the instruments for the pilot, for us in our industry. The problem is most people just see price. Most people in the industry don't spend all day long doing valuation work. So I started like that because the quality index is under extreme pressure at the moment, and most people you speak to in big audiences suddenly say quality is dead, don't buy it. We've called our presentation, this is No Time to Blink. And the first graph really just shows the quality index's performance against the market over time. And this is a broad market, includes emerging markets. If we look at the performance on an annual basis of the quality index, we can see that it's definitely had a tough time just of late. But most of the time, it sits above the market, even on a one-year rolling basis. If we look at the value index, which everyone's defaulting to now, it's performed much in line with the quality index, but actually with quite a lot more volatility in blue. So the standard deviations around value is very, very high. You incur big ups and big downs. What we've done is we've said in our business for many, many years, let's add quality and value. Let's buy companies when they're cheap, but good businesses. The outcome is actually the pink line. You get very, very strong performance by buying undervalued quality businesses. But you do get some volatility in pink. More than you get out of quality, less than you get out of value. And if we sum that all up, quality gives you a very high, quality value mix gives you a high return, get a lot of bang for your buck. You do get some volatility, certainly less than value, but more than quality. But the outcome is outstanding. But in the last 2 years, quality's been beaten. And that's really where we come to now. And why is that the case? And we think there are probably two reasons why that's happened. One is technical, and the other one is fundamental. The technical reason is that most of the capital has gone in two directions. The cyclical part of the market, so oils, materials, even utilities, maybe less cyclical. So it sucked capital in that direction, and it sucked capital to very expensive part of the market where the hyperscalers sit and some of the semis sit. So very expensive companies and very cheap companies, and it's really sucked it out of the middle where a lot of the quality businesses reside. So that's maybe a technical reason. A fundamental reason, and there are actually three of them, and I'll really discuss that today as briefly as I can, is that we've had three things happen. And I have to really skip some of the slides, but the one, and move quickly because I don't want to overstay my time, but the one is really around GLP-1s. And if you look at the way the quality index is constituted, 71% of it is medtech facing, facing the consumer, or facing technology. So those are the three areas where quality kind of operates. And in each instance, there's a fundamental reason why they're under pressure. So in the GLP-1 space, this is attacking the historical businesses that are invasive in terms of fixing people, operations and things like that. Now you can take a tablet, hopefully lose weight, cardiovascular improvements, et cetera, largely untested still, but certainly damaged the industry in terms of the large medtech stocks being derated downwards. And you can buy some of these companies on less than 20 times multiples. It used to trade at double that in the past. And you can see the derating of the healthcare sector. The second is the AI trade on the tech industry, particularly the SaaS players or the companies that offer service. And here too, we understand that you've got a problem in the industry and that there's a new technology that might disintermediate some players. But the counter argument is that there's trust and compliance with your existing supplier. They're vertically integrated in an entire industry, and you tend to find businesses take a long time before they can an operator or change to new technology. And I've had time, I could show you so many examples of those. And then, of course, SaaS operators have all the proprietary data on their clients, and that data is very useful for improving their businesses. So those are three counter arguments. You can buy many SaaS companies at less than the market's valuation these days. And then the last real problem against quality is the consumers being under pressure. So we just show a graph here of Hermes bags. So anyone that's interested in buying a Hermes bag, I think some of them cost $20,000 a bag. This is the second-hand market, and you can see the top graph and how the second-hand market's devalued a lot of Hermes bags. So the consumer's under some pressure, even the most well-to-do consumers out there. So those are three reasons why quality is under some strain. Now, here's an example. It's probably the poster boy of the tech industry in SAP. It's come under extreme strain. And the view is that AI will disintermediate SAP. Now, SAP touches 77% of transactions in the corporate world. And I don't have time to really go into the details here, but I'm going to tell you what Jensen Huang said about SAP and AI in particular and the SaaS industries. And this was at the Cisco conference in February 2026, so the other day. He said, AI will not replace software companies. AI are tools, not replacements. These are all quotes, direct quotes. The replacement narrative is the most illogical thing in the world. I think the market has got this wrong. And if you don't believe him, in Q4 2025, 90% of SAP's new business was in the AI side of things. The next business I'm not going to go into in detail, but it's Reckitt, a business we own. You can buy this company on literally the same multiple as Tiger Brands in South Africa, but it's one of the 15 largest consumer movement goods companies in the world, and 60% gross margins that the business operates at. It can defend its portfolio. So, we think there's a lot of irrationality in some of the way these businesses have been valued. Now, just getting on to some slides on our own infrastructure. This represents our discount on our buy list. So we cover 100 companies, and we should increase that coverage probably to 150 and 200 companies within the next year as we've grown our team. We cover 100 companies, got our own valuations on all of them, and we've tracked the discount to intrinsic value over time. In red, it's when the buy list doesn't offer value, and in green, it's where it offers extreme value. What we've seen just of late with the way stocks have sold off is it's one of the largest potential returns on our buy list we've seen in years. The last time we saw this was through COVID. And what's important, infrastructurally, is that we follow the buy list. We don't second guess ourselves. We're not looking out the window, guessing, using our ears for navigation. We've got the tools in front of us. We've done the work. So we follow the buy list. The buy list says there's huge opportunity to buy equities, particularly many of those that have been sold off that are cheap. And we followed that, and the blue line represents our asset allocation in equities, rising every time the buy list offers value. We of course sell high, as well. You can see that we de-risk the portfolio when the buy list enters a zone where equities no longer offer value. And that's led to great performance over a decade. And we're in red, and their peer group is in blue. And the equity part of our flexible fund is in red here against other equity managers, also outstanding performance. But below the bonnet of the car, and the single lines represent the paintwork of the car, below the bonnet is the real mechanics of what we do. And our hit rate on the left-hand side, or I see it on the left-hand side here, is the number of stocks in our portfolio every year that beat the index. We're in white, the index is in blue. The win-loss ratio is the ability to pick winners that outperform the detraction that happens from losers. A ratio over 100 tells you that the winners are adding more value than your losers are detracting in your portfolio. And our alpha, out of 13 years, 9 of them we've delivered positive alpha. So if we sum that up, 57% hit rate, 143% win-loss ratio, and almost 2% annualized alpha. But we have been humbled in 2026. It's been a terrible 4 months for all quality managers, really. And we just show the retracement we've seen in our own portfolio, both at a flexible fund level and on our equity level. But here's the interesting kind of rub. This is a graph that uses the different cohorts of different stocks in the market based on the return on capital. So what's interesting, in the last 4 or 5 months of the year, is the best returning stocks in terms of ROICs have had the worst performance on the market. A little bit like saying the best farms that yield the highest have been sold off, and the worst farms that yield the lowest, which are the stocks between like 0 and 30% ROICs, have been repriced upwards. So we've had a strange dislocation in the markets. Now, if we just look at our performance over time, we're in blue, and the quality managers, many managers are in all the other colors. We kind of done very well over many, many years. But the last few months suffered like the pack. And I just want to raise 1 or 2 last slides with you. This is a manager we rate very highly. They've got $8 billion under management, and I'm sure a lot of you will have your money with them, a quality manager. We rate them. I actually listen to him every now and again because I really do believe he's a leading mind in the industry. And he too has had a tough time, so no one's alone in the quality space. And this is another manager that's more pragmatic and drifts away from quality, but likes to say that they own good businesses. They've got $30 billion. What's intriguing is from 2017 to 2024, they underperformed the market. $30 billion. The gray space on the slide shows the extent to which they underperformed the market. Yet they stuck to their principles, they stuck to their buy list, they didn't look out the window and concern themselves with the weather. And the massive returns seen in the last 2 years led to extreme outperformance. So I'll make a point here. They stuck to their guns and their clients stayed with them, and everyone landed quite safely. So just really in conclusion, what's been tough is the software trade for us just this year. We always make our own mistakes. So every year we get about 40% of our stocks wrong. And the war has really hurt a lot of companies that we think are ridiculously undervalued and will reprice upwards. So in conclusion, what makes us win over time? We have a philosophy that's just a no-brainer. Would you rather own a flat in Newlands when the market comes under some pressure and you can get a 10 or 12% yield and you can buy it at a 30% discount in Cape Town? Or would you rather buy a block of flats in Hillbrow? You know, we prefer the block of flats in Newlands at the right time. That's one way of putting it. It's reliable, you can bank it. The process is deep, it's bottom up. We have a lot of people working on it daily and we're extending our team. And the team is growing. We're going to have 8 analysts just on global by the end of this year. So we really aim to cover 200 stocks globally. So, you know, we think in decades, not in days. And we certainly have no intention of blinking currently. Thank you very much.
Awesome. Thank you so much, Adrian. I will start off, I think, by giving, the audience an opportunity to ask questions. I'll take audience from the floor for the next minute or two. Any questions from the audience? Okay, no questions. I can't really see. There's like 4 lights like hitting my eyes. So, okay, perfect. Okay, cool. If there isn't any question, I'll go on to the online audience. The first question is for Tony. It says, given volatility in bond markets and the global debt risk, would you say managing beta via equity can replace the 60-40 portfolio? So I really think it's a conversation around the 60-40 and its relevance.
So just, sorry, Tabanga, just repeat.
Okay, cool. So given volatility in bond markets, so almost dismissing the global bond market, and the global debt risk, would you say managing beta via equity and discarding bonds? Yeah.
So what we've actually done is we're using so the question is, if I understand it correctly, given the volatility and the view on bond markets, would we rather have our beta exposure through the equity market? And the answer is actually in reverse. We were heavily invested in South African government bonds until very recently, and we've taken that money offshore and we've popped it into the US 20-year part of the yield curve. Agree with Philip. I think it's a very useful place to act as a risk diversifier, because if the macro picture plays out the way we think it will, is that ultimately those bond yields are going to come down quite sharply, and it diversifies the active risk that we're taking in the equity component of the portfolio.
Okay.
If that answers the question.
It possibly does. Maybe if I can just maybe zone in on that question a bit further. Would that specifically apply to the US bond market or treasuries?
Sure. I think it's a very important question, because if you look at the dynamic around the world, Japan itself, that is having to use the US Treasury through the currency swap to defend its currency this time and not the bond market, is in a little bit of a debt funding crisis and liquidity crisis on its currency. So for countries that don't have the reserves, like Japan, that are over-indebted, that previously were defending their own bond market, they're now having to defend their currency. So we see the US in a very different position. The long end of the curve does worry us from a funding risk perspective. Besant has to find 2 trillion this year. He's got to roll 9 trillion. The trade tariffs have interrupted the natural flow of US bond buying. So a subject perhaps well beyond today's debate is looking at stablecoin and seeing how the US bond debt profile could potentially be monetized. I see a big shaking of the head in the back room there. And I think what we've got to look at is how the Walsh and Besant combination, which is very powerful, starts to change the regulatory environment and introduce a little bit more stability into what looks like a precarious funded situation in the US bond market now. And as soon as the market starts to get whiff of that, the real yields that are implied in the long end of the bond market in the US look very attractive to us as an alternative to duration risk.
Awesome. No, thank you. The next question again from online audience. I'm going to go to Neil. It really is saying, does diminishing trust in the USA equate to diminishing flows into that market? Like, is there a relationship between capital flows into the USA and trust of the UK, US system?
I mean, it's a good question. I think that the answer is yes. I mean, if you look at the flow data 18 months ago, the US equity market, in equity land anyway, the US equity market accounted for 75% of global flow. It's now down to sort of mid-20s. So, you know, you see a lot of the flow being reorientated. You had some pretty major European asset managers stating that, you know, that they will be reducing exposure along with some of the sovereign wealth funds, including in the Nordics. So I think the situation in Iran has certainly paused things. You know, people are managing their risk and their exposures, and I think it'll be interesting to see once that settles down. But I mean, I'll show you the trust data, and I mean, I think, you know, there's been Trump's thrown a lot of negative volatility at a lot of their allies and partners, and I think that people are sort of reassessing.
Cool. And then I will just have a quick check if there's any questions from the audience on the floor. Great. Help me out here. One question. Okay, good. There's a question for you, Adrian. And I'm going to sort of top it up with a question on my side. So it says, you're arguing that price is not always right. And I think the whole argument is around maybe that applies at a single stock level, but it doesn't quite apply at an index level. I think that's the gist of the question. And then maybe from my side, it would be, I think, as a multi-manager, where we're sort of trying to build portfolios, and especially spawning block, where we choose quality managers, value managers, growth managers, as I alluded to earlier. One of the benefits of your fund is the ability to blend, quality and value. Could you maybe just give us a sense of how those two factors would find their way into your portfolio? So it's two questions for you.
The second one was how?
Like a quality and value would find their way into your portfolio, which obviously, I think is a great thing for us in the sense that we could almost outsource those two styles into your portfolio.
Thank you. All right, I think I'll deal with the second one first, which is, how do you end up with quality at a reasonable price? We're looking for good businesses, and we screen for those, and we screen 14,500 companies these days. The world has become very sophisticated in the tools that we can use from the days when we had a few stocks on the JSE 31 years ago that we tried to screen for. So the capacity to screen is there. So the first thing, you're screening for businesses on specific metrics that rate as quality metrics, and then you rescreen them on valuation-based metrics. So you screen for good businesses, and then you screen for the ones that are the cheapest within that grouping. If that answers your question, Tavonga.
Yeah, it does, yeah.
And the first one was?
The first one was that our price can be deceptive at a single stock level.
Yeah, so I would say that price is compounded in its problem at an index level as against, so I'll just make the comment that we would say price is wrong at an instant in time, but not necessarily wrong over time. So, the market works itself out over time and revalues things accordingly. In many examples I gave, Steinhoff is zero these days. Even the debt was worth zero. So, and it was always worth zero, quite frankly. But at an index level, you actually get a congested overvaluation or undervaluation at times. And I think that's really the greatest risk. And it's so obvious. If we look at so many examples we can relate to, in 2016, we saw that in building construction companies that had excessive margins in South Africa and became dominant in the index. You look at technology businesses at the time that are completely over-indexed in indices. And then in South Africa's case, financials accounted for an insane amount of our index many years ago and repriced down. So we see that very, very often. In 2000, exactly the same thing happened in the US. So I think you have a double problem in an index.
I've got a lot of questions from the online audience, and they're really looking for a fight, because it has an element of Tony is saying, time to look at the US again, ask him to debate that with Neil. And then Adrian is saying this, ask him to debate that with Tony. So they're kind of looking for a bit of spice. But maybe I think I'll sort of try and figure out how we can sort of allow, the three of you to sort of get into each other's presentations. Maybe the most neutral way I can think of is the one question says, China has had a far better GDP growth rate than most DM, but this is not translated into stock market performance. Why does this matter? Or you could also look at it from the EM being very relevant at a GDP level, but not at a stock level. Maybe that would be a more neutral way to take by all three of you. Start off with Tony, Neil, and then finish up with Adrian.
Sure.
Cool.
I've for a long time pondered the difference between stock market returns and economic growth, and there is really a very poor causal linkage. So I think what markets do is they price implied growth rates, and what they're looking for in the difference between the regions is a company's ability to sustain those implied growth rates with a multiple attached to it. And I think when we look at the China versus US example, you can find many companies in China that are of equal quality that trade at half the rate. And I think what investors are doing ultimately is that they're backing companies where they've got the level of transparency and they're comfortable that that sustainability is being managed in their interest, and therefore it gets down to, what premium you're prepared to pay for a company that has shareholder interests at heart versus perhaps a more political agenda.
Thank you.
Yeah, I mean, I agree with all of that. Just as China specifically, I think if you look at the net profit line of the index, the Chinese stock market index, it's done exceptionally well over time. But the EPS line, so there's been a massive disconnect, and that as a result, see the stock market hasn't done that well over time. And the reason for that is issuance. I mean, a lot of the management teams in China have been issuing paper hand over fist for many years. That dynamic's changed about 18 months ago. There's a big reform drive within China, targeted at better shareholder-focused policies. And I think the reason behind that is that 60% of household wealth is in the property market in China, and we all know what's happened there. And there's this agreement between Chinese population and the government that they forgo civil liberties to a large extent, and in return they get prosperity. They've had no prosperity for a long time, and the only channel really for wealth creation going forward is the stock market. The stock market has only got about 4% of household balance sheets, and as mentioned, I think the last 18 months has been 1,400 companies in China for the first time have registered for dividends and buybacks. You've had management teams of state-owned enterprises for the first time being incentivized on share prices, and the hope there is that you're going to stimulate a stock market culture to drive wealth creation. And that's now been paired with, we think that the Chinese economy is going to start pivoting towards supporting domestic consumption. They've been talking about it for a long time. And we're not expecting a big bang approach because the rebalancing in the economy needs to come from the government giving up towards consumers, which obviously the CCP is very reticent to do. But we think that it's reached a point where they need to do it to instill confidence domestically. And if they can get that right, Chinese consumers have got $23 trillion of cash sitting in the bank account. And if you look last year, what happened on the sort of southbound connect, the amount of money coming in from the mainland into the stock market connect was equivalent to 80% of all EM mutual fund assets globally. And that is 0.5% of the $23 trillion. So there's tremendous firepower there. So we think China can do well. I'm not saying it will, but I mean, the building blocks are there for the stock market to do really well, especially everyone's underweight it as well.
All right, thanks, Neil. We'll finish off with yourself, Adrian.
So if we had to speak macro, I'd probably embarrass myself because we spend 99.9% of our time bottom up in the office. And macro fascinates me, but I'm not equipped to speak from a macro perspective because it's not where we spend our time focusing. So I actually agree with both of these guys in terms of their views of the world. I think where we come from is we might have very different positions in the portfolio simply because we're looking at businesses from the bottom up. So let's say we've got 60-odd%, 67% exposure to the US, and someone would argue, geez, you shouldn't have any exposure to the US. The US is a massive market, and our portfolio looks nothing like the index. I mean, we run an active share of 80%, which tells you that the underweights and overweights in our portfolio are 80% different to the index. So, it just gives some perspective. So when you're doing bottom-up work, you can have massive global views, but you can still end up being exposed to a certain market and look completely different to that market and not behave like that market. So I think that's where we come from. And I just also add, why we've gone that route. There's a particular top-down house that I follow very, very closely, and I love their work. I'm fascinated by it. It's brilliant, brilliant graphs and that. And I go through their work methodically every 3 months, albeit that this is in my spare time on weekends. They're wrong every quarter. And the reason why they're wrong is because everyone's wrong, top down. It's impossible to predict the future. It's impossible to do it. None of us have the mental capacity with the complexity of the world, to actually get that right. And so we don't focus our attention there.
Thank you, Adrian. There was a couple of questions, but I have unfortunately run out of time. So thank you to all of you. Thanks.
Thank you.
Well, thank you, gents. On global equity, some very thought-provoking questions in there. And I think a lot of what was said speaks to why active management and how they can actually beat the clock. Right, our next session, before we're going to break for lunch, we've got the Global Fixed Income and SA Credit panel. Here to moderate the session for us is Rudolf Horn from Martin Optimal. Rudolf, you can come to the front so long. There you are, thank you. Kind of look around where they are, and it's like Tab says, all these lights in your eyes. And then we've got Paul Crawford from Fairtree. We're all very familiar with Paul. Paul, welcome back to a stormy South Africa. Hope you're enjoying it. A little bit more of London that you're getting here today, aren't you? Conrad Wood from Aluwani Capital and Adam Frolin from 91 Investments.
Where's Adam?
Right, we all here. Thanks, Adam. Thanks, gents. Enjoy.
Thanks, Eugene, and thanks, Tanya and the team for having us. I'm Rudolf Horn at Martin Optimal, and excuse my husky voice today. It's the winter fading into me, and not my golf. Maybe it was related to the golf over the weekend. In 26 years in managing DFM portfolios, the most fascinating thing for me is to understand and to accept the challenge of blending fixed income managers in a portfolio that delivers a potential good outcome in sharp ratio returns and inflation plus 2 to 3 performance. And what's interesting, and probably the debate that Jacques de Kock, my colleague, and I have most, is to fit these funds together, because on a Morningstar or profile data output, you may actually find that the performance are the same or the volatilities are the same, but they're actually underlying in terms of its components very different. And today, to my left, I have 3 fund managers. All have done really well in their respective mandates, but all very different in terms of the way they manage fixed income and how their funds are populated. And if my voice today fails and there's no questions from on the iPad, I'm sure Tian and Rian will ask questions. So who's first? Adam?
Yeah. Good afternoon. I hope we're not keeping you too far from lunch, but I'm going to give you an update on the South African fixed income outlook and what lies ahead for investors in South Africa. So starting off, I think you can't ignore what is happening in the Middle East. And if I think back to the beginning of this year, I didn't know where the Strait of Hormuz was. And you know, since March, between March and April, we are talking to our commodities analysts, our oil analysts a lot more to try and understand what is going on in the global oil market. That being said, you know, we can't predict the future, as was said on the previous panel. And you know, one thing worth noting is if you look to the right-hand side of this chart, is that markets do tend to look through these type of shocks. You know, in history, post big oil crises, you know, 6 months forward, you know, market returns were positive. And that is already ringing true today. If you look at equity market returns post the war, they have made new all-time highs in certain sectors. Certain areas of the credit markets are back to the levels that they were pre the war. But one area that is quite interesting, and I think makes a lot of sense that it hasn't recovered fully, is fixed income markets. Local currency interest rates are now starting to worry about inflation. And that's, you know, that is going to be a theme over the next 6 months, over the course of the rest of the year, is what is going to be the inflation impact of what we're seeing with oil prices north of $100. When thinking about January, we were seeing oil prices in the low 60s. So that's a significant increase in petrol prices. We're already experiencing it in South Africa. And I'm going to try and unpick what this oil price shock is going to do to our local economy. So before I go any further, let's talk about what's been happening with the Rand. And if you think about the South African Rand and how its behavior has been in previous global geopolitical shocks, I would say that the South African Rand has actually behaved very well in this environment. So what you're looking at here on the screen is our terms of trade in orange. So that's the price of our exports minus the price of our imports. And you're looking at the currency, the South African Rand relative to the dollar in green. And what you'll notice is over the course of last year and the beginning of this year, our terms of trade were doing extremely well. The price of our exports were going up, gold in particular, as well as platinum group metals, that drove that orange line higher. And you can see that that was a large part of that currency strength we experienced over the course of last year. Obviously, all the local idiosyncratic improvements we had in South Africa also benefited us, but you can see the fundamentals on the chart. The price of our exports were doing well. The price of our imports, oil being a big one of those, were quite stable. And that meant that the rand actually enjoyed the flow dynamics in that environment. More recently, you can see the terms of trades have pulled back off the highs. That's due to the rise in oil prices. And the rand has followed pretty much in line with what it's expected to do. Generally, in these type of environments, the rand being the most liquid currency in global emerging markets, it's often used as a hedge because it has that excess liquidity. It hasn't underperformed what you'd expect, and we think that is quite a healthy place for the rand to be. Sitting at 1640 around about there this morning, we think it looks quite reasonable. So, what does that mean for inflation in South Africa? This chart is quite outdated. Things are moving quickly. So on the right-hand side, this is our sensitivity matrix. This is average inflation for 2026. You can see at the beginning of the year, we expected inflation to be 3.8%. That's assuming an average oil price of $87 per barrel over the year and a rand of 17. We're now moving much lower, particularly on this matrix, because oil prices are getting to $100 a barrel. You're likely to see inflation average close to 4.5% over 2026. As we all know, we have an inflation target now of 3% in South Africa, not 4.5% anymore, and we do expect the SARB to react to this rise in inflation. So base case expectations, 2 to 3 rate hikes over the course of this year. This is all very dependent on how quickly this war can be resolved, and then what happens to result in oil prices after that fact. But we have an MPC meeting coming up in May. The market expects a 25 basis point rate increase at that meeting and expects 2 further rate hikes over the course of this year. That is the SARB reacting early to an inflation shock to stop having to go further and more aggressively later if they wait to see second round effects. The governor has been telling us this. Moving on to the fiscus. As we all know, the fiscus provided some relief to consumers in the form of the fuel price levy. So they've reduced the levy or given a holiday on the fuel price levy of 3 rand a litre over the next 2 months, and that will be half the amount, 1.50 rand a litre in June. That will be removed in July. The cost of that to the fiscus is 18 billion rand for the year. As we know, in March, we received the budget numbers for March. The budget numbers already exceeded National Treasury's expectation by that amount, 10 to 20 billion. So it is currently fiscally neutral. They've given that money back to the consumer. But to the left-hand side of this chart, what we haven't seen come through in the numbers yet is the taxes and royalties from the mining sector that we expect to come over the course of this year. So PGM prices, gold prices at all-time highs or close to. To the right-hand side, this is our commodities team at 91. They're forecasting the taxes coming from these companies in the mining sector. That's 100 billion of taxes to be paid over the next 2 calendar years. Those are not yet in the budget numbers. So there is space within our fiscus to absorb the sort of shock that we're experiencing at the moment. And that gives us a nice buffer in place for the Treasury to do things like provide relief on fuel prices and not actually deteriorate our creditworthiness. So what lies ahead for South African bonds in the context of rising inflation, an okay fiscal environment, and a very uncertain oil price market? So I think we're all kind of caught up in what is going on in the Middle East, and we forget what is happening in South Africa in an idiosyncratic basis. So there finally has been some good wins for the country. If we think about, don't take my word for it, think about what external agencies are thinking about us. From a credit perspective, our creditworthiness has improved. S&P upgraded us. They kept us on positive outlook. That was a big surprise. In terms of governance, we've been taken off the grey list. We've been removed from the European high-risk list. So, they view our governance as, improved. We can actually prosecute financial crime in this country. From a SOE perspective, 3 years ago, we were worried about grid collapse. We now have Eskom posting financial profits. Energy availability factors are much better. Load shedding is a thing of the past. The most important one we're watching, looking forward, is what is happening in the network industries. The Transnet turnaround is gaining momentum. I can't say it's done and dusted or it will happen, but what we're seeing is public-private partnerships are being embraced by that sector. We're already seeing the ports at Durban, ICTSI, spending money there to upgrade those ports. This is critical to our economy to benefit from these higher commodity prices that we're seeing. We need to have the ability to export, the ability to transport commodities across the country to the various ports, and that will then allow the mining sector to actually expand output and improve GDP growth. So the commodity sector has been that boom for the rand. That's allowing debt consolidation to happen a bit faster than we originally thought. And then finally, the cherry on the top for a fixed income investor. 2 years ago, you expected the Reserve Bank to keep inflation at 4.5% over the next 10 to 20 years. So when you buy a 20-year bond, you're happy with 4.5% inflation and your yield above that. Last year, they told us inflation over the next 20 years, we're going to actually keep it at 3%. So that's an additional 1.5% real return in your pocket as a bondholder. And that really was the cherry on the top last year that led to such a significant rally in South African government bonds. So what you can see on the left-hand side, that's the All Bond Index total return over the last 5 years. You can see 2025 was an outstanding year for government bonds, 13.6% in capital, 24% total return. And that was all those factors coming into play. It was a perfect storm of strong commodity prices, falling inflation, an inflation target change, and also some reform momentum with the government of national unity. And all of that played into the hands of a lot of risk premium priced into that bond market. So looking forward, is it all in the price now? Is it time to take profit on South African government bonds? On the right-hand side, the SA 10-year, it got down to the lows of close to 8%, but as we sit here today, it's hovering around 9%. That is still a very attractive income or return or yield for an investor. Looking at, if you trust the Reserve Bank, which I do, they've built up credibility significantly under the current governor, and that means on a 3% inflation target over 10 years, that's a 6% real yield. Very attractive. Cash rates are at 6.75. We expect them to increase in the short term, but you're still earning a significant premium above cash. So over the medium term, I would expect bonds to outperform cash, given where current yields sit. So with that in mind, how are we positioned in the 91 Diversified Income Fund? This fund tries to participate in bond market upside and protect capital on the downside. We are neutral in government bonds at the moment, with a lot of our duration longer out on the curve, not shorter, because in the shorter end of the curve, we are much more sensitive to inflation shocks that we are currently experiencing. We've included inflation-linked bonds in this portfolio to benefit from rising inflation, and we have exposure to listed property and US dollars in the fund that diversify returns quite nicely. Overall, the portfolio yielding 8.5% roughly. This is slightly out of date, and a very well-positioned portfolio to benefit from the higher yields that we're seeing in South African government bonds. Thank you very much.
Thanks, Adam. Conrad, over to you. I believe you're talking about a new world order coming up here.
Thanks very much to BCI for the opportunity. So I figured that on the panels over the next couple of days, there's going to be enough sort of detail on the minutiae of fixed income markets and whether they're going to hike rates at the next meeting. So I'm going to just pull out a little bit to maybe 10,000 feet and just take a much more slower moving sort of macro look at what potentially could be coming down the turnpike for bonds. And a spoiler alert from the title of the presentation, it could be challenging. So if we start with a graph of US inflation, and you would have heard the cliche that inflation is a fixed income investor's worst enemy, and that is true to a certain extent. You know, rising inflation eats away at the real purchasing power of that fixed coupon that you're getting. So it matters a large deal for bonds and fixed income investing on what inflation does. In fact, arguably that's the most important variable for a fixed income manager to consider and to get right in a portfolio. And this graph of US inflation just shows you the dramatic tailwinds for lower inflation that we've had over many decades now, moving from an average of 5% in the 80s down to 3% in the 90s, and then into the new millennia, the average was 2.5 over the early first decade, and it's been 1.77% and very, very stable at those low levels over the last decade. And that has largely underpinned what have been fairly attractive returns from bonds and from fixed income asset classes globally. There's something going on in the current decade, which I'm going to get to and I'm going to touch on in the gist of my presentation. The massive move down in inflation and the re-rating of fixed income securities as a result has happened largely on what we would loosely term an era of abundance. If you look at all the inputs that go into economies and processes and manufacturing that drive inflation, they've all been in a massive abundant supply over the last few decades. And once you have an abundance of something and a lot of something, the price of those things comes down and it drives inflation lower. So we've had an abundance of money, cheap money at low interest rates, large quantities of it. We've had surplus capital. We've had excess investment. We've had declining savings. We've had very cheap labor coming through the Chinese sort of integration into the global economy. We've had cheap energy and cheap resources due to overinvestment and overcapacity in the world. We've had cheap goods coming out of China. Never before have we been able to buy consumer goods at such cheap levels as what China's been churning them out. We've had easy trade, frictionless trade between countries and economies around the world. And maybe two factors that are less sort of tangible to measure, but we've had an abundance of trust. We've had a peace dividend, if you could argue that. And through the lens of globalization and sort of interdependence in the global economy, this has resulted in a massive supply shock. And not the supply shock with negative connotations, a supply shock that has been disinflationary. And this era of abundance has brought inflation down to almost record lows and record levels of stability. And South Africa's been no exception. Our profile of our inflation is a little bit more volatile, but largely we've made the structural move down from 6 to 3 over this period, taking advantage of many of these drivers of this era of abundance. And as I've said for fixed income, very important, once that inflation risk premium gets taken out of yields or gets reduced dramatically, as in what's in the level of yields, your fixed income instruments benefit. And the chart on the left shows you just how much the inflation risk premium that has been embedded in South African yields when we were at 6%, how much has been taken out, and that's at record lows since the global financial crisis, that our bonds have benefited from a compression in inflation risk premia. And that's delivered substantial returns from fixed income asset classes in the table on the right-hand side, with bonds beating both cash and inflation by record amounts and even double digits over longer periods of time, which is absolutely unheard of in the local fixed income market. Now, this era of abundance has had consequences and will have consequences. So we think, the yields or the cost of capital has at times got very, very low and arguably way too low. This has resulted in excess consumption. It's resulted in unproductive and excess investment. And it's resulted in a lot of structural imbalances that have developed around the world. And we are not, in our view, well positioned for an unwind of this era of abundance and this era of excess that we've enjoyed. Moving forward, we look like we are likely going to have to deal with the consequences of that unwind. And we've loosely termed this an era of shortage for the next decade, to thumbsuck a time period. And it's almost a mirror image of the era of abundance that's caused this massive compression in inflation that has uplifted fixed income returns. Almost all of the variables I showed you have flipped around. So there's less abundance, less supply, less quantity of money, floating around. The price of that is going up. There's a shortage of capital. There's a shortage of investments. There's excess savings, shortage of investment, and we need massive investment at the moment in the world economy to deal with some of the spend and the infrastructure spend that needs to happen. There's a shortage of labor. Now that the Chinese sort of dividend has come through the market, labor is resorting or is experiencing headwinds from demographics, from immigration policies, and from a rebalancing or a change in China, which has increased the price of labor and has reduced the quantity of labor. On the resource side, commodities and energy, the tide has also turned there. After an era of excess and abundance and excess capacity, there are now shortages of resources, shortages of commodities, and shortages of energy. Onto those last two sort of more intangible ones, there's been a decline in the amount of trust globally. More friction is built up in trade and supply chains and how we do business in the world. And that's resulted in increased frequency of shocks. And these shocks are creating uncertainty and creating periods of sporadic spikes in inflation. So those same factors, moving from abundance to shortage, through a lens where the world is deglobalizing instead of globalizing, breaking up that interdependence, and you still have a supply shock, but this time it's a negative one, and this time it's an inflationary one as opposed to a disinflationary one. So globalization is a good thing when it's working. It's not such a great thing when it breaks up. And we've spent a decade or more in the top left of this chart where we've reaped the benefits of globalization, like innovation, like investment, like economies of scale. But arguably we're in the bottom right now where some of those factors are unwinding and becoming a little bit more challenging, where we've built up massive inequality, we've built up threats to individual sovereignty, and this interdependence and frictionless trade in the world is gradually breaking down, and it's leading to things like protectionism, like nationalism, like anti-immigration policies, and the increased need for defense spending that is being ramped up. The other factor that I touched on relating to the labor market is demographics, and this is the so-called global graying, or the population is getting older, particularly in the developed world and even some of the emerging market countries. And the graph on the left shows you in the US, the dependency rate of the population. So if you go back 50 years ago, there were 6 or 7 productive working people that were supporting every one that was not working and was unproductive or retired. That's come down to currently 3, and by 2050 it'll be down to 2. So there's this over-dependency of people not working, people not being productive and being supported by less resources that are productive. And this is as a result of falling fertility, of increased life expectancy, and a mismatch in the skill set between the type of work that people are able to do versus the type of work that economies need to be done. The chart on the right shows you in the US, the falling population growth rate, and this has been supplemented by immigration, which is now changing dramatically and is falling off the edge of a cliff, and will no longer subsidize the US population growth rate like it has done. And in 2035, in fact, deaths in the US are forecast to exceed births, and that population actually go into net negative growth. On the resource side, we mentioned years of investment and capacity that got built up with Chinese demand and Chinese industrialization. This has changed quite dramatically, and the chart on the left shows you capex rates relative to depreciation and how those were at about 2.5 to 3 times during the commodity boom and during the go-go investment years into commodities. Those have fallen dramatically down to 1.5 times as return on investment and incentives to invest have come off quite substantially over the last couple of years, creating potential shortages as we go into this increased infrastructure and investment boom. On the right-hand side, it shows you another acute area of the resource or the commodity market where China has essentially cornered vast majorities of the world's production and extraction of rare earth minerals. And on the right-hand side in red, the refining of those rare earth minerals into the end state that they need to be used in the manufacturing of almost most goods on Earth. We hear a lot about them for defense and for AI chips, but they are very prevalent in a much broader set of consumer goods, and China has totally cornered that market from a monopoly perspective. China itself is going through a massive rebalance that we think will have profound impact on the inflation outlook for the world. And as it has been a major disinflationary force over the last few years, it's going to turn to be inflationary over the next decade or so. They need to rebalance from a production and manufacturing and exporting-led economy into a consumption economy. They have an anti-involution policy, which is just a fancy word for saying we can't continue just to churn out all this massive excess capacity and have prices come down. We need to move up the value chain. We need to unwind this involution that's happened in the economy. And you can slowly see on the left-hand side, Chinese PPI is starting to trend up. And on the right-hand side, their manufacturing output and their production is starting to roll over. Exactly the opposite forces of what has driven the big Chinese disinflationary force over the last few years. One that's going under the radar, but it looks to us like all of Trump's policies that he's implemented have been inflationary or are inflationary. And they won't come out and say this directly, but it looks to us like they are targeting higher inflation in the US, and the reason being because of their massive debt burden. And they first came out and said that they would almost shrink that debt, and they would implement Doge and cuts in spending, and that they would shrink the level of debt. And they quickly realized that that's impossible to do with the demands on that US economy. So they've now gone to the other side of the spectrum. They are going to goose this thing and run it as hot as they possibly can to generate inflation, to deflate the level of the debt burden that is hanging over America and threatening its insolvency. And I'll finish off. This stressed environment leads to shocks, as I've said. There's plenty of evidence to show that the number of conflicts is rising, the stress index is rising, and the number of countries on the right-hand side in blue that are spending increasing amounts of GDP on defense is rising quite substantially, leading to the weaponization of a number of factors. Lots of countries have control over different factors, and they are weaponizing those in order to leverage their power in the world, sort of bilateral relations at the moment. So commodities are being weaponized by China on the rare earth side. Supply chains weaponized by Russia, who stopped supplying oil and energy to Europe. Currencies, the US is weaponizing the dollar, and it goes on to technology, security, etc. The one unknown and the one controversial factor, I think, is AI and how that fits into all of this. So we hear the argument a lot of, well, are we just going to have AI? That's going to increase productivity. It's going to be dramatically disinflationary, and it's going to offset all this era of shortage and the upward pressure on inflation that I've been going on about. We don't quite see it as simple as that. We definitely see the initial phase of this AI rollout as being demand-driven or a demand story. The build-out of the rollout is going to be inflationary. Building all the capacity, doing all the investment is going to be inflationary. Then comes the supply side or the adoption side, and that's meant to be where the disinflation kicks in. But the interesting sort of opposing view to that is that in an economy that has has rising productivity, that almost begets growth, it almost begets spending, and you can argue that the higher levels of productivity will result in higher levels of trend economic growth and actually require higher interest rates, not lower interest rates. So I think the jury's out on AI and its role that it'll play in this era of shortage that we are going into. So just to wrap up, we're moving from an era of abundance into an era of shortage. In our view, this is likely to be an inflationary environment and is likely to add 1 to 2% onto global inflation for a number of years to come. The irony is right at this time, we have moved our inflation target to 3%, which is the lowest inflation level that we've ever really sort of attained, and we've never really stayed there with any sustainability. And wouldn't it be ironic and quite sort of depressing, actually, if right at the time global inflation was going into an upward cycle for a decade, that we've moved our inflation target to the lowest level and would be definitely leaning against quite strong headwinds. So we think the risk over the next number of years for fixed income asset classes is that the rising inflation risk premium will be increasingly needed to be priced into yields and into the shape of the yield curve, and all else being equal, this will place downward pressure on fixed income and fixed income returns. Thank you.
Good luck after that, Paul.
Thank you. Well, thank you. I can honestly say I think the weather actually showed up for me today. I spent 8 years living in London, and this very much reminds me of the good old English summer, although it's slightly warmer here than it is normally in the English summer. Anyway, so I've actually been speaking at these conferences for quite some time. And in the past, I've delved into the mathematics of portfolio investing and showed you some pretty cool stuff and nice distributions of potential outcomes, default probabilities, and all this. It's going to change this time. So this is going to be a very simple presentation. I just want to tell you that. And I'm going to be focusing on the why rather than the how. There's a lot of talk about how we do things and how we value companies. Maybe the question should be, why are you doing that? Why are you bothering? Why do you buy cheap? Why does someone sell cheap then? These are very pertinent questions that we need to ask. So anyway, I'm just going to ask the question, why don't we have more credit in our portfolios? So this is a great little quote I've got from L. Ron Hubbard, which we're going to dwell a bit about his other beliefs, but he actually stated the evolution of knowledge is towards simplicity rather than complexity. What I've got there is the Raptor 1 engine, a rocket engine, which is used by SpaceX, by the greatest South African, Elon Musk. In 2019, that's what the Raptor 1 engine looked like. Very complex piece of equipment. Lots can go wrong in it by the looks of things, lots of little things to break and stuff. Look at the Raptor 3 in 2024, a much more simplified engine. Less can go wrong in it. More efficient, much more efficient rocket itself. The bottom line is, to get to simple, you have to start with incredibly complex. And that goes for even putting together portfolios of assets. You start very complicated and get very simple as time goes on. So just bear that in mind. So my contents, I've got a couple of things. I'm going to answer the first three, the three most important questions: returns, risk, and correlations. That's all I'm going to sort of talk about. Anyway, let's go back a few years. This was my opening slide for our conference in 2018. This is what I thought the risk things that were going on in the world at the time. And we've got the Eye of Sauron, which could be your telephone or your mobile phone who's listening to absolutely everything that you say. I've got a little AI guy at the top. I've got the Middle East. This is directly from that presentation, by the way. I've got Kim Jong-un. I've got Jeremy Corbyn, obviously, one of the most dangerous people on the planet. We've got some terrorists in the bottom left-hand side. I've got old Donald Trump talking to Putin, and I've got the potential of bubble bursting, as well as a US aircraft carrier. Jump forward to 2025. The only thing that actually changes is the fact that we've got two-tier Keir and Rachel from accounts there, who's replaced Jeremy Corbyn. But everything else is exactly the same, isn't it? Jump forward to 2026. Again, exactly the same factors of risk, I would say, for investors. The only thing different is that Kim Jong-un, with his nuclear capability, has been replaced by Iranian nuclear capability. And obviously their ability to shut off the oil coming through the Strait of Hormuz. But again, very similar. Yeah, basically the same sort of story, which is quite interesting, in my humble opinion. Anyway, so let's have a look at returns. Last time I spoke, the equity market has actually rallied 35% since our last May the 18th, I think it was. 35% in equities over the last year. Bonds have done 23%, and cash has done just over 7%. Bottom line, everybody makes a big noise about Donald Trump. Goodness gracious, 2025, the top 40 total return index delivered 47.6%, coming off a high base already. Phenomenal returns. The bond market produced 24.24% last year. Phenomenal returns. The end of February this year, they produced over 28% year on year. That's the best 12-month return in history. It's been a phenomenal story. Since that time, by the way, as well, the NASDAQ is up 41%. Think about that for a second, 41%. Goodness gracious, we want more global wars on tariffs, don't we? So here we go. So we've got equities, which have done incredibly well. The Albi's done well, and risk assets have done well. If we look at excess returns against cash, I generate this since March 2007. We should be interested in averages, long-term averages. Otherwise, we're just speculators, right? Having a go, making a call on this, making a call on that. We can't forecast the future. We also agree with that, but we can forecast the short term, apparently. I don't know how that works, but anyway. So I like to look at long term. Equity returns through the long term have been 4.1% per annum since 2007. That's 19 years of data. That's statistically significant numbers. Albany has returned 2% per annum on average over cash consistently. That's what it's done. By the way, if we actually look at what the US has done, the US has outperformed cash, I'm talking about US Treasuries, by 1% per annum over the same time period. So we've produced 2. There we go. I thought this was supposed to be about credit. Well, let's actually just superimpose credit into these performance numbers. So here we go. So I like to use the iTraxx crossover, which is a European, well-diversified, sub-investment grade credit index. And a lot of people will say, well, that's a bit risky, isn't it? Well, South Africa itself is sub-investment grade, so there we are. At the end of the day, just look at the graph. It's actually outperformed equities over that period. That's hedged, by the way. So I hedged the currency by using short-term interest rates, blah, blah, blah. Don't worry about that. So there we go. It's outperformed. So it's produced an alpha since 2007 of 4.1%. And it's done it more stable. Yeah? It's pretty good returns. Let's have a look at risk quickly. Well, if I take those returns annualized and look at them versus the risk or the standard deviation of quarterly returns over that period, I get that. So we've got orange being the STEFI or cash, top 40 being the green one, and Albany being the blue one. Interestingly enough, they've got the same Sharpe ratios. You can draw a line through it. You want to dial up risk, you dial up return. Simple as that, over the long term. You want to take more risk, you're going to get better return. You want to dial down, you just dial down your equity component. Perhaps the question we should be asking is, over the long run, why won't we just have 100% equities then if we're after just pure returns? Yeah, it's an interesting sort of question. So where does credit sit? Well, credit hedged, European credit hedged, produces a high return for just over half the risk of local equities. That's a phenomenal number, by the way, and a much better Sharpe ratio. Correlations. This is an interesting one. So what we're looking at here is we're looking at the quarterly returns of the ALBI, shown in orange, the All Bond Index, and the top 40 equities, top 40 total return index. So there's what we look at. Certainly risk is uncertainty. You can see the blue line is a lot more risky or uncertain than the orange line. Those are quarterly returns. When you actually have a look at correlation between them, I actually like to look at them in 2 different times. There's a pre-COVID and a post-COVID. Pre-COVID, the correlation between the All Bond Index and the equity market was negative 0.27. So if you had put together an efficient market frontier and put together done all your work and what sort of weightings you should have, post that time, the correlation has just literally gone from negative to positive 0.74. That's quite a big number, by the way. That's a big change. So all the work you do in putting together your balanced funds and what proportions you should have for a given risk profile, throw it out the window. It's all been a complete waste of time because this in itself is incredibly volatile. When we have a look at the iTraxx crossover hedged, it is a lot more stable. Yes, it's gone up, but nowhere near to the same effect. By the way, the average over this entire period is 0.68. The average over the last one was for Albany versus equity was 0.28. So you can see that the correlations are a lot more stable for credit than what they are for the All Bond Index, which should help you develop efficient portfolios. So to conclude, let's conclude with some conclusions. Yes. This time it's going to be different, okay? Yet again. Every single year it's different. Every single year it's sort of the same. The returns differ, but it's sort of the same risk factors. All of it's there. Credit is an asset class, okay, has performed a lot better than anyone would have ever thought. Everybody likes to point like a boogeyman at credit is too expensive. Ooh, it's too expensive. Ooh, be careful. There's going to be defaults. Ooh, yeah, thank you very much. Absolute rubbish, right? I mean, it's outperformed equity, for goodness sake. Yeah, there we go. Right, so, and not only on top of that, not only is it outperformed, but it's outperformed at less risk, so better Sharpe ratios. And that's what we should all be maximizing, is Sharpe ratios. That's what we should really be doing. Credit quality return correlation, it shows stability. Now, why is stability a good thing? Because you can plan with stability. You can't plan with instability. Investments, I read this morning, when someone suggested investments should be boring. You should be you should be grinding out performance. It shouldn't be this hit and miss. Let's have a go. Let's switch this. Let's do this back. No, you want stable returns and stable portfolios, I would argue. Unless you like that sort of thing. I mean, some guys like that sort of thing. I mean, not really me, anyway. Right, so what I like to conclude with at the end of the day, my very last things, is keep things as simple as possible. Remember, we're not investing for the next year. I heard this previous speaker saying he thinks in decades. And I think that's the right approach. Think over the long horizons and put your portfolios together for the long horizons. Otherwise, just speculate and invest in some hedge funds or have a bit of a go long short, like do that and do it properly. But investing should be for the very long term. I just worry that sometimes it would appear that it isn't. Thank you. That's me.
Literally from the one end of the world to the other end of the world. I've got Michael Philpott asking a question which I was going to ask you, Conrad, but he does it much better than I. He's asking, since you expect a high risk of an increase in global inflation, that could push up South Africa's inflation rate, would you suggest an increase in inflation-linked bonds or possibly supplemented by floating rate bonds, variable rate bonds, rather than a long-term fixed rate component in a portfolio locally in South Africa?
I think that sort of sentiment is largely going in the right direction, but I will just sort of make the point, though, that my horizon that I spoke about is over multiple years, if not the next decade. So it was more a theme than something I expect to happen in the next year. And our fixed rate bonds are at very elevated levels of yields and a very steep yield curve. So if you go into floating rate bonds now in anticipation of a big global inflation, it could take a year or two of earning 7% before the actual resetting or re-rating does come. So, I think timing is everything, and don't throw the baby out with the bathwater. I was just highlighting that inflation risk is something that's coming down the turnpike over the next couple of years. Inflation-linked bonds are quite a tricky one, and I think the almost the default view on them is, well, where you must buy them when inflation's going up. I can show you many, many times when those things have underperformed while inflation's going up. And it's because their yields move. If yields move more on the nominal side than what inflation is going up, your real yields will rise. And rising real yields will detract from the returns of ILBs. So yes, buy them in a rising inflation environment and have them in a portfolio. But if the environment coincides with higher real yields, that will subtract from the returns, and they might just surprise you in terms of that they don't perform as well as one would expect. But in a rising inflation environment, I think it is a good premise to have some in your portfolio as a protective strategy.
So what's your predominant asset exposure in your fixed interest fund at the moment?
Yeah, look, at the moment, I'm still very comfortable with nominal bonds. I think Adam's touched on the environment that is, driving the prospects for nominal bonds. I just think, we could enter a period where the returns are more sort of running yield and income type driven rather than these massive capital gains that we've enjoyed over the last couple of years, and then increasingly facing the risk of higher inflation in the next couple of years could mean that, the previous 8% level that we got down to on 10-year yields might need to be something more like 9% or 9.5%, whatever the numbers, happen to be. But I'm still very comfortable holding nominal bonds as a predominant asset class in a fixed income portfolio.
Thanks, Conrad. Adam, moving on. I mean, you're part of the 91 credit team for South Africa and Africa. And 91 has a lot of credit in their portfolios. Talk to me about the type of credit you have. Is it like banks? Is it corporates? Is it those that are not marked to market, because there are commentators in the market that fear that some of the funds that we all are exposed to some credit-linked notes that are not market to market. So talk to us in terms of what you hold, and are those risks real?
Yeah. So if I'm talking about the 91 Diversified Income Fund, as well as our high income portfolio, which is a pure credit portfolio, we are invested in South African investment grade rand denominated credit. And that is names that you'll be able to touch and feel, interacting with the economy as a consumer. It's your large banks make up a big part of it. It's your blue chip corporates. In the retail space, it's Woolworths, Foschini. In the property space, it's Growthpoint, Redefine. In the telecom space, it's MTN, Vodacom, Telkom. It's names that we all know very well. It's very large businesses, and in some instances in South African credit, not all of these, blue chip counterparties come to the bond market. Some of them don't borrow in debt capital markets. They borrow from the banking sector, and we can then access that credit through banks via CLNs. That's what you refer to as those instruments being illiquid, mispriced. That is, I think, dependent on the manager. At 91, within our credit process, we have valuations committees. We reprice assets when there are material credit changes, and that ensures that a portfolio, especially unit trusts, that our collective investment schemes need to be accurately priced at all times, and we ensure we do that periodically to revalue assets.
I'm going to come back to you on SA listed property, because nobody here to this point has really talked about it, but I'm going to come back to you. First, I want you to respond in terms of your portfolio and credit. And you've been very well, you've put it very well over many years that credit do default from time to time, but look at the long term, look at the total returns. You want to respond to that question?
Yeah. Okay, so just let's put things in perspective here. I'm not just a credit manager, okay? I'm a rates manager as well, and I'm a hedge fund manager, so I do all of them, yeah? But the unit trust that we're specifically talking about today is the Fairtrade BCI Income Plus Fund, right? So that's the one I'm going to talk about. I mean,
yes,
because I'm actually also, if you look at a hedge fund, we're running long interest rate risk at the moment, which means we're positive on domestic bonds. So I just want to say that, right? So that's quite important to start with. So I'm not here to trash bond fund managers,
sure,
because I'm one, right? So let's just talk about the Income Plus Fund and what it's trying to achieve and how it manages to achieve it consistently. That's probably your question. So we have got a target of 3% over STEFI, benchmark is 2% over STEFI call per annum with low volatility. So we're trying to create that with a Sharpe ratio in excess of 1. What does that mean? So we're trying to produce alpha of at least 2 with a risk of less than 2. That's the way you think about it. So we've done better. We've done basically STEFI call plus 3, and we've done a Sharpe ratio of 1.7. Yeah, so we're quite comfortable with that. How do we manage that? Given that all bonds generate standard deviations or risk of around about 8% per annum, we're generating sub 2% per annum, 1.7% risk per annum is what we have produced in that fund. We've done it through just investing purely in floating rate notes. So it's basically cash deposits plus a spread on top, all credit-linked instruments. And yes, your question, have we had defaults? You're bloody right we've had defaults. It's part and parcel of what we do. Yeah, but what we ensure is that when we have defaults, they're so small that it's irrelevant. It's irrelevant. It's a small number that's easily sort of put to bed with the excess returns that we've been generating over that specific period. So that's what we've done. I know there's a lot of sort of other credit managers out there who run large positions, who think that they can, let's talk about that for a second. A lot of people think that credit is everything but government. I actually say that's absolute rubbish. Credit includes government. The government can default, right? And it's not a question of when it's going to be. It's not a question of if, it's going to be when. It's going to happen. In fact, if you have a look at the sell-off that we have actually witnessed in the South African bond market year to date, it's actually been it's actually been a term to maturity sell-off rather than a credit risk sell-off. The credit risk of the South African government's actually come down in South Africa rather than increased. I've got some charts that can show that. So we see, and we do invest in the South African government, funnily enough, but in floating rate notes. When we see nice spreads in the floating rate notes, we'll buy them. We'll buy treasury bills. So we will never invest in the South African government. That's absolutely not true. When they offer value in floating rate space, not in interest rate risk space, we'll buy them. So
thanks, Paul. Thanks. We have 2 minutes left. I really want to touch on SA listed property. It's part of the 91 diversified income portfolio. As a diversifier, you mentioned, property's done well over the last, it's recovered well over the last 2 years, and those companies have restructured themselves. Loan-to-value ratios are looking a lot better than 2018 and 19. Your outlook in terms of SA listed property in a, call it, mildly inflationary environment, which both of you mentioned?
Yeah. So, the starting point for my view on SA listed property is that, I'm a South African bond bull. I think there's, a lot of risk premium in our government bond market, and property is tethered somewhat to the bond market. So when you think about listed property at the moment, the sector pays a dividend yield of 7%. And the big change in reform in that sector post-COVID was a switch from 100% plus payout ratios to 80 to 90% payout ratios. So your 7% dividend yield is actually a 9% funds from operations yield that you're earning in that sector. So, that is already an attractive inflation-beating yield that the sector gives you. And then on top of that, our analysts at 91 are expecting 6% growth in dividends, projected over the next 2-year period, compound annual growth. So that's, as rental escalations come in, they're contractual in nature for a large part of the sector, and you will see those, those earnings rise as the sector does that. On top of that, names we pick, names we favor, the likes of Vukile, have large and growing offshore operations in, Europe that, offer very attractive yields for developed market type risk. So from that perspective, we think the South African listed property sector can likely outperform bonds, and in some aspects actually does have that inflation protection built into the sector as you have those rental escalations cooked into your earnings.
Thanks, gentlemen. Before we break for lunch, any questions from anyone? Any fixed interest manager that wants to challenge the views or the components of portfolios? Nobody wants to put their hand up, it seems. Tian, you also happy? You want to go and have lunch? No comment? Over to you, Eugene. Thanks very much, gentlemen. Thank you for participating and answering so well. Thanks.
Gentlemen, thank you very much. Just before we break for lunch, Dan, who's running from Excel Academy, who's running our online session and a lot of stuff that you get online and the content, wants to come up very quickly with another gift as per usual, but this is a skill set gift that you really need, especially with all the stuff we've been talking about now. Dan.
Okay, let's unmute, assuming you can hear me nice and clearly and see me. Thank you, Eugene. All right, I'm hearing a bit of echo, but I'm sure it's okay.
Yeah, got you.
We've been running the Zoom for BCI over the last few years, and every year we actually offer a free gift in the form of a free masterclass live on Zoom. And for many years it was Excel. Now we actually have been training people on how to collaborate efficiently, effectively, and responsibly and safely with AI. So we've got a session next week. It's Tuesday morning, the 19th of May from 10 till 11 South Africa time, live on Zoom. And I'm going to actually share my screen so that you've got the QR code, and we'll put the link to register in the chat as well. Simple, should take about 30 seconds just to give us your details. You'll get a confirmation link. And we're going to be looking very, very practically at the mindset shifts, the habits, and the practical day-to-day use of AI. So very, very exciting indeed. And I hope to see all of you there. And yeah, as I said, I'll put the link in the chat as well. Thanks, Eugene. Over to you.
Our next session is on domestic equity. And we had some comments already on SA equity, but we're going to take a little bit of a deeper dive into equity as well. Joining us on stage as the moderator for the session from In8 Invest, Lee Kohler. Lee, thank you so much for joining us. You're also no stranger to our conferences, so thank you very much for joining us here. And Jamie Jabdas from Vunani Asset Management and Mark Detoy from Oyster Catcher Investments. Ladies and gents, again, thank you for joining us here.
Thanks so much, Eugene, and thanks everyone for coming back after lunch. I know it's tempting out there. The weather's stormy, markets are stormy. But yeah, thanks for joining us. And for the guys online, we're gonna listen to Jamie and Mark with their presentations. And after that, please just send through your questions. Audience, I'll ask you guys if you have any questions as well. And we're finally on what I think is the most exciting asset class, domestic equities, the asset class that gave us monstrous returns last year, driven by it was resources mostly, and more specifically, sort of gold and banks as well. And when looking at the two portfolio or the two asset managers here, you'll look at the portfolios and you'll see some very similar views coming through. And generally, when I do these things, I ask and I do some work beforehand. I ask for them to give me the asset allocations, the positioning, and then I compare and contrast. I put it on a slide, and then we ask them, why are your views different? So we'll do that as well today. So kicking off today is Jamie Jaftis of Vunani, who will take us through her presentation.
Thank you, Lee. Good afternoon, everyone, and thank you to BCI for the opportunity to present to you all today. The core idea behind this presentation is a simple one. South African domestic equities remain priced for disappointment despite improving fundamentals. And the question I want to answer today is, does that gap present an opportunity? So if we start off with GDP growth in South Africa, the conclusion that we may draw from this graph may be a straightforward one. If we look at 2005 to 2007, South Africa experienced its strongest growth, while today GDP growth is closer to 1 to 2%. So on the surface, the economy appears structurally weaker than it was in the mid-2000s. But GDP is an outcome, not the starting point. And if we dig a bit deeper beneath the surface, the story becomes a bit more interesting. So one of the major differences between South Africa today and in the mid-2000s is the fact that I think the foundations of the macroeconomy is stronger than investors maybe appreciate. And so based on an analysis done on the data in these charts, we can see that inflation is structurally lower than it was in the mid-2000s. And we also know that the SARB has, or the National Treasury has lowered the inflation rate, so that has also anchored inflation lower. Policy credibility in terms of monetary policy is also improved. And interest rates, even though it's still moderately restrictive, is actually operating from a much more stable starting point. But the economy is not responding. And we can see that that's as a result of confidence being lower than what it was in the mid-2000s, as well as unemployment structurally higher than what it was in the mid-2000s. However, household balance sheets in South Africa are actually much healthier than they were in the mid-2000s, but consumers are not spending. And that's because the cohort of consumers that are able to spend has remained fairly stagnant given the high unemployment rate that we're seeing. So household balance sheets are actually healthier, but employment hasn't followed that to drive a broad-based recovery in confidence and consumption. I think important to also note is that relative to some of what we've seen in other developed markets, South Africa did not experience a post-COVID growth excess. Our credit growth was actually fairly subdued post-COVID, and so that actually lowers the risk of South Africa or consumers potentially experiencing a consumer or credit stress event. And that's very different to what you're seeing emerging out of the US, which I'll touch on a bit later. Another major difference between South Africa today and where we were in the mid-2000s is where the macro vulnerability lies. And so if we go back to the mid-2000s, the growth back then was largely driven by strong consumption growth, strong credit growth, and investment spending. And that led to imports growing faster than exports. And that resulted in our current account deficit widening, which you can see in the chart on the left-hand side. That also resulted in us being more reliable on foreign capital inflows. Relative to today, our external position is actually more contained because demand is weaker. And as I mentioned, credit growth has actually not, or it's been fairly subdued. And so you're seeing that the current account deficit has actually narrowed in recent years. So the risk has shifted from an external one to a fiscal one, where the South African economy is less vulnerable to external risks. But we are facing a fiscal one where you can see in the chart at the bottom of the slide, our government debt to GDP is quite elevated relative to the mid-2000s. I think 2 points to make on that. The one is that the rate of change in recent years has actually slowed down. So even though the absolute level is still high, the rate of change has slowed. Secondly, for some context, the US debt to GDP is actually in excess of 100%, but because they have reserve currency status, that's what's given them a bit of flexibility. But I think the question in our mind is also how long does that continue, given that we are in an environment or a more polarized global environment today. I think the last point just to make is that given that inflation in South Africa is lower and rates are lower, that not only bodes well for the recovery in growth, but also for fiscal sustainability. So then if we take a step back and we contrast what has improved since the mid-2000s relative to today and what hasn't, as I said, inflation is lower, structurally lower and more anchored. Household debt to income actually peaked during the mid-2000s at about 78%, and you can see it's now much lower at 62%. So household balance sheets in a much healthier position than they were before. And as I mentioned, the economy is less externally vulnerable. However, relative to the previous cycle, the economy still lacks confidence, it lacks employment momentum, and lacks investment. So today we're sitting with a more stable economy, but without the growth. And so your next question would obviously be, so where does the growth come from? Investment is the missing link in that story. If we go back to the mid-2000s, the growth that we saw in the mid-2000s was largely an investment-led boom that drove investment in infrastructure. It also drove employment growth, and it drove demand. And where we are today, that's different to where we were in the mid-2000s, is that government has put together, as some of you would know, Operation Vulindlela. And according to National Treasury, the reforms coming out of Operation Vulindlela could boost growth by up to 3.5% by 2029. Now, admittedly, the progress on this front is probably slower than we all would like. But I think the fact that the work that's being done is largely with private and public partnerships, you are actually starting to see some of that unlock of constraint in key areas like electricity, logistics, and infrastructure. And so with some of these reforms starting to take hold, we think that it creates a much stronger foundation for further investment going forward. And as I said, investment is that missing link that is needed for employment, which is one of the key differences with where we are today relative to the mid-2000s. So I've painted the picture of where the macro is in terms of South Africa, and that the foundations are actually probably stronger than many investors expect. But it's still important to look at what's happening in the US because the Fed still anchors global liquidity conditions. The charts on the slide are looking at where the US is at the moment. Obviously, headline numbers are still fairly strong, but I think the important chart to draw your attention to is the one at the bottom right, which I touched on earlier on in terms of credit stress emerging in other markets post-COVID because of credit excess. You can see in the chart on the bottom right-hand side, it's showing you delinquency rates in the US. And you can see where we are in some of those loan types, some of those credit products. We are actually at similar levels to where we were during the GFC. And so that speaks to the fact that even though the headline numbers in the US are still strong, we are starting to see some credit stress emerge, which is a very different picture to what we see in South Africa. As I said, household balance sheets are actually fairly strong. But I think the main point to make here is that with potentially the US going into a weaker cycle and some stresses starting to emerge, we could actually see the Fed cut rates, which would bode well for South Africa or for the SARB to be able to follow the Fed. So then, given that top of mind in the room is probably what's happening in the Middle East, I've included a slide just looking at, does what's been taking place in the Middle East derail this recovery story? And really, I think the key takeaway here is because our starting point was a much lower inflation rate that we started off with going into this conflict, I think it's more about a timing issue and not necessarily that it derails the fundamentals of the story. So where many of us were expecting the SARB to cut rates in this year, we'll probably see them hold rates. And obviously, the duration of this conflict is a large driver of that. But basically, we don't think it derails the recovery story because the fundamentals that we were starting with, we were in a much better position. So how does all of this tie into where the opportunities lie within the JSE? So a big part of our investment philosophy at Vunani is understanding the key drivers of investment returns over time. So the charts that I'm showing you is a decomposition of equity returns in the domestic market over various periods. You can see 1, 2, 3, 4, 5, 10, and so on. Now, we know that earnings growth is the largest driver of returns over your longer periods of time, and that's 10 or more years. But in the shorter term or in the near term, and that's in a 1 to 5 year period, it's really your multiple changes that have quite an outsized impact on your returns. And you can see, and Lee referenced that in his introduction, obviously we had a bumper year in resources loss. You can see in the chart on the left-hand side, a lot of that return is actually being driven by a re-rating. To a lesser extent, you've also seen a re-rating in property and financials in the charts at the bottom. But I think the most interesting one is industrials in the chart at the top right-hand side, where you can see that there's been quite a de-rating in industrials over the last couple of years. And that's really where we think there's an opportunity. Obviously, the recovery story in South Africa helps the earnings growth. But if we even not necessarily 5% growth that we saw in the mid-2000s, but even if we improve growth just marginally from current valuations, you can see the market is quite negative on industrials, and particularly SA Inc. within industrials, which we are more constructive on. And so that just shows you our positioning in the Vunani BCI Equity Fund. And you can see that this theme or our views play out in our positioning in banks, retailers, and listed property that should benefit from a recovery in South Africa, as well as we see opportunity in technology. That's NASPER's process based on attractive valuations and also selective exposure in resources. And then lastly, this is the Vunani BCI Equity Fund performance, where you can see we've outperformed over all meaningful periods, taking into account some of the views that I've discussed here today. Thank you.
Thank you. Good afternoon. I'm Mark Toy from Oystercatcher Investments. Yeah, very glad to be here after quite a bumpy landing this morning, but I'm here. So here to talk about SA domestic equities, and was March 2026 just a pothole? I mean, this is kind of as creative as I can get. We've got a graph of the Aussie there, and then we had a really great start to the year until the Iran war. And the question is this just a pothole, and can the longer term trends continue? So we always like to start the year off thinking about South Africa's known unknowns. Things like, does the GNU hold? I think by and large, it's actually been going better than what we expected. We think it can continue. We've got the municipal elections coming up in November. I think that that'll be a nice data point for us. We get to see kind of does the MK party make any progress, what kind of support there is for the ANC. I think it'll give us a clue for 2029, which is obviously a big election year for South Africa. Fiscal reform, I mean, we think it's been tough. It's been slower than what we all hope, but I think by and large, very positive. Project Vulindlela has been going along slowly but surely in the background. And you can, if you search Google for Project Vulindlela, you can get actually a dashboard that they update monthly to show you the progress on the reforms, which is also quite interesting to follow. We've had great terms of trade. So South Africa's been exporting, with the higher commodity prices, and we've had the lower oil price up until recently. So that's been contributing to rand strength. Obviously now that's off the table, and I think in the short term, we do have quite a big high oil price and higher fuel prices, which is like a bubble that we kind of have to swallow as an economy. I mean, our base case is that this is sorted out fairly soon, but still that bubble does need to be swallowed. Can we achieve the 2 for 2? So there's a international broker which likes to talk about the 2 for 2. When he talks about South Africa, can we do 2 years of 2% GDP growth? I think beginning of last year, 2025, we were very constructive on South African GDP, and then we had the tariff wars in April, which kind of derailed that year for South Africa. This year again, we started off with good momentum, and just remains to be seen, can we pick up that momentum post-resolution in the Gulf? And then, Treasury is looking to implement a fiscal anchor, something which I don't think gets a lot of airtime, but we've met with National Treasury, and I think, something that maybe is also not widely known is we have a fantastic institution in the National Treasury, really great people, and they're looking to implement what they call a fiscal anchor. So it's a more legal protection for South Africans against government overspending. And the question just is how much legal rights can they give to their bill? So yeah, I mean, the South African, thinking about a strong South African GDP environment. I mean, we like the banking sector. I think that post-COVID, the banks have done a fantastic job to manage their balance sheets and to manage the growth and the credit losses. We've seen favorable asset cycles, so that's the credit loss ratio coming down over time. That's probably closer to, that kind of cycle's largely played out now. And now what we're looking for is a pickup in lending to drive the next step in the South African banks' equity returns. Got much lower interest rates. We had stable inflation. Now we're going to have a bit of an inflationary impulse, but hopefully short-lived. We had improved consumer and business confidence. I think that as the reforms start to take shape, we've seen a big rollout in solar. I mean, load shedding. I remember when we talk about load shedding all the time. Now it's almost an afterthought. These things, have largely been solved. It's been positive for South Africa, and business confidence is returning. And with lower bond yields, I think that one thing that you have to think about is where do you invest your money? You used to be able to get a 10% return in a South African 10-year bond. Now you're getting 8% return, or a little bit higher at the moment. And so you start to look at other opportunities to make money, so other things to invest in. And also when you're thinking about South African equity, as you try and price it, you look at it relative to something like a South African bond yield. As bond yields come down, equity values go up. Also, something that we didn't have last year, which we have this year, is much higher PGM prices. So South Africa is blessed with 70% of the world's platinum reserves. Last year, we had a very subdued PGM price environment, low platinum price, low palladium prices. Started to tick up around about mid-year. There was severe flooding at the Amandelbult, which is one of Valterra's mines, constrained supply a bit in the market. Coupled with that, we had the European Union pushing back some of the EV targets, meaning that there'll be more demand for the metals. We have a bit of return to jewelry demand in China. There was the launch of the GFEX in China, which is a futures exchange. They launched platinum and palladium on the exchange. And that started to really tick up the PGM prices. Also, with the big gold rally, it pulled platinum price along with it. And I mean, at current prices, we're looking at 36 billion rand extra tax for the South African fiscus. It's not a very big number, but it's something that we didn't have last year. Of course, no investment presentation is without a Trump slide. You know, it has a big impact on the world economy. I mean, they are the biggest economy in the world, and we have to watch what's happening there closely. I mean, we've seen him fiddling with the Fed. We know that he wants to boost US GDP growth artificially, I suppose, with lower interest rates in the shorter term. But he does have midterm elections, so he needs to balance his sort of external focus in other parts of the world with domestic focus. And one of the reasons we think that the resolution in the Middle East will come soon is that he wants to now concentrate on the midterm election and gaining better support up into that election cycle. He's been targeting Russia's allies, so looking at shoring up the Western Hemisphere, targeting Venezuela. We think Cuba's next. And then, of course, the big story's been the weakening of the US dollar. So, in fact, I've got a slide just now on when we saw the weakening start, but I think that, you know, the US domestic-only focus, putting America first, really has weakened the dollar in the longer term. And we've seen the weaponization of US treasuries in the Russia-Ukraine war. Yeah, and I think that longer term, things have changed, and the US dollar is structurally weaker. So there we have the decoupling. So last year, when the Trump tariffs started out, you could see an immediate break there from the correlation between the US dollar and US treasuries. And we think that although it has come back a little bit, we think that this is a structural change for the longer term. So we've spoken a lot about South African-focused equities, but listed on our market, of course, is Naspers Process. And sometimes joke that next to Nelson Mandela's statue, and maybe on the other end of Sandton Square, there should be a statue to Chris Becker, who brought this asset to our market. It's been a fantastic investment for many of us. We think that the long-term growth prospects are intact. They're going through a bit of a reinvestment cycle now, where they're spending more on AI, but their mobile gaming business is still strong. They've got their WeChat platform. They're monetizing things like mini games. They've got like mini stores on their super app. They're using AI to generate more advertising revenue from better targeted advertising. We're expecting more to come from the payment side of their business as the Chinese consumer improves. And of course, they have their own proprietary AI that they are busy investing in. And it's not expensive. So obviously, the one thing you look at for is great businesses, and the other thing is the price you pay for them. So we look at the long-term 12-month forward PE, and we can see that it's trading at near the nearest lowest level. And I think, in fact, it's actually almost in 13 times forward earnings now. The results on Wednesday, we do expect the results to be kind of like low single-digit earnings growth as they invest in AI, but medium term, we think it returns to double-digit, sort of 18% earnings growth. So, in conclusion, we're watching things closely in South Africa. I mean, we do think that March is a pothole, but the longer the high oil price continues, the more difficult it is for South Africa. I mean, we are quite exposed to a higher oil price. One thing we've been worrying about, well, we've really started worrying about at the beginning of March is whether we would run out of fuel. So we've been tracking, we built a tracker to track the amount of fuel tankers or petroleum products, oil and fuel that are coming to South Africa. And as we stand here today, we still have enough fuel tankers on the way. So at this point in time, we're not going to run out of fuel. But hopefully that will give us as West to catch an early warning as to whether we need to change some positioning. We underweight the SA industrial companies by and large, and then overweight insurers, banks, and some of the apparel counters. And of course, we've got our overweights in Naspers Process. And then we expect continued volatility with Trump. And its volatility is uncomfortable, but it actually creates opportunity for us as investment managers. So although it feels horrible sometimes, it's actually an opportunity, and you need to keep focused on your process and see where the opportunities are. And just thought I'd highlight two of our products. So our longest running product is the Retail Hedge Fund. We've got an Aussie benchmark for that hedge fund, and we've beaten Aussie on average 6.6% a year. And then we've got one of our newer funds, the Flexible Fund, which is coming up with a 3-year track record, and that's got a CPI plus 5% benchmark, which we've been 7% ahead on it on average. That's me.
Cool. Thanks, Mark and Jamie. We've got some questions coming through online, but before I go there, is there anyone in the room with a question? Come on, guys, it's like domestic equity. You must have a question. At least one. I'll give you time, and we'll go through some questions that I prepared. So I asked the guys to just give me some information so we can just have a look at them, and contrast some of their views. I mean, these are two actually very different managers, but the outcomes of their process, interestingly, has yielded sort of very similar views. So I see, I mean, you guys, your views are not too dissimilar. You're both constructive on resources. We've seen the sector run. 2025 was a great one. 2026, a little bit more vol. Mark, as a sector, do you still see sort of long-term value in resources?
Yeah, I mean, I think that... Have I gone off? I think that, I mean, our base case is that the US dollar is structurally weaker, so that is positive for things like gold and platinum. Platinum also has its own drivers. So, I mean, we're sitting largely neutral to that in that space, but we look very specifically at each mining company, and we have our favorites, our overweights and underweights there. So trying to generate some alpha from being overweight the right miners in the right sector. I think just on the more diversified resources, I mean, I think copper has good long-term prospects, but the prices run quite hard in the shorter term. There's quite a lot of inventory actually available at present. So all the projections are longer term, we're running out of copper, may be true, but in the shorter term, we've got enough. And then we are most bearish, I suppose, iron ore, because for 30 years we had the big boom in China, the property boom, and now we're seeing a bit of a property slump, and I think that medium-term iron ore will probably not be much.
Okay, great. Jamie, anything to add to that?
No, not at this stage.
Nothing? Okay, cool. So we've seen that, relatively speaking, as things stand now, you guys are sort of underweight industrials, but even in your presentation, you're most excited over the next sort of 5 years on industrials. Do you want to just, and you mentioned sort of more SA-facing industrial stocks. Maybe just a little bit on that.
Yeah, so I mean, at an absolute level, industrials maybe makes up a smaller portion of the fund, but that's also a function of the fact that resources has just become so significant in the benchmark. But as you mentioned, within industrials, if you're just looking at those, because industrials is obviously everything excluding resources and financial. So within industrials, we are constructive on SA Inc., particularly on retailers. And I think that also links to what I mentioned in my presentation, the fact that household balance sheets are also actually in a stronger position than they were before. Also with lower inflation and lower interest rates, that should bode well for retailers as well. And then within industrials, also Naspers process. And I mean, Mark touched on some of that investment case. We also see value at these levels. So.
Thanks. So I'm seeing a couple of questions coming up online around potential impeachment of Ramaphosa. So I'll read the question. Latest impeachment potential, do you see it derailing our SA reform recovery, or is this structurally positive, is the question. Mark, do you want to attempt this one?
Yeah, so sure. I mean, like I said, we watch the political situation closely. I think if Ramaphosa is impeached, it will be short-term negative. I'm not sure. Like, there is a question as to what happens post Ramaphosa, because Project Vurundlele was driven by his office. You would hope that, given the positive outcomes, it will continue. I think that the GNU holding, I think, is a big box that needs to be ticked for South African-focused equities to outperform. But yeah, it is a risk, and I think that the impeachment process will have to run its course. But also, there has to be a future post-Cyril. He's not going to be around forever. And we have to start looking forward towards 2029 and more medium-term post Ramaphosa, what is the next political regime going to look like? So we have to cross the bridge. It's just whether we do it now or in 2029.
Okay. I'll go back to some or the screen there. So I've contrasted or at least compared your top 10. Jamie, you guys are like 20% in gold counters according to what I could find here, right? Goldfields, Anglo Gold, again, is this a long-term holding? Is there still value left in gold?
So maybe just also some context there. When we built our position in gold, this was probably about 2 and a bit years ago. The gold price was probably sitting at about $2,300 an ounce. The all-in sustaining cost is probably closer to 1,617 per ounce. And at those levels, we thought the gold miners were generating decent cash flows. And so we built our position at that point. And then obviously it's had a phenomenal run since then. And in that strength, we've actually been trimming back our active position. But obviously, because of the size in the benchmark, it's also increased. Our absolute position has obviously increased with the increase in the benchmark. But as it's been rallying, we have actually been trimming back our active weight. I mean, with the gold price, where it is now closer to $4,700 per ounce, obviously that margin, the all-in sustaining cost is a bit higher, but there's still quite a decent cash margin there. So we still see value, but in terms of it being a long-term holding, I think we are probably getting closer to those peak margins.
Okay. And then maybe just staying on you, property. It's a differentiator in your top 10. Yeah, just expand your view on that. You guys have Redefine and Growth Point.
Yeah, so again, with property, that position, we actually built probably about 2 or 3 years ago when property was trading at about a 50% discount to NAV. And at that point, our thinking was that we've probably seen the worst of the D-rating. We could probably see a further D-rating, but the rate of change has probably decreased. So we started building a position at that stage. Where we are today, property is still trading at a bit of a discount to NAV, but as I showed in my chart, that we have seen a bit of that re-rating coming through, particularly in banks and property at the end of last year because of bond yields compressing. But we still think there's value there because dividend yield is currently between 7% and 8%. As I said, still trading at a discount to NAV. LTVs have come bode well for property counters.
Great, thank you. I'm going to go to audience questions, oh, sorry, the online audience questions. Mark, there are 2 interesting ones here. I'm going to give you both of them. So what is your view on apparel retailers? They've been decimated and earnings don't look like they're recovering soon. And the other one is, to what extent will industrials be dampened by household spending on gambling rather than clothing?
Yes, so I mean, we are overweight at a sector level, apparel retailers. We have seen the share price has been really hammered hard. I mean, the earnings also haven't helped. We saw Fashini come out with a poor update on what we thought was a poor update on Friday. So the question is this the bottom? I mean, like I say, we always look at the valuation, the price you're paying for a business. The retailers are very cheap, but in order to get that investment return, you do need to see the earnings start to grow. I think that they have been impacted by a lot of spending shifting to online gambling. They've been impacted by things like Shein and Temu, but they do look like there is value, and we don't know when that starts to come through, but they really do look quite cheap to us. So we will maintain our overweight position likely until we change our minds, I guess.
Okay, great. Biggest risk to equity markets. So I asked you guys a question, and it was an open-ended question. And I mean, you mentioned geopolitical risks, and then there was the oil price above $150, which I think you mentioned earlier. So both views are linked. Mark, maybe just staying on you. How do you manage your positions given this is actually a real outcome?
Yeah, I mean, it has been difficult because, like I said, coming into this year, I mean, we can see a pathway for South African GDP growth to go to a higher trend level. So we were overweight things like the banks and insurers, retailers. And then with the higher oil price, I mean, we didn't have any of we had underweights in the energy stocks. So it is difficult for us because at the moment now, I wouldn't want to go and start buying Sasol unless we can see that there is going to be no resolution to the Iran situation. I mean, that price has already run. We sold the little bit that we had. So yeah, I think managing it, if we see this lasting, is going to be difficult. We did trim some of our positions. I think it's always important to have room to invest more. So if we're currently 3% overweight the banks, if things get worse, but we see a pathway to things returning to more normal levels, we can go to 5% overweight. So yeah, I think we're just trying to keep a bit of powder dry, not sitting in cash, but sitting in things that we think will go up, just, regardless. So we've had a nice overweight in Anheuser, which has helped. But yeah, managing, we meet every week. Formally, we meet and we go through our whole ranking table, and as things change, we change our position.
Great. Then last question. I don't have a timer, so I'm trying to manage time here. I asked the question, company fundamentals or Trump, what's going to have the biggest impact on markets or our market over the next 12 months? I mean, I think the answer is pretty obvious, right? But maybe just your view on that, Jamie.
Yeah, so I mean, I said Trump because I think over the last year and a half, we've already seen, I mean, with the Middle East conflict, what happened in Venezuela, Liberation Day, you see that the action from the market to what's coming out of the White House. And I mean, we still have, I think, another 2.5 years of this, right? So, yeah, I think that is going to be the main drive. But I mean, I think Mark also mentioned it, that it's not all bad news because the sort of volatility and noise that comes out of the White House, what we see is valuations decoupling from fundamentals. And I mean, that's fertile ground for alpha generation for asset managers. So it's not all bad news.
Okay, so Trump creates opportunities.
Yes.
Cool. Listen, that's the end. We've come to the end of it. But before I say goodbye, are there any questions from the audience? I'll give you one more chance. As the rain comes down, I think we'll call it to it. We'll call it a close. Thanks, BCI. Thanks, audience. Thanks, guys. Thanks, Eugene.
Thank you.
Lee, I think lunch was maybe a little bit too heavy and we all want to get past this. But we saved a very good panel for the end of the day. We're going to look at global equity again. We've got some really, really good presenters coming to the front. Sean Pesh from Ranmore. Jen, you can join me here on the stage. Thank you. Richard Pitt from Blue Alpha. Ryan Wood from Artisan. And here to moderate the session is Managing Director at Apex Investment Consulting, Pierre de Klerk. Gents, welcome. Thank you so very much. And while you're coming to the front, Pierre, I think you're in for a tough one. We've got value managers, and I see from Richard's topic, is how I became a value manager. So maybe all value, or it's going to get a little bit more controversial. All right, so have fun. And to our audience as well, it's the last session. Yeah, please challenge him as well. Thank you so much.
Thanks, Eugene, and thank you everyone for braving the weather and for staying till the last session, and everyone online as well. There you go. As Tavonga, our Chief Investment Officer, mentioned already this morning, we, in the building of our portfolios, advocate for representation of all the major investment styles. And the logic is obviously simple, that all styles don't perform at all times. And the idea is that when you have a style in your portfolio or exposure to a style that's not working, then there'll be another style that helps you out. So I think in that respect, it's nice to have presenters representing the different styles, and hopefully we can have a nice debate around that. And I think it's Richard's slides that had something with the heading that said, "What's your religion?" So that's almost how strongly we sometimes feel about these things. But thanks for joining us. Sean, you up first. You can go for it.
Thanks, Pierre. And thank you, BCI, for the invitation. It's wonderful to be here, despite the weather.
and to share the platform with a great friend of mine, Richard, and respected peer from Artisan. And Ryan, the weather's not always like this. And I'll just share a story. I flew in from London yesterday to Johannesburg because it's cheaper that way and we value managers. And then I flew down. And I flew down yesterday, we were landing, and the pilot, I mean, you heard Adrian say this morning that he was driving past watching a plane land. I was in the plane trying to land yesterday, and they aborted takeoff. Landing. They aborted the landing and went around. Now, at that point, I thought, maybe that was a value trap saving a few bucks on the trip over. Anyway, it's great to be here. So the presentation I thought I'd talk about is, the topic is value investing in an uncertain world. And if you look here, this is 17 years of annual, so it's calendar year S&P 500 returns from 2009 to 25. And the red lines at plus 10% and minus 10%. And what do you notice? You notice that actually 11 of those calendar years, the S&P 500 total return was over 15%. There was only one which was less than minus 10%. That was in 2022. In the first quarter of 2023, we had the AI euphoria, get everyone very excited, and so the fear was dissipated pretty quickly, and the average return was just under 16%. Now, if you look at the 17 years prior to that, that's what the picture looked like. And what you see there is only 7 years where it was more than 15%, 3 where it was minus 10%, including 3 years of negative calendar year returns in a row. Okay, and the average was considerably lower at just 8.7%. So what's the point? The point is that times have been very good and there's been minimal fear. And we know that markets move based on fear and greed, and everybody shouts from the rooftop saying that you need to be greedy when others are fearful, but very few people say you need to be fearful when others are greedy. All right, so we know that there are lots of risks. This is a less elaborate AI-generated slide than you saw earlier today, but we've got the 2 wars, tariffs, inflation. What is that going to do to interest rates at a time when US debt, about a third of the US debt is rolling at high interest rates? Private credit risk. I note this morning in the Wall Street Journal that KKR's, one of their private credit funds, is taking a $500 million write-off in the first quarter, and that's about 10% of NAV. So that's now starting to come through. Jobs being taken by AI, high valuations, and of course a risk that we don't know about, which are black swans. Okay, but the problem is we need to stay the course because time in the market beats timing the market, as Kenneth Fisher once said. So how do we stay the course? Well, I came across some very interesting research that I thought I'd share with you here, and this was done in June 2020. It's from Research Affiliates, and they looked at how value as a strategy, a couple of different styles of value, did in recessions and again in the post-recessions, the recoveries. And they went back to 1962, and what you can see very faded is the recession bars, and these are so they looked at recessions and bear markets, okay? So when the two collided, you had fiscal tightening, you had the Vietnam War, Nifty 50, bubble bursting, tech bubble, global financial crisis, etc., and then COVID. And I should stress that COVID, this paper was done in June 2020, so you hadn't had the full period of recovery, and value didn't do very well in COVID, so bear that in mind. But of the 6 bear markets and recoveries in the USA, there were 4 that they considered in the category a shock to fundamentals, the oil crisis, etc. You can see them there, and 2 when there were bursting of the bubbles. So you had the Nifty 50 and the tech bubble bursting. And so how did value do? Well, in the 6 downturns, the market lost on average 32%. And a shock to fundamentals lost on average 28%, bursting of the bubbles lost 41%, but value outperformed by an average of 11%. And bearing in mind this is not a huge data sample, did really well with bursting of bubbles and kind of performed on par with the fundamentals. But how did they do it? How did value do in recoveries? Well, it outperformed in 5 of the 6 times. Shock to fundamentals, where it performed kind of in line on the way down, because you got a rotation into other sectors, value did really well. And then the bursting of the bubbles did extremely well, 24.6%. So putting those together, value did extremely well in the bursting of bubbles and quite well in the shock to fundamentals. Okay, so that is maybe of some use in terms of how do you navigate. There's always risks. What do you do? Well, try and go for a strategy where if you get it right, you make some money and you don't lose too much on the way down. And so the one thing we like to look at is upside, downside capture. And this is from Morningstar. And what essentially it is, I think it's a very, very useful tool. It says that in positive markets, what percentage on average do you capture of the positive move? So in our case, over the last 5 years, we've captured 99% of the upside. Over the last 10 years, about 90% of the upside in positive months. The peers have captured 90% in 5 years and 94% in over 10 years. In downside, in the last 5 years, we've captured on average 62% of the downside, okay, protecting the downside. The IA Global, which is a large set of funds in the UK, it's Investment Association Global, is about 500 funds or so, all the large names that you would know about. And in the last 10 years, we've captured about 80% of the downside. And that is the key. Don't capture all the upside. You know, we don't expect to capture all the upside, and just don't capture all the downside. And if you keep compounding that through time, it makes a difference. Now, you saw a similar chart today. I think it was from Simon. You know, the 1-year forward PE on the x-axis and your subsequent 10-year returns. I think Simon had 4 years on the y-axis. And what does that show you? It shows you that the lower the forward multiple, the higher your subsequent 10-year return. Okay, valuation matters. And if you saw a recent podcast by Paul Tudor Jones, who with Patrick O'Shaughnessy, you know, he was being interviewed, and he's been in the market for some 50 years through all market cycles. Valuation matters a lot. Okay, so where are values high? This is the forward multiple in North America. It's 22. The 25-year average is 18. And again, that is earnings, not cash flow, because of all the capex we've seen. Cash flow multiples are far higher. In Asia, Latin America, and emerging markets, they're lower than the 25-year average. Okay, and in some places with the commodity booms, you can imagine emerging markets like South Africa. You saw that recently. You know, that is really helping the economies. So on a blended basis for the MSCI World Index, forward multiples 20. And that's because it's been dragged up. North America is so large. Our forward multiple of our fund is 9. Okay, this is probably the most important slide, I think, in my pack. And what this is it's taken from Morningstar's style box. What you have on the x-axis is the value, blend, and growth, and on the y-axis, small and mid and large. And this is compared to our largest peers in the feeder fund space in South Africa. In total, that's about 194 billion. We've taken the largest feeder fund peers. And what you can see is that most of them are over their blend to growth in large caps. Okay, we are mid-cap value. So we're very different. And it's one of the reasons I think we've been gathering assets in recent years is it's a way of two things. One, reducing exposure to North America, but two, we're different. And so that just diversifies clients' risks and helps them get a smoother ride. And here you can see the smoother ride, annualized standard deviation. This is over 3 years on the x-axis and return per annum on the y-axis. And we have slightly less standard deviations of volatility and of higher returns compared to the average. So being different doesn't necessarily mean it comes at a cost. In this case, it's been a slight benefit. So to echo the sentiments of some of the previous speakers, the future is always uncertain. And so if the future's uncertain, you know, if you're coming in a jet, we took off yesterday from Johannesburg. The pilot knew there was going to be a storm on the way, okay? But what did they do? They went through the checklist, and as we were coming in, there was a warning that because there was a wind shear and we had a mitigating procedure and went round. So the future's always uncertain. Make sure you're with, you know, in a decent aircraft with a good crew. Value has helped protect in recessions and recoveries. And of course, every crisis yields opportunities. So, quite a bit of water over here. Never presented next to a waterfall before, but anyway, there we go. Okay, right, so Pierre, that's it. Thank you. Thanks, Rich. Thanks, Pierre.
Just a bit. Okay, where are we now? A lot of disclaimers.
5 pages
A lot
of
of
disclaimers.
disclaimers, Sean. A lot of disclaimers. Okay. Right. Good afternoon, everyone. That really was a watershed moment. And for those of you who've had the misfortune of hearing me talking before, I'm not a value investor. So this is also a bit of a watershed moment for me. It's been a tough time for quality investors such as myself and peers of mine. And when I saw they placed me with these, Sean, who I've known for a hell of a long time and hold him in high regard, and he's a superb investor and excellent value investor, and Ryan is obviously also a very good value investor, I thought I have to change my spots quickly, otherwise I'm going to get eaten alive. So this is almost like a bit of a confessional, I guess, and my penance is to sit with these two value guys as a quality investor. So last year, I tried to introduce this idea of cheap versus value. If value was so simple, we would just line up all the stocks, buy PE, we'd buy the bottom bunch, and off we'd go. And of course, we all know life doesn't work like that at all. But nonetheless, we still use PEs a lot. We use it as kind of shorthand for valuation. It tells us very little about valuation. Anyway, I came up with this idea of housing, and I spoke about an area, Helicon Park in Randfontein. Apologies to anyone in the vicinity in Randfontein, and Camps Bay. And we said, like for like, these two houses, they basically offer the same thing, but their price point is radically different. And I think that happens a lot in the marketplace as well. You get things that appear to be cheap or expensive relative to each other, but if you don't look all the way through into the economics of the business, you actually can't make a statement about value. And what I did with this example, and in fact, funny enough, Sean, you came after me, and he also used a housing example, but the complete opposite, which I think worked in your favor. And I think today, you don't want to be selling property in Camps Bay. You might want to be selling property in Helicon Park, because I think the weather's perfect up there. Anyway, so taking this idea of the houses, I then looked at companies, and I said, Citigroup, classic cheap company. MasterCard, expensive company. United Airlines, cheap. Google, Alphabet, expensive. And I've just tracked how those kind of comparisons worked. And in the case of MasterCard and Citigroup, it didn't work at all. And the value guys will tell me, well, that's because it was cheap. And yes, it was cheap. And it re-rated. In terms of earnings, MasterCard and Citigroup wasn't an earnings story. It was just a revaluation in the case of Citigroup, and in the case of MasterCard, a devaluation. So that was a fail. United Airlines, Google, we were very positive on Google this time last year, and that's done extremely well. And then we looked at this idea of low quality versus high quality. Ryan Mattel, very topical last year, but we would argue a low quality business. And interestingly, if you knew that there was going to be war at this time, if you knew about the conflict that was coming in the Middle East, you probably would have thought you'd be very safe in a business like Ryan Metal. But the returns have not been good. And we compare that with ASML, which has done well. And then another company we just picked out was Hertz, which I think has gone bankrupt twice. It, at face value, looked quite cheap, but it's done terribly since then. So let's get to the penance side of the presentation. This is our performance, global equity versus our peer group, going back to 2014. And you can see for a long period of time, our approach, our strategy worked extremely well. We are, however, very overweight US, and we are very overweight quality. And in especially the last 6 months, we've had a tough time of it. I'm pleased to report that the slide has now gone up again. The line has gone up. We had a very, very good April. But nonetheless, things are changing. And when you go through a painful experience like this, you start thinking about your religion. I guess you saw the presentation. And I would say, if you approach the markets, unless you're agnostic, which is, I'll do anything and I will go anywhere where I can find money, if you need to sell some sort of philosophy, you must have a religion. So you're either quality. You want to buy really good businesses that generate good returns. Microsoft, Philip Morris, the biopharmaceutical business, AbbVie. Otherwise, you value. You want to buy things that are just very, very cheap. And Volkswagen, I guess, is an easy one to pick on. Been done terribly, but been cheap for a while. Barclays and Vodafone, as sort of other examples, have done very well recently. But if you look at them going back 15 or 20 years, they've done absolutely terribly. So that's the challenge with value. And then I guess the final religion is growth. The sort of stand back, how big is the story going to be? And I think Tesla fits in there. SpaceX certainly fits in there, because if you try and you actually can't do the maths on SpaceX. I mean, how do you figure out the economics on this idea of colonizing space? I think it's incredibly difficult. So you have to be a buyer of the story. Same with Tesla. I think you have to be the buyer of robotics. So religion is important. And essentially, you're either asking the question of how good is this business, how cheap is this business, optically cheap, or how big can it grow? And bringing that back to investments, what makes a good investment? Well, for us, we would say you must invest in a good business. So it must create value, and the way it creates value is it generates returns above its cost of capital. Very simple. A bit harder to discern in the marketplace itself, but actually very simple. A good stock must be undervalued. The undervalued component is tricky because it's not just the price to book or the PE multiple or simple factors like that. It's a lot more nuanced, in fact. And then finally, what is the market like? Because you want to invest in companies that the market is also willing to pay for, and that's the sort of growth story. So if it's a good story, the revenue is growing very fast, or earnings are being revised upwards, typically you'd see some price momentum with that. And I guess the point is, it doesn't matter how you cut and dice it. If you want to make a good investment, you need the combination, we would say, of quality, of growth, and of valuation. Not just one of those. So we always start with quality, and then we sort of layer on from there. So quality's had a really tough time of it recently. What this chart is showing, there's two lines, a red and a gray line. If we could focus maybe on the gray line, it's just the top quintile of stocks measured by quality. So that's measured by the return, cash flow return on invested capital, versus the market. And the first takeaway is that there's been a very, very good time for quality. Quality as a style has done particularly well, and obviously we benefited from that. But what's happened recently in the last year and a half is quality has fallen off a cliff. And the question is why? Has this whole notion of quality businesses fallen apart? And we would say, based on a lot of the data we see, we'd say certainly not. And what the chart on the left is showing is just the profitability advantage of high quality businesses. And if you take the top quintile of quality companies, which is represented by the black line, not only is it significantly higher than the bottom quintile or the lowest quality stocks, but it has also slowly trended upwards. And you even see that to some extent in the second quintile. So there's a big gap, and I guess this is a function of scale, advantages as you get bigger. A lot of it is kind of related to technology and how that has helped businesses. And then also in terms of persistence, showing on the right, just that there's been this continuous and increasing persistence of cash flow returns in businesses from year to year. So, excuse me. So what's the issue? One of the issues certainly is pricing. Quality worked well. Quality businesses became more and more expensive. And what this chart is showing is basically the implied yield spread versus the market for both for high quality stocks, unconstrained and sector neutral. And I mean, you'd expect quality to be at a slight premium below the horizontal line, but clearly it got to quite a significant premium to the market. And there's been a big change in that. That on the right is kryptonite for the Superman fans. There are two other factors which also impact quality. The one is innovation cycles and the one is economic recoveries. And the shaded line just shows the performance of the excess return of high quality versus low quality. So when it's below the line, you can see that low quality is beating high quality. So that's like the very worst kind of situation for us. And typically this happens when you have an innovation cycle. So you have the red line shows hyper growth versus the market. AI, I guess, is part of that. And the lighter blue line shows us kind of cyclical revaluations, or kind of when the market goes into an uptick, say from a recession to coming out of a recession, which is typically a risk-on rally, and quality companies tend to get left behind. So these two factors have also impacted, along with the valuation, the performance of quality in call it the last year and a half or so. Just very briefly, we are very skewed to the US, and we're skewed to quality, as we've said. So what we're showing here is just the world ex-US, which we know has done extremely well, the likes of Europe and Japan, and US quality has kind of gone sideways. If you unpack this in terms of value versus growth, very different pictures. So value growth is kind of working quite well in Europe, which is the green line, and in the US, it's kind of neutral. Not, no major difference. But I think the most interesting thing for us is if we look at the brown line, which is non-profitable tech, and we compare that to software and software as a service, which is the blue line, and we all know about how the potential threat of AI to software companies and particularly software as a service. But it's interesting, you have this, how it's played out is there's quite a lot of appetite for new, innovative, untested, unknowable economics, and at the same time, a lot of high-quality businesses that fit into the software space have been, have fallen enormously. So, that is a lot of water. So just in terms of software, and again, here we're showing how that sector compares to the market, and you can see for, most of the last 35 years, it was trading at a substantial premium. It deserved a premium because of the qualities of those businesses. Now, not to labor the point, but we think there are some very, very significant moats that these businesses have, whether it be distribution, data context. But if you think about compliance and governance, the counterparty risk, business logic that these vendors have, two of the businesses that we do own at the moment, ServiceNow and Salesforce, which most of you will be familiar with, have very high returns. They see huge growth potential as a result of AI, introducing it into their businesses, and as they are, and those businesses, those aspects of their business are growing very, very fast. And they're also engaging in substantial share buybacks. Insiders are buying shares. So we think that basically this idea that it's the end of software is a bit overrated. Final slide, I'm out of time. And I'm going to kind of do the same thing I did last year, but I'm only going to come with one idea, and it's Microsoft versus Walmart, because it's sort of, to come back full circle, it explains how I've become a value investor, because I think a lot of quality stocks now sit very much in the value space. So if you'd invested in Walmart versus Microsoft over the last 2 odd years, you would have made more than, the return you would have made is more than 10 times. It's quite an extraordinary number. So the percentage return is more than 10 times. And then if you look at and I've taken these 2 businesses because, we all know the companies, they're not changing the world. They're kind of large, established mega caps. But if you look down into the companies themselves, what those 2 top charts are showing is the returns of the businesses through time. And both the vertical axes are the same. So they're like for like. And you can see Microsoft, unsurprisingly, much higher return business, significantly higher than Walmart. And when we think about valuation, you can say, what is the relative PE multiple? I can tell you roughly it's about twice. Walmart has twice the PE multiple of Microsoft. That tells you something. But more interesting is if you say, what does the share price imply about future returns? What these charts are telling us is that long-term, the market is saying Walmart will revert back to its highest return ever over the last 30-odd years. And Microsoft will go down to essentially its lowest return in the last 30 years. So these are the kind of opportunities that we're seeing, and kind of why I've slowly been dragged into the value camp as a quality investor. And I'll end it there. Sorry, I went over time. Thank you.
Thanks, Richard.
Good afternoon. My name is Ryan Wood. I work with Artisan Partners Global Value Team as a portfolio specialist. Thanks to BCI for the invitation to be here today. I'm going to be on stage with distinguished investors and Sean and Richard. I thought artificial intelligence is one of everyone's favorite topics of the day, so I thought I'd use this time just to discuss some of our thoughts and perspectives, as well as a few of the opportunities that we have in the portfolio today. However, I realize you might not be familiar with who we are, so I thought I'd spend a minute just describing our firm. So Artisan is a $180 billion investment manager. As you can probably guess by how I sound, we're based in the US. We're structured as a multi-boutique. So we have 12 independent and autonomous investment teams, of which one of those is the Global Value Team, who I am here representing today. The Global Value Team is led by Dan O'Keefe in Chicago, Illinois. It's a 6-person investment team with 2 portfolio managers and 4 analysts. We are bottom-up stock pickers through and through. We manage about $35 billion today on behalf of clients around the world in a 35 to 40 stock global equity portfolio. Now, also important to set the backdrop in terms of how we think about value. As you can probably already tell, there are different definitions and approaches to it. And we approach value in an absolute sense. And what I mean by that is that we want to own businesses at an absolute discount to their cash flow derived intrinsic worth. We're not deep value investors. We're not traditional value, focusing on statistical cheapness, looking for some sort of reversion to the mean. We don't approach value from a relative sense, trying to buy businesses at a discount to the broader market or to historical trading range. We're looking for at least a 25% discount to cash flow derived intrinsic value. And so that ideally, we ultimately have 2 sources of return. We want that multiple re-rating, that mispricing, like traditional or a deeper value approach, but we also want a secondary source of return through the growth and the underlying value of a business, the compounding of the per share value of the business. And what that means in practice is that a business at 15 times earnings, say that's worth 20, not necessarily a statistically cheap multiple, is a more attractive value in our eyes than a business, say at 9 times earnings, that's worth 12. That business at 9 times earnings might be more cyclical from a growth standpoint, might carry more leverage on the balance sheet, and we'd rather own those higher quality compounders that happen to be mispriced for one reason or another. So at the end of the day, we're looking to combine a portfolio of 4 characteristics. Again, our North Star is that 25% discount to cash flow derived intrinsic value. And the next 3 or more are insurance policies. They're risk management oriented. We want to own high quality businesses with dominant market shares, strong competitive positions, and ability to compound that per share value over time. We want to own businesses with strong balance sheets. Ideally net cash on the balance sheets, but at the very least, we want it to be a resource rather than a restraint. And then lastly, finally, is that we want to align ourselves with management teams who think like we do, like long-term owners of a business, which is ultimately what we do. Our typical investment horizon is 5+ years. There are countless examples in the portfolio that we've owned for well over a decade now. So that gives you just a brief overview of the lens through which we're trying to invest. And now I'll switch gears and just talk about artificial intelligence. As obviously, like most investors, we're spending a lot of time these days trying to understand both opportunities and risks that the technology poses, analyzing how it's impacting different companies' cost structures, competitive dynamics in certain industries, how it is changing and evolving different parts of the economy. And I think with anything, it's important to have just a high-level basic framework. And so when we think about the landscape of artificial intelligence, we break it up into 3 broad buckets. The first of those you can think of as your infrastructure players, more of your picks and your shovels. These are the chip manufacturers, the memory players, the equipment manufacturers. Second are the platform businesses. These are the businesses that are monetizing AI today, actually turning models into revenue and cash flows. These are your model providers, as well as the hyperscalers that are spending upwards of $650 billion on CapEx this year. And then lastly is a bit of a catch-all, areas that we're avoiding, that are more speculative or overhyped, areas where expectations are extremely high, but there's not a clear path to sustainable returns, or it could be parts of the market where valuations are seemingly attractive today, but there are significant risks from a disruption standpoint from the technology, such as you've seen within the software space. So in terms of a couple of stocks within our portfolio today that I want to discuss, starting on the infrastructure side of things, Samsung Electronics. This is a business that we have owned since 2013. Obviously, the opportunity set has evolved significantly in recent years given the evolution of AI. You can think of Samsung as the AI memory backbone. All the spending, CapEx spending, data center build out, need for compute capacity has led to a massive boom in demand for memory, both DRAM as well as high bandwidth DRAM, which Samsung is a leading provider of. Now, they were late to the game. They completely missed out on this trend and on this demand boom in 2024. However, they have completely remedied those issues. They now have a chip that is at the cutting edge from a technology standpoint. They've regained capacity lead, and the operating profits have rebounded as a result. In fact, this year, Samsung will earn more in 2026 in operating profits than they have in the last 5 years combined. So this is truly an unprecedented demand environment. And as a result, and as you can see here, the share price is up massively over the last 15 to 18 months. That said, the valuation today is still at around 6 to 7 times earnings, which is pretty incredible. And we think the market is pricing this business on its historical cyclicality and treating these profits as if they're going to peak and come down like they have in prior cycles. We think, though, that this cycle could potentially be different given the demand drivers today, that it's coming from hyperscaler spending. Previous cycles have been more consumer-driven by PC upgrade cycles, smartphone upgrade cycles. There are much more durable and sustainable demand drivers for the business today. And you can see that, given that 70% of their memory shipments today are tied to AI, and they're also locking in 3 to 5 year supply agreements with their customers, the hyperscalers, which is unprecedented and hasn't happened in the past. And so the debate is as to whether or not this is still a cyclical business or it's more of a structural grower going forward. We tend to believe that there are structural drivers of demand, and that would certainly warrant a higher valuation than 6, 7 times earnings today. And so this continues to be the largest position in our portfolio. Next stock, also an infrastructure play, is Lam Research. A little bit different exposure in that it is an equipment manufacturer. We first bought Lam Research in 22 at around 10 times operating profits. As AI has continued to develop and be rolled out, these chips are becoming increasingly complex, requiring more processing steps, and that has led to increased demand for fabrication equipment, the actual equipment that makes semiconductors and chips. Last year, Lam Research's management team estimated that for every $100 billion of investment in data centers, that will lead to an incremental $8 billion in revenues and spending on wafer fabrication equipment. And so unsurprisingly, this has been a fantastic operating environment for the stock and for the business. It's been one of our best performing stocks in recent years. Admittedly, the valuation has gotten a little bit ahead of itself more recently, and it's difficult to justify today. Certainly if AI continues to build out at scale, free cash flows, profits could exceed expectations. But there is a great deal of optimism embedded in the valuation and the share price today. And so as a result, we've trimmed this position pretty significantly on that strength, as there's little margin of safety at today's valuation level. And I just think that's a testament to ultimately our valuation discipline. Switching gears to the platform side of things and Meta Platforms. This is a business that we have owned since 2018. Fourth quarter of 2018 is when we first bought it. Over time, we have added and trimmed as the valuation has waxed and waned between fair and attractive. Most recently, we were aggressively buying the shares at the end of 2022. This is a business that we clearly believe and can see is benefiting from their investments in building out their AI capabilities, both from a revenue standpoint as well as a cost standpoint. On the revenue side, it is improving all aspects of the business. It's improving the algorithms, the content generation, user engagement, which is leading to better advertising performance and ultimately better ROI for advertisers spending across the social media platforms. On the cost side of the equation, the business is clearly becoming more efficient. Over the last 3 years, Meta has added $84 billion in additional annual revenue. And over that period, they have 8,000 less employees than they did 3 years ago, with rumors of further layoffs ahead. So clearly massive productivity gains being had and the substitution of labor for capital. Now, obviously, the concern more recently is on CapEx spending and the financial discipline of Mark Zuckerberg. CapEx spending was $67 billion last year. It's rumored to be headed to $140 billion this year, which is truly a staggering increase. However, we ultimately do believe that Zuckerberg is going to show financial discipline and that there were some hard lessons learned in 2022 when the share price was down 65%. We feel that that was largely self-inflicted, and they were unwilling to rein in operating expenses in what was a very difficult period period of time for the business. And while it's difficult to necessarily discern the marginal returns on CapEx spending today, we do clearly believe that it is benefiting the business. It's improving revenue performance, improving the cost basis. And so we continue to believe that at 19, 20 times earnings, that's a reasonably attractive value for what we believe is one of the world's best businesses that is becoming incrementally better by building out their AI capabilities. Finally and lastly on the list is Alphabet. This is a business that we have owned since 2008. And similar to Meta, we've added and trimmed over time as the valuation has fluctuated from fair to attractive. Most recently, if you recall, the valuation got down to 16, 17 times earnings about this time a year ago. That was the last time we were buying the shares. And that was due to competitive threats and concerns from ChatGPT. What did large language models and AI mean for their core search business? Were they going to cannibalize their own core search business going forward? And at that time, we always felt that those fears were largely overdone, that behind the scenes, Alphabet had been making investments in building out their own capabilities, and that they could roll that out across their massively scaled ecosystem. And sure enough, over the last year, what you've seen them do is start to embed their AI technology and Gemini within their different consumer applications, within search, within YouTube, within its accelerating growth in the cloud business, within the productivity apps, within Gmail, which we always felt was ultimately their competitive advantage versus OpenAI and some of these other LLMs, is that they already had a massively scaled ecosystem in a number of different ways they could position the technology to their consumer base. Similar to Meta, clearly making it a better business from a revenue performance standpoint. I mentioned its accelerating growth in the cloud business. It's improving search results. Despite rolling out Gemini and putting it within Google Chrome, the search results and ad revenues have only accelerated over that period of time. Also, from a cost standpoint, making this a more efficient business. It took Alphabet 20 years, from 1998 to 2018, to get to $130 billion of revenue and 100,000 employees during that period of time. Over the last 3 years, they've added an additional $120 billion in annual revenues, while the employee count is down by 500 people. So clearly, again, massive productivity gains, huge substitution of labor for capital. Now, since we were adding to it a year ago, the valuation's moved up to around 28, 29 times earnings today, which is not unreasonable in our opinion. That's right around fair value for one of the best companies in the world. We have trimmed the position on that strength. However, we're comfortable holding it near the top of the portfolio, given its ability to continue to compound that per share value over time, which gets back to ultimately our approach to value, those two sources of return. We got that multiple re-rating from 17, 18 times earnings to 28 times earnings today, and now we're comfortable holding it because of its ability to compound value going forward. So hopefully this was interesting. Obviously, AI is a transformative and popular theme. For us, it's not just about chasing themes or the latest trends. It's focusing on the duration of cash flows, the quality of businesses, and importantly, this is only 15% of our portfolio that I've discussed today. The rest, 85% of the portfolio, is in names that aren't necessarily related to AI. And you can see the results that we've been able to produce here over the long term on behalf of our clients all over the world. So thank you for listening. Really appreciate it. And I look forward to the panel discussion to follow.
Thanks, Ryan, and thanks to the other speakers. I've got some questions that came in online, but maybe before I go to that, are there any questions from the audience? Is there a roaming mic somewhere? There's a question up front. There's a mic in front. Thanks.
Awesome. Thanks so much. Ryan, thanks for the presentation. Just two quick questions. So first of all, just out of interest, on the Alphabet side, since we're moving to a world where it seems like with AI search, we might go into a one answer to a search world instead of paying for ranking on search engine optimization, and that was the core kind of business process of Alphabet. Do you have any idea kind of how that might change in terms of how they might structure their planning around revenue, since you've got almost like one person paying for a result instead of people paying to be ranked on a page, if that makes sense? And then secondly, just like a broader question, we had a lot of speakers today speak about obviously long-term investing, right? We need to take 10, 20-year views on stocks, on portfolios. Just like that feels like it's such an incredibly almost impossible thing to do currently. If we rewind 5 years and just think where AI was non-existent and where it is right now, and we know that tech creates an accelerated version of increasing tech. So 5 years from now, it's going to be ridiculous. 5 years after that. So just 15 years from now, it's impossible for anybody in this room to even contemplate where we're going to be. Like, how do you do a fundamental bottom-up analysis on a company if you have no idea what the world's going to look like? Like, how does one approach something like that? Just like those two. Thanks.
Sure. Yeah. On your first question, ultimately, we don't know 3 to 5 years from now, what search or these large language models are going to look like. I think what Alphabet has started to demonstrate is they're incrementally rolling it out, introducing it. And so far, it's putting AI search results at the top of Google Chrome. And so you're still getting the search rankings down below it. And so far, that's driven increased engagement and actually more search queries. So wouldn't be surprised to see them continue to plow forward with that strategy, in addition to having the standalone Gemini app. But in terms of how it's going to look, I don't know, to be specific. And then secondarily, we're not necessarily, or we are not trying to predict what's going to happen 10 years, 15 years in the future. We're certainly not running 10-year, 15-year DCFs. We don't have an ability to predict cash flows for a business beyond 3 years, for that matter. We're just trying to price businesses conservatively off of their normalized earnings power. And things can certainly change. And so it's not that we're underwriting a business for the next 10 to 15 years. We're typically doing so on the next 3 to 5 years, but we want to make sure we're owning businesses that over the next 3 to 5 years are continuing to compound value and hopefully beyond that into the future. But of course, there are going to be disruptions to the business along the way and things will change. And I think ultimately that's why we focus on business quality, is that we want to make sure the businesses that we own don't have any single point of failure in them, if that makes sense.
Thanks a lot. Any other questions from the floor? Another one?
Thanks, Ryan. Some great quality investments there in the value fund. In what circumstances would you then, I think it adds to, would you sell a business?
If we make a mistake, which mistakes happen, if we have to take down our estimate of intrinsic value, that happened as recently as the first quarter with PayPal. That was very clearly a mistake where there was a misappraisal on how competitive the payments landscape is, and they weren't able to take share. Ultimately, if price exceeds intrinsic value, we're going to be trimming, if not outright selling that name. However, that's where this is where it's more the art than science. You're weighing the relationship between price and price target with the underlying quality of the business. And so as an example, like Alphabet, despite it being near fair value, in our opinion today, we've trimmed it to manage risk. We're comfortable holding it today. Now, if you were to have a lower quality, more cyclical business that, say, might only grow with GDP, if that business all of a sudden gets a multiple re-rating, say from 9 to 12 times earnings, such as a name within energy or a Heidelberg Materials, which we own today, that's a materials, cement and aggregates business. Those businesses, you're not going to get that same secondary source of return at the same level as Alphabet. So we'll be much more quick to sell those businesses down, if not outright exit them. But ideally, that's best case is prices hitting price target, but mistakes happen. Try to keep them as infrequent as possible.
Tian at the back.
I have 2 questions. One is, what is the average holding period or the average trading that occurs in your portfolio, the trading balance that shifts, or how often you trade your portfolios? And what's your preferred time horizon if that exists?
Is that for Ryan?
For both.
Everyone.
Preferred actually for sure, but the other 2 can answer it as well because it's an interesting
Sean, go for it.
I'm a little bit controversial in this one, Tian, because I'd say my favorite holding period's a day, okay? And the reason I say that is if you think something is worth 100 and you have the opportunity to buy it at 50, when you buy it at 50, you want it to get to 100 as quickly as possible because then you can sell it at 100 and buy 2 other things down at 50, okay? And so we'll rather compound the capital than give it to a management team and let them compound it because very often you find management teams do crazy things. Bayer goes and buys Monsanto or that type of thing. So we will hold companies for as long as we think the odds are on our side of a decent return from this point, from every day, and we're comparing it to others. And so if a stock falls and we think things haven't changed and the value, intrinsic value is the same, we'll add to that because it offers a higher return. And the ones that have rallied hard, we will trim. So that is, and we like to think, if you think about it, on the turnover side, you want high turnover because it means your stocks, you're either A, recognizing mistakes, and we all make mistakes, and even the best portfolio managers in the world are going to get a third, 40% wrong. And B, the ones when you've got them right, they've hit fair value, okay, and you sell those too. So we think this focus on low turnover is the biggest fallacy in financial markets. If you look at some of the best money managers in history, the Druckenmiller and Paul Tudor Jones and those guys, I mean, none of them said anything about low turnover being the answer. Even Warren Buffett said, my favorite holding period's forever, but he didn't say my only holding period's forever. And a lot of his, they've sold the banks, sold the airlines, etc. So yeah, it's all about the return and optimizing the return. It's about 100%.
The brokers love you, huh?
Oh, no, they don't, because we pay 2 basis points and we don't buy their research. But for example, we've been looking in these software stocks. I mean, the point that Richard made, we've been, when stocks in certain sectors are out of favor, that's when the opportunities are. So we actually bought a bit of Microsoft down at 366 fairly recently, because this was, and we owned Alphabet last year when everybody thought search AI was going to kill search. So we're happy to move there, and we unfortunately sold Alphabet a little bit too early. Probably sold it to Ryan.
If I can maybe add a question to that, and portfolio construction questions can become very dry material, but the question is, we've had the experience, well, firstly I should say, we saw, I think it was in the North Star presentation earlier today, the volatility, a graph of the volatility of value versus other stuff. And obviously the more strongly value-oriented you are, you might have higher volatility in the short to the medium term at least. And similarly on the quality and the growth side, Richard, we've seen examples in the recent years where the managers with the most concentrated portfolios have come and given investors a tough time. So my question is, do you have views, and you can both answer it, do you have views about number of holdings in a portfolio, also as a risk and a volatility management tool? Because obviously the arguments from people who run concentrated portfolios are always, it's less things to keep your eye on, you can know those companies very well and so forth. But when you look at some quality or growth managers that's been severely underperforming in recent years, and they only hold 10 stocks or 15 stocks, then if they pick up one or two, no.
You're not looking at me.
Not specifically, but I suppose if you run a 15 stock portfolio and you make one or two serious mistakes, then it blows the portfolio out of the water. So, what's your opinion about that?
If you have a lot of stocks, then you must understand that you're making a different bet. And the bet that you're making is actually the qualitative, you can cut up your portfolio. You might think that you're taking individual fundamental stock pick ideas. But I think what you're actually doing is you're aggregating these stocks. If you have 100 stocks, you're essentially going to pick up the factors of that portfolio. And if those factors are in style, let's say it's momentum or valuation or quality or growth, whatever the case may be, then it can work. But you've kind of gone quite a long way from fundamental research. And when you're doing fundamental research with all the risks, because to the question, who can see the future? None of us can see the future. And I think it comes back to your religion. Because none of us can see the future, we respond in different ways. Some people will say, I must buy cheap because the future is unknowable. And there is value to that. If you'll excuse the pun, yeah. And other people say, if you look historically, the businesses that do really well are these businesses that have grown. Amazon, Monster. So we've got to get growth. We've got to focus on growth. And that comes with its own hazards. Just like quality, if you're a quality investor, I think what you're saying is the future's uncertain. Historically, this business has found a way to generate good returns, and therefore we will make the bet that there's a good chance it will be able to do so going forward. But there are also risks. You can overpay. But, just to come back to the point, and I think if you trade a lot, then the factors that you use to make your investment decisions should be quite fast-moving. If you're using slow-moving factors, in our process, the factors that we look at are quite slow-moving. To be trading a hell of a lot, I think it wouldn't be aligned to how we think about the investment process. And then, just on Sean's point, it would be brilliant to know when to buy and sell all the time, and of course, if one can do that well, that's fantastic. But I think, a lot of money is left on the table by being invested in good businesses that at some point you thought just got a bit too expensive, only to see them powering on, maybe that's been a cycle, and, maybe that cycle's going to end, and I'll be more challenged, and Sean will be buying me the drinks, so we'll see.
Sean, you want to add something to that about the...
No, we know we leave stuff on the table for the next guy. Unfortunately, with NVIDIA, I think we left the main course, the dessert, the cigar. But that's that we acknowledge that. The good news is we typically won't get caught up. The problem, one of the challenges here with large positions is that it's very emotionally taxing. It really is. You've got 10% position in a stock. And especially these days with bots and all the rest, you got 10% position in Nike because you thought it was a fantastic company, and then it comes out disappointing results, or they, sanguine about the outlook, or whatever. And that stock falls 10%. You cost your clients 1% of performance. And now you sort of, well, now what do I do? Do I double up? I've told everybody I'm a long-term holder. Do I cut it because they're losing market share to Mizuno or whoever? It's really, really difficult. And so we don't know what the future's like. So for us, diversification is the best, and we don't overpay for the future, And that's how we manage it. So I think if you have large positions, then you've got to be very active and manage it. But that comes at a cost, because otherwise you end up with a 10% position in Novo Nordisk that falls 70% over the next 2 years. And then what do you do? So that's how we manage it.
Any other questions from the floor? So I've got quite a number of... is there a question? In front? Mr. Shuvize?
I think my question really is around, I think the multi-manager that kept on buying value as a style when it was obviously going through the prolonged stretch of underperformance, and you sort of explained to your clients it's getting cheap, it gets cheaper, it gets cheaper, it gets cheaper. And I think the question is really around, are there any risks that it's too early to sort of start doubling down on quality? The arguments are very convincing of the high quality stocks, sustainable return on equity, and maybe even style convergence between quality and value might be reassuring, but what if it's a convergence in the middle of a prolonged quality style underperformance? So it's just pretty much comments around that.
Richard, yeah.
Okay, so sorry, Bonga, the question is, will quality continue to underperform? No.
Well, what's the risk that it's way too early for quality? I think that was kind of the crux of the question.
I don't know the answer to that question, and none of us do. Sure. I think I'm talking about, I've become a value investor, but so I'm talking a little bit about how a lot of really good quality businesses have become cheap historically versus their own history, and then cheap versus the market, certainly. But as Sean highlighted, there isn't really a convergence, because I think you said your portfolio is on a 9 multiple, and we're not on a 9 multiple. And please God, we don't get there, because these companies are going to have to fall a lot. I think the one slide which I highlighted, it was, aside from valuation, and in hindsight, it's easy to say that quality got a bit expensive, is this idea of innovation and then a kind of a typical relief rally that you normally get at the bottom of a cycle, of an economic cycle. Now, I would be hard-pressed for anyone to explain to me how we're at the bottom of an economic cycle, but you know, the whole economic cycle thing has been changing. COVID changed it. AI, the investment that is driven by AI is also changing the cycle. And I guess the important question, the jury's out, at some point, the question will be asked, what is the return on these substantial capital investments? And in our case, you know, where we are exposed in a case like Microsoft, we think, you know, it's also unknown as it is for many of the others, but they have such a robust, strong business. And it is kind of so obvious how AI entrenches the user even more. And you're seeing that in their numbers, that we're willing to take the risk there. But, you know, I can't actually answer the question because I think in a sense, part of my own belief system is people approach the markets with a bias. And once you have that bias, that's how you think the money will be earned. And there are many ways to make money in the market. It's not like the one cancels out the others. In fact, there's a multitude of ways to make it. You just need to understand your way and why it makes sense to you. And can you stick to it when times get tough? Because when it's easy, it's easy. And you went through a time where it was tough, and Sean stuck to it. And now he's doing fabulously. And we went through a time where it was more easy, but now we're being tested. And I think that is the mark of your religion, if I come back to that, is like, why do you believe it makes sense to do what you do, and will you keep on doing it? And that's the key. I mean, if you start chopping and changing your ideology because of tough times, then we know it's game over. But I can't actually answer your question. I don't know.
But I'll move over to Sean now. But I just want to say, from a consultant or a multi-manager point of view, that's exactly the point for us as well. You know, the fact that all the styles exist presumably proves that, you know, they work or they offer value. But the worst situation for an investor or a multi-manager consultant is when a manager doesn't stick to their style or their religion, as you say. You know, if we get into a situation where we don't know what to expect from a manager. So it's much easier to defend a manager that performs poorly when he's supposed to be underperforming than to try and defend a manager or even make the decision where you should keep it or not if you just don't know why he's performing, you know, unlike what you expect. So I think trueness to philosophy and religion is important.
I mean, also, you know, like one of the topics now is narratives is halo companies. You know, now we're going back to the dark ages. You've got to have heavy assets, low obsolescence, apparently. Now, I would suspect that Microsoft is fairly low obsolescence. I don't know what you guys think, but if Microsoft switches off, it's going to be major problems for all of us. And they're investing lots of capital, so they're becoming heavier asset as well. So, I mean, I'm being a bit tongue-in-cheek, but you know, I think that's a better place to deal with an uncertain future.
Sean, you want to?
Yeah, Pierre, just to add to that and to answer Tavonga's point from my side, there are some areas where actually quality has fallen so much that we think it's fallen into our zone. And when we decide on value, obviously we look at quality and we look at growth as to how are we going to get our return? I mean, you know, are we going to get our return from dividends? Are we going to get it from earnings growth? And are you going to get it from re-rating? And earnings growth and re-rating are joined at the hip. So some of the software names have derated so much out of fear that that we've now been looking there. And some of the alcohol names as well, because of the fears about us drinking less and all the rest, and those are considered quality compounders. But the luxury goods companies, no. Okay, the Walmarts and the Costco, quality businesses, but we're nowhere near there. You know, we are not buying businesses on free cash flow yields of 2%, because then you're totally reliant on earnings growth and you're totally reliant on no derating. And when something's at, you know, 50 times earnings, not ever expecting it to derate at some point is quite a challenge. So I think there are some sectors that are, because of their own specific circumstances, are falling into our zones, but not all of them.
Any more questions from the floor? We've had lively participation. I've got a number of questions online, but I think we might have to circulate them to you in the interest of time. I actually want to kind of, given that it's the last session, go a bit kind of off script and maybe just talk a bit about AI. I think we all are experts to various degrees on AI by this time and have had our own experiences with it. And certainly, I've done or kind of try to use AI technology to help me with some stuff, and then I've been very impressed. And then on the other hand, I had a thing I want to do, and I thought I'll use AI to try and help me. And then halfway in, I said to myself, if I just did it by brute force, the outcome would have been much better and much quicker. So I think I'll start with Ryan, but I really want to ask, what is your experience with AI technology in your business? And what you've seen in the investment industry so far. Where do you think we stand in terms of, the value that AI technology is going to bring to our industry?
Yeah, I think so far, by no means is it a formal part of our research process, and it will never actually replace, going through the earnings transcripts, historical financials, meeting with the management teams, going through that original source documentation yourself. But it is certainly an efficiency tool. And I mean, we've embedded it within, we have a very writing intensive research culture. We have notes on thousands of businesses going back to 2007. That's one of the best skills you can have on our team is the ability to communicate in written form. We've embedded AI within that. And so you can query all those notes where it'll only use those notes as its source. If you come across a very poorly written 10K where it's difficult to understand the business, you can dump it into Gemini, which is the best LLM out there, and have it explain it to you in simple terms. But that's never going to replace then actually going through the 10K and meeting with the management team and doing the work yourself. But it's a productivity enhancer and efficiency gain. And so I think that's how we're using it today. But it does make mistakes. And I think we all live in a world and operate in a business where ultimately you can't afford to be wrong and you can't afford to make mistakes. And so that's why it will never replace actually going and doing the fundamental bottom-up research ourselves.
Thanks. Richard, do you have any experience?
I would echo that. We definitely have a small team, so people need to work quite efficiently. And I think the efficiency component of AI, a lot of it on the kind of grunt work in an investment company that takes time, be it proxy voting or things like that. The other area where it's brilliant is kind of summarizing news, information, in terms of portfolio companies. You just want to know anything specific that's happened to those companies. And if I think back to when I first started in investments 30 years ago, that was at Old Mutual. And the way it worked as analysts is you spent 3 months gathering information and then writing a report and reaching some conclusion. And it's incredible. I mean, with AI, you can build a model. You can just give just reference the annual reports, and it'll build you income statement, balance sheet, all these things in probably less than, say 5 minutes. Okay. So in the past, we had to build those things. That's very time consuming and kind of not always a good use of time. And then, of course, if you want to get information about a company using AI, I mean, it's just absolutely brilliant. And then in terms of interrogating information, so we use, you all have Bloomberg. The AI tool on Bloomberg now is incredibly useful and efficient for getting information. The one thing, going back to your question about knowing the future and things are changing so fast, I wonder how we felt about this 30 years ago. Relative to where we were, we probably also thought things were changing quite fast. So maybe that's just a continuum that we're on. But certainly there is no shortage of information. There's an abundance, there's an oversupply of information and triggers and things to make you, make decisions. And of course, you can't make decisions so frequently. It's not possible. So I think the big advantage going forward is if you can actually slow down your decision making. Get the information, use information from AI, but you need to slow down your decision making because there's AI stock picking tools now, and they're doing brilliantly, supposedly, or not. I don't know. And the one thing about AI, and when it comes to the pure sort of mirroring what you just said, if you look at the markets, we all know a simple factor like momentum works extremely well. We all know that. But to run a pure momentum portfolio is extremely challenging because the moment it stops working, you don't know why it's not working. You don't know you don't know how long it won't work for. So we've got all this historic evidence which shows that's it. That is like the main thing. And I think AI would be a bit like that as well. You can't just, sorry, I'm laboring my point now, but I mean, if you think about these software as a service and how integral they are to businesses, businesses cannot just rely on AI. There's no counterparty, who's the counterparty that they're dealing with? What happens when things go wrong? So.
Sean, your experience.
Yeah, I mean, it's amazing from an efficiency perspective because I used to listen to conference calls and it'd take me an hour. And then I decided to start reading them and take me 15 minutes. And now you get AI to summarize it for you, or I get someone to summarize it for one of the guys in our team to summarize it for me, and I can read a summary in 2 minutes. That might not, that's quite often the companies that we don't invest in, but competitors or whatever, or other stocks in the industry, so you get a feel for what's going on. But it's just incredible. But I think what I did a piece a while ago, a presentation on why value investing is a great way to play AI, because what's AI so good at? It's good at cutting costs. And so what do you want? Ideally, you want businesses with big cost bases, because then AI's got a lot to work with. And if you can lower you can lower costs just a little bit, that can have quite an explosive upside. So the only way to play AI is not through the big AI companies we all know about. I mean, companies like banks are increasing margins through the use of AI, and food retailers, and even we've got a company, Anta Sports, which is a footwear and apparel company, and they own Fila and Arc'teryx and all the rest. They're using AI in the design, in the shipping, logistics, in the marketing, in the advertising, cutting costs. And so it's available to all of us. And what's quite scary is the switch costs are zero, basically. We all went from using ChatGPT not long ago to using DeepSeek briefly, then Gemini and Perplexity, and it doesn't cost you anything to switch. You just stop using that one and start using this one. So, what's going to be the winner today is not necessarily going to be the winner tomorrow, which comes back to why you don't want to pay too much for these things.
I think your point about switch costs is a specific use case, like individual use case.
Yeah.
It's quite easy to change unless you become too embedded, with data. Then you might be less inclined. So I think for businesses, it can be quite different compared to, but certainly individuals, we jump around, don't we?
I think it's a very valid point that you make, that the winners aren't certain yet. And I had an analogy from a different manager recently that said, what's happening now is guys are building the equivalent of 6 or 7 or 8 parallel train tracks running to the same city. And, if you think back to the late 90s, how many browsers do you really need to exist in the market, for example? And I think many of these things will be similar. Eugene's arrived to cut that short. Welcome, Eugene.
Thank you.
Thank you to the panel, and thank you to everyone. I'll circulate the questions for answers that we didn't get to.
Right. I can see this conversation going on for very, very long. Because we've had a really good panel. Pierre, thank you so much. And to Richard, Ryan, and Sean, thank you so much. It's been absolutely smashing. They're all staying for drinks afterwards. So please make sure to catch up with the fund managers. Most of them are going to be here. We're going to have drinks in the foyer where we had lunch. And then we're going to have a fantastic venue here for you tonight, or function here tonight. Olga and Tanya have done a lot of work. There's a lot of excitement at 6 this evening. To everybody online, thank you so much for joining us. And to our audience here and all the presenters, you've done an absolute fabulous job today, really bringing it on. And we're looking forward to seeing you all here again tomorrow morning at 9. For our live audience, we'll see you at the function a little bit later. Please enjoy it. Thank you.